Let me tell you a story about two men, both born in America around the same time. Their lives could not have been more different. Yet their stories hold the single most important lesson about money. The first man was Ronald Read. For 25 years, he fixed cars at a gas station. For another 17 years, he swept floors as a janitor at J.C. Penney. He lived in a small two-bedroom house his entire adult life. He was a quiet, unassuming man. When he passed away in 2014 at the age of 92, his friends and family were shocked to discover his secret. This humble janitor had amassed a fortune of over $8 million. He left $2 million to his stepkids and the other $6 million to his local hospital and library. Now, consider the second man, Richard Fuscone. He was the inverse of Ronald Read in every way. He was a Harvard-educated Merrill Lynch executive. His financial career was so successful that he retired in his 42nd to become a philanthropist. He borrowed heavily to expand his lavish 18,000 square foot mansion, which had 11 bathrooms, 2 elevators, 2 pools, and a monthly upkeep cost of over $90. Then, the 2008 financial crisis hit. The debt and illiquid assets destroyed him. In 2014, the same year Ronald Read's secret fortune was revealed, Richard Fuscone declared bankruptcy. Now ask yourself, how is this possible? How can a janitor with no formal training, no complex spreadsheets, and no insider connections financially outperform a top-tier executive from one of the world's biggest financial firms? The answer is the entire point of our journey together today. And it has almost nothing to do with intelligence. It has everything to do with behavior. What we see here is that financial success is not a hard science. It's a soft skill, where how you behave is infinitely more important than what you know. Ronald Read was patient. Richard Fuscone was greedy. It was that simple. One man understood the power of time and compounding, while the other was brought down by pride and an insatiable desire for more. Their stories prove that the person who has no financial education but has mastered a few simple behavioral skills can outperform a financial genius who has lost control of their emotions. This is the psychology of money. It's a force that affects us all, every single day. Over the next few minutes, we will unpack the hidden biases, the emotional triggers, and the flawed mental models that secretly drive our financial decisions. We're going to explore why we sabotage our own wealth and how to finally stop, because building wealth isn't about being the smartest person in the room. It's about being the most disciplined. Hello, and welcome. Today, we embark on a journey, not just into the world of finance, but deep into the landscape of the human mind. We are about to explore one of the most insightful books on personal finance written in the last decade, The Psychology of Money by Morgan Housel. Now, if you hear the words finance book, and your mind immediately pictures complex charts, indecifrable jargon, and rigid formulas for calculating returns, I want you to pause and set that image aside. Morgan Housel's masterpiece isn't about that. Its premise is deceptively simple, yet profoundly revolutionary. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. It posits that financial success is not a hard science. It's a soft skill, where psychology and your personal history with greed, fear, and optimism play a far bigger role than any spreadsheet. And that's why this book matters so deeply. It's not a manual for the market. It's a mirror for the mind. Before we dive into Housel's brilliant chapters, I feel it's only right to start with my own story, a moment of financial folly that this very book helped me understand. It happened in March of 2020. The world was grinding to a halt. Fear was palpable, not just on the news, but in the silence of the streets. And my investment portfolio, which I had so proudly built over the years, was bleeding. Every single day, I would open my brokerage app, a knot of dread tightening in my stomach. I saw red, cascading, terrifying red. Years of gains were wiped out in a matter of weeks. Logically, I knew the age-old advice: don't panic, stay the course. Time in the market beats timing the market. I had read it in a dozen books. I had nodded along sagely to podcasts. But reading a principle and living it through a storm are two entirely different universes. The logic in my brain was being drowned out by a primal scream in my gut. This wasn't a theoretical downturn. It felt like a personal attack. Every news alert about the economy felt like a punch. I saw my future, my security, my goals evaporating in real time. My carefully constructed financial plan felt like a house of cards in a hurricane. And so, I did what my terrified, emotional mind told me to do. I sold, not everything, but a significant chunk. I told myself it was to preserve capital, to wait for the dust to settle. But it wasn't a strategic move. It was an act of pure, unadulterated panic. I was trying to stop the pain. The moment I hit the confirm sell button, there was a brief, fleeting sense of relief. I had done something. I had taken control. But that relief was quickly replaced by a hollow feeling of regret, because what happened next is, of course, history. The market, against all logic and expectation at the time, began one of the most ferocious recoveries we've ever seen. And I was sitting on the sidelines, with cash that was losing value and a portfolio that had locked in its losses. I had sold at the very bottom. I didn't just lose money. I lost the opportunity for recovery and growth. The financial cost was significant, but the psychological toll was worse. I felt foolish, weak, and angry at myself. Why couldn't I follow the simple rules I knew to be true? The answer, which Morgan Housel so eloquently explains, is that I am human. My decisions weren't made on a spreadsheet. They were made in the crucible of fear and uncertainty. And that experience is precisely why we are here today. Together, this series is not going to be a simple, straightforward reading of the book. You can find that anywhere. This is what I like to call a humanized audiobook experience. It's an exploration. We will read Housel's words. Yes, but we will also pause to let them breathe. We will treat his insights not as commandments, but as conversation starters. After exploring a key concept, I'll share my own reflections. Just as I've done now, we'll connect his timeless wisdom to the turbulent headlines of today. I'll pose questions that I encourage you to reflect on in your own life. Your own history with money. Your own behaviors. Think of this as our shared journey. A book club where we get to the heart of why we do what we do with our wealth. We're not just aiming to understand the psychology of money. We're aiming to understand our own. So, I invite you to get comfortable and open your mind. Over the coming sessions, we will dismantle the myths that hold us back. We will investigate the strange and powerful forces of luck and risk. We will learn why humility is a financier's greatest asset, and why the ability to endure is more powerful than the pursuit of high returns. This is more than just a book about investing or personal finance. It's a deep, immersive exploration into our collective relationship with wealth, security, and happiness. It's a journey to becoming not necessarily a smarter investor, but a wiser one. Let's begin. Welcome to our exploration of Morgan Housel's The Psychology of Money. Why couldn't I follow the simple rules I knew to be true? The answer, which Morgan Housel so eloquently explains, is that I am human. My decisions weren't made on a spreadsheet. They were made in the crucible of fear and uncertainty. And that experience is precisely why we are here today. Together, this series is not going to be a simple, straightforward reading of the book. You can find that anywhere. This is what I like to call a humanized audiobook experience. It's an exploration. Think about modern financial advice. It's often presented like physics, a world of rules, formulas, and absolutes. We're told to save a certain percentage, invest in a specific way, and avoid particular debts. These rules are logical, derived from data and spreadsheets, but they often fail to account for the most powerful force in finance, the messy, emotional, and deeply personal human element. People don't make financial decisions on spreadsheets. We begin with the foundational first chapter. A concept so simple yet so profound, it changes how you view every financial decision you and others make. No one's crazy. They make them at the dinner table, in a hospital room, or in the grip of fear or aspiration, and the lens through which they view these decisions was forged by their own unique life experiences. Housel's central argument is this: your personal experiences with money make up maybe 0.1% of what's happened in the world, but they account for maybe 80% of how you think the world works. And because we all have different experiences, we all have different views on how money works. To understand this, let's travel back in time. Imagine you were born in 1910. Your formative years, your late teens and early 20s, are dominated by the Great Depression. You don't just read about unemployment. You see it in the shuttered factories and the long bread lines. You feel the gnawing anxiety as your family stretches every penny. You watch neighbors who were once prosperous lose everything. The stock market isn't an abstract concept of growth. It's the monster that devoured your family's savings. For you, risk is not an opportunity. It's a clear and present danger that can snatch away your security in an instant. Decades later, even in times of prosperity, the memory of that fear lingers. The idea of putting your hard-earned money into something as volatile as stocks might feel like pure insanity. Keeping cash stuffed under a mattress, while financially inefficient according to a spreadsheet, feels like the only rational way to protect yourself from a world that has proven it can collapse without warning. Your behavior makes perfect sense to you. Now, let's shift to someone born in 1990. Their formative years are shaped by the tech boom of the late 90s and the long, roaring bull market of the 2010s. They witnessed the birth of world-changing companies like Google and Amazon. They saw friends and family build wealth through stock market investments and tech IPOs. Recessions, like the one in 2008, appear as temporary dips. Scary, yes, but ultimately, buying opportunities on a chart that always seems to go up and to the right. For this person, cash under the mattress isn't security. It's a guaranteed loss to inflation. The biggest financial risk, in their eyes, is not being invested. It's the risk of being too conservative and missing out on the compounding growth that seems to be the primary engine of wealth in the modern world. Their desire to invest aggressively in technology stocks isn't recklessness. It's a logical response to the world they've experienced. So, who is right? The Depression-era survivor, or the tech-era optimist? The answer is both. They are both making rational decisions based on their own, equally valid, personal realities. Let's explore this with another powerful example. Housel uses lottery tickets. From a purely financial perspective, buying lottery tickets is a terrible decision. The odds of winning are astronomically low. For a high-income individual, it's often seen as a stupidity tax money that would be far better served in a high-yield savings account or an S&P 500 index fund. It seems utterly irrational. But let's step into the shoes of someone with a very low income. For them, the gap between their current financial state and true financial security, owning a home, being debt-free, sending a child to college, is not a gap. It's a chasm. Saving an extra $20 or $50 a week feels futile. It won't bridge that chasm in their lifetime. It might buy a slightly better brand of groceries, but it won't fundamentally change their circumstances. The lottery ticket, in this context, is not a financial investment. It is the purchase of hope. For $3, they are buying the right to dream for a few days. They are buying a fantasy of a life without financial worry. A tangible ticket that represents a slim, but not zero, chance of escape. Is it a sound financial strategy? No. But is it a rational decision from their perspective, where traditional saving feels hopeless? Absolutely. It's an emotional hedge against despair, and that, to them, is worth the price. Understanding this principle that everyone's financial choices make sense to them is the foundation of empathy. It stops us from judging and pushes us towards understanding. When you see a friend take out a huge loan for a fancy car, the immediate reaction might be to criticize them for being financially irresponsible. But perhaps they grew up in a family where a broken-down car was a constant source of stress, leading to lost jobs and missed appointments. To them, the high monthly payment is a price they are willing to pay for the psychological security of knowing their transportation is reliable. When you see a young person gambling on speculative meme stocks, you might see a reckless fool. But perhaps they've only ever seen a world where the safe paths, a college degree and a corporate job, led their parents to layoffs and stagnant wages. In their world, taking huge risks feels like the only viable path to getting ahead. We are all just telling ourselves stories about how the world works, and our financial decisions are the outward expression of those stories. So, the final and most important step is to turn this lens of understanding inward. It's time to ask yourself, what is my money origin story? What were the first lessons you learned about money? Were they taught explicitly? Or did you absorb them through observation? Think about your parents. How did they talk about money? Was it a source of excitement and opportunity? Or was it a constant, whispered source of anxiety and conflict? Did you experience financial hardship as a child? Or were you always comfortable? Did a major economic event, like a recession or a local factory closing, impact your family and your community? These early experiences are like the operating system running in the background of your financial life. They dictate your instinctive reactions to risk, your feelings about saving versus spending, and your beliefs about what's possible for you financially. Recognizing these patterns is not about assigning blame. It's about gaining awareness. Once you understand the why behind your financial behaviors, why you instinctively hoard cash, or why you feel a compulsion to spend every dollar you earn, you can begin to make conscious choices. You can decide which parts of your story still serve you and which parts you're ready to rewrite. Because in the world of money, no one is crazy. The most important thing is to understand your own story. In Chapter 2, Morgan Housel introduces a foundational concept that shapes our entire relationship with money. No one is crazy. Your financial decisions make perfect sense to you, but they might seem insane to me. Why? Because our view of the financial world is sculpted by our unique, personal experiences. What we've lived through dictates what we believe is possible, what we should fear, and where opportunity lies. Housel argues that our personal experience with money is just a tiny sliver of what has happened throughout history. Yet it forms the bedrock of our financial worldview. Let's explore how deeply this runs. Consider the stock market. We often talk about its average historical return, but no one actually experiences the average. Your lived experience depends entirely on when you were born. Imagine an American born in 1950. In their teens and 20s, their formative years for understanding how the economy works, the S&P 500, adjusted for inflation, grew nearly tenfold. The country was recovering from war. Productivity was booming, and economic optimism was the air they breathed. For them, stocks are seen as a powerful engine for wealth creation. Their normal is a market that consistently goes up. Now, picture someone born in 1970. In their teens and 20s, they witnessed a completely different world. The economy was stagnant, and inflation was rampant, soaring into the double digits. The stock market went virtually nowhere in real terms for over a decade. They experienced the Black Monday crash of 1987. Their normal is a world where money loses its value, and the market is a fickle, dangerous beast. Neither person is wrong. Neither is crazy. They are both responding rationally to the slice of history they personally witnessed. Their lessons about risk, reward, and the nature of the market are imprinted on them for life. This phenomenon is a form of generational imprinting. Major economic events leave scars and create beliefs that are passed down. The generation that lived through the Great Depression learned to distrust banks and the stock market, valuing cash and tangible assets above all else. Their children likely heard these stories of caution. Conversely, the generation that came of age during the dot-com boom of the late 1990s learned that immense fortunes could be made overnight in technology stocks, leading to a higher tolerance for speculative risk. The inflation fears of the 1970s are another perfect example. For those who saw their savings eroded year after year by rising prices, the fear of inflation is visceral. It dictates their preference for real estate or inflation-protected bonds. But for a younger person who has only known a world of low percent stable inflation, this fear can seem abstract, even overblown. It's not just about when you were born, but also where local economic conditions dramatically shape our perspective. Someone who grew up in a thriving tech hub like Silicon Valley sees risk and opportunity differently than someone from a declining industrial town. If you witnessed friends and family getting rich from tech startups, you're more likely to believe in the power of venture capital and entrepreneurship. If you saw factories close and jobs disappear, you're more likely to prioritize job security and a stable pension over risky investments. What seems like a brilliant opportunity to one person looks like a reckless gamble to another, based entirely on the economic environment they know. The crucial takeaway from this chapter is a lesson in humility. Our personal experience, the one that feels so real and all-encompassing, is perhaps just 1% of what's happened in the world. Yet, as Housel says, it might account for 80% of how we think the world works. We are all playing the same game, but on fields with different goalposts, different rules, and different scoreboards defined by our generation, our parents, and the corner of the world we call home. Understanding this is the first step toward making better financial decisions. It allows us to appreciate that other perspectives are valid and to seek wisdom beyond our own limited experience. By studying history and listening to others who have seen a different part of the game, in the world of finance, we worship at the altar of skill. We study the titans of industry: Warren Buffett, Jeff Bezos, Elon Musk, believing their success is a clean, replicable formula of genius, grit, and strategy. We read their biographies, searching for a roadmap. But what if that roadmap is missing two of the most important coordinates? What if every financial outcome, from bankruptcy to billionaire status, is governed by two inseparable twins, luck and risk? Morgan Housel begins this crucial chapter by forcing us to confront a simple, yet uncomfortable, truth. Nothing is as good or as bad as it seems. Let's consider the story of Bill Gates. His genius is undeniable. His ambition, legendary. But a key part of his story is pure, unadulterated luck. In 1968, Gates attended Lakeside School, one of the only high schools in the entire world with a computer. The odds of a teenage boy in the late 1962 having access to a school computer were, as Gates himself admits, less than 1 in a million. This wasn't a result of his foresight or hard work. It was a random stroke of fortune that gave him a colossal head start. Without Lakeside, there might be no Microsoft. Now, consider Gates's classmate, Kent Evans. He was just as brilliant, just as obsessed with the computer, and shared the same vision. By all accounts, he was destined for a similar trajectory. But Kent died in a mountaineering accident before he graduated. He experienced the other side of the coin, risk. The same forces of probability that blessed Gates with an opportunity delivered a random, tragic outcome to Evans. This is the core of Housel's argument. Luck and risk are two sides of the same coin. They are the reality that every outcome in life is guided by forces other than individual effort. They are the statistical variables we can't see. The events that happen to you, not because of you. The problem is, we are terrible at recognizing them. Why? Because our brains are wired for narrative. We crave stories with clear cause and effect. It's inspiring to believe that Jeff Bezos built Amazon solely through customer obsession and relentless innovation. It's a less satisfying, and frankly more intimidating, story to say he was also the beneficiary of being in the right place at the right time with the right idea. This leads us to one of the biggest dangers in finance, attempting to emulate the success of others. When we look at extreme outliers, we are almost always looking at extreme results of luck. Of course, skill was involved, but the luck component is what pushed them into a statistical stratosphere that is impossible to plan for. For every Bill Gates, there are thousands of equally smart and driven entrepreneurs who simply didn't get that lucky break. They chose the wrong market, faced an unforeseen competitor, or were hit by a recession at the worst possible moment. We don't study these failures. This phenomenon is called survivorship bias. We focus on the winners, the survivors, and we inadvertently ignore the silent majority who used the same strategies and failed. Imagine 100 million investors, all starting with $1, purely by chance. After 1 year, about 50 million will have made money. After 10 years, about 100,000 will have made money every single year. After 20 years, about 100 people will have a perfect, unbroken record of success. Do we call these 100 people geniuses? Do we write books about their infallible strategies? Or do we acknowledge that in a massive game of chance, a few perfect records are a statistical inevitability? The challenge is that in the real world, luck and skill are never that clearly separated. They are woven together. This difficulty in separating them gives rise to a dangerous psychological quirk, the fundamental attribution error. When we succeed, we tend to attribute it to our own skill. We picked the right stock because we were smart. Our business thrived because of our brilliant strategy. Our success was earned. But when we fail, we blame external factors. We lost money because the market was irrational. The business failed because of a bad economy. Our failure was just bad luck. We are forgiving with our own failures, but demanding of our successes. We do the opposite when judging others. We see someone else's failure and quickly attribute it to their mistakes or lack of skill. We see their success and might chalk it up to them just getting lucky. This biased thinking prevents us from learning the right lessons. If you believe all your successes are due to skill, you become overconfident and take on too much risk. If you believe all your failures are due to bad luck, you never learn from your mistakes. The key is to develop a balanced view. Acknowledge that your successes probably involved a healthy dose of luck, which fosters humility. Acknowledge that your failures might not have been entirely your fault, which fosters forgiveness and the resilience to try again. So, what is the practical takeaway? If so much is left to chance, should we just give up? Absolutely not. Housel's advice is profound in its simplicity. Focus maniacally on what you can control. You can't control if the market will crash next year, but you can control your savings rate. You can control your patience. You can build a margin of safety into your financial plan, having enough cash and a diversified portfolio so that one bad outcome, one stroke of bad luck, doesn't wipe you out. Don't aim to be the next Warren Buffett. His level of success is a non-replicable combination of skill, historical context, and luck. Instead, focus on broad, universally applicable principles. Save a high portion of your income. Be patient and let compounding work for you over decades. Diversify your investments so you aren't reliant on one company or industry succeeding. The goal is not to get every decision right. The goal is to build a financial plan that is robust enough to work even when some of your decisions are wrong and when the world throws a dose of bad luck your way. Luck and risk teach us that we should be kinder to ourselves when we fail and more skeptical of ourselves when we succeed. They remind us that financial success is not a hard science, it's a soft skill, where how you behave is more important than what you know. By accepting the twin forces of luck and risk, you stop trying to predict the unpredictable and start building a resilience that can withstand whatever the future holds. Chapter 4. Ampere's Case Study in Luck. Bill Gates. We often look at extraordinarily successful people like Bill Gates and see a clear line of genius, ambition, and relentless hard work. We build a narrative that their success was inevitable, a direct result of their unique qualities, and while those qualities are undeniably present, this narrative is dangerously incomplete. It ignores the wild, unpredictable, and powerful force that Morgan Housel calls the other side of risk luck. Bill Gates' story is not just a story of brilliance. It's one of the most powerful case studies in the profound impact of a series of fortunate, low-probability events. Let's travel back to 1968. Bill Gates was a teenager. But he wasn't just any teenager. He was a student at Lakeside School, a private school in Seattle. In the grand scheme of things, this might seem like a minor detail, but it was everything. Because in 1968, Lakeside School did something that almost no other high school in the entire world did it got a computer. This wasn't an Apple II or a Commodore 64. This was a teletype Model 33 terminal, connected via phone lines to a massive General Electric mainframe computer. A small group of mothers, the Lakeside Mothers Club, had held a fundraiser and used the proceeds, $3,000, to lease this machine for their students. In 1968, there were about 303 million high school-age people in the world. About 18 million of them were in the United States. About 270,000 lived in Washington State. A little over 100,000 lived in the Seattle area, and only about 300 attended Lakeside School. The odds of a teenager in 1968 attending a high school with a computer were, statistically speaking, infinitesimal. It was a 1 in a million event. Bill Gates happened to be one of those ones. This single event gave Gates and his friend Paul Allen a head start that was almost impossible to replicate. While other future tech pioneers were still reading about computers in magazines, Gates was programming one. He and his friends spent thousands of hours on that teletype terminal, learning, experimenting, and mastering a skill that was virtually inaccessible to anyone else their age. As Gates himself later admitted, if there had been no Lakeside, there would have been no Microsoft. But the chain of luck didn't stop there. The school's computer was expensive to run, so the students quickly used up their allotted time. A short while later, a company called Computer Center Corporation, or C-Cubed, opened in Seattle. Realizing that the Lakeside students were among the few people in the world who could test their software on nights and weekends, C-Cubed offered them nearly unlimited computer time in exchange for finding bugs. This was luck compounding on luck. However, C-Cubed went bankrupt a few years later, and the free computer access vanished. But then another fortunate event occurred. The founders of C-Cubed had also started another company called Information Sciences, Inc., and felt bad for the Lakeside kids. So they hired Gates and Allen to write a payroll program, once again giving them access to a computer. One stroke of luck opened the door to the next. The story of Bill Gates, then, is a cascade of improbable events. He was brilliant and driven. Yes, but his brilliance and drive were poured into an opportunity funnel that was almost uniquely available to him. To truly understand the power of luck, however, we must also look at its tragic twin risk. At Lakeside, Bill Gates had a best friend named Kent Evans. Gates described Evans as the smartest kid in our class and the most business-minded of the group. They were inseparable. They talked on the phone for hours, passed notes, and planned their future. They were going to run a company together. They were going to be CEOs. Everything Gates did, he did with Kent. Kent Evans was just as smart, just as ambitious, and had the exact same 1 in a million head start as Bill Gates. His future looked just as bright, but it never came to be. Before graduating from high school, Kent Evans died in a mountaineering accident. Every year, thousands of people die in outdoor accidents. The odds are low, but they are not zero. Kent Evans was on the unlucky side of a low probability event, a risk. It was a random, tragic event that had nothing to do with his intelligence, his work ethic, or his potential. It was simply a bad break. For every Bill Gates, there is a Kent Evans, someone equally skilled and driven, whose journey was cut short by a risk they never saw coming. When we study success, we see the Bill Gateses of the world because they are the ones who survived. They are visible. We don't see the Kent Evanses, because their stories ended before they could become case studies. This creates a dangerous survivorship bias. We look at Gates and think, I just need to be smarter and work harder. We completely miss the lesson from Kent Evans. You can be just as smart and work just as hard, and still be derailed by a force totally outside your control. Think about it. What if Bill Gates hadn't gone to Lakeside? What if the Lakeside Mothers Club had decided to spend that $3,000 on new library books instead of a computer terminal? What if Kent Evans had decided not to go hiking that day? A single, tiny change in the chain of events, and the world we know today might be completely different. There would be no Microsoft as we know it. Bill Gates might have become a successful lawyer or a math professor. He would still have been brilliant, but his impact would have been a fraction of what it became. The lesson here is not to diminish the accomplishments of people like Bill Gates. His hard work and genius are undeniable. The lesson is one of humility. It's to recognize that success is not just the result of individual effort. It's the product of hard work meeting opportunity. And opportunity is often sculpted by the invisible hand of luck. When we idolize individuals, we risk learning the wrong lessons. We focus on their tangible actions because they are easy to copy, while ignoring the crucial role of luck because it is impossible to replicate. This leads to a skewed view of the world, where we believe success is a simple formula to be followed, and we judge those who fail as simply not having tried hard enough. The reality is far more complex. So, when you look at success, yours or someone else's, remember the full picture. Acknowledge the grit, the effort, and the intelligence, but also leave room for luck. And when you look at failure, leave room for risk. This balanced perspective doesn't just make us more empathetic, it helps us make better decisions by understanding the true, and often random, nature of outcomes in the real world. In the world of technology and finance, we idolize stories of singular genius. We look at figures like Bill Gates and see a straight line drawn from brilliance to staggering success. But for every story we tell, there's an equally important one that goes unheard. Morgan Housel invites us to look at the negative image of the photograph, to understand the flip side of luck. This is the story of risk. And it begins in the very same place as Bill Gates' story at Lakeside School in Seattle, with a boy named Kent Evans. To understand Bill Gates, you must first understand Kent Evans. By all accounts, including Gates's own, Kent was his equal, if not his superior. Paul Allen, the other co-founder of Microsoft, described Kent as having the most brilliant and business-oriented mind of all the Lakeside computer whizzes. Gates himself said Kent was the smartest kid he ever knew. They were best friends, inseparable partners in the nascent world of computer programming. While other kids were playing sports, Gates and Evans were losing themselves in the glow of a teletype terminal, speaking a language of code that few others in the world yet understood. They dreamed together, not of small ventures, but of changing the world. They talked about becoming CEOs of major companies, about the future they would build together. They even had a plan. One day, Bill Gates called Kent and told him, with the supreme confidence of a teenager who saw the future, "We need to call Lakeside and let them know we want to run the computer on campus this summer." Kent's reply was immediate and ambitious. "That is a great idea. We should definitely do that." They envisioned a future where they would be partners, leading the charge into the digital age. This wasn't just a fantasy, it was a tangible, achievable goal for two boys with prodigious talent and unrelenting drive. But the future they planned would never happen. For Kent Evans, That future ended before he even graduated high school. The great risk in life, the one we so often ignore, is rarely the one you see coming. It's not the market correction you've been nervously anticipating or the competitor you've been watching. It's the bolt from the blue. For Kent, that bolt came in the form of a mountaineering accident, a single, random, tragic event. He was gone, just like that. A 1 in a million statistical probability ended one of the world's most promising young minds. This is the brutal, unforgiving nature of risk. It's the parallel universe to luck. For every Bill Gates, who benefited from a 1 in a million combination of being in the right place, at the right time, with the right skills, there is a Kent Evans who was subject to a 1 in a million tragedy. Same school, same skills, same ambitions, same work ethic, but entirely different outcomes dictated by forces utterly beyond their control. Kent's story is a profound and somber lesson. Talent, hard work, and brilliant ideas are not enough. You also have to survive. You have to survive long enough for your efforts to compound, for your luck to find you. And survival is not always in your hands. This forces us to redefine what risk truly is. We tend to think of risk in financial terms, the volatility of a stock, the chance of an investment going to zero. But Housel argues this is a dangerously narrow view. The most significant risks are the ones that have little to do with your investment portfolio. They are the tail-end events, the things we don't plan for because they seem too improbable. A health crisis, a sudden accident, a global pandemic, a political shift. These are the events that can render your perfectly crafted financial models and spreadsheets completely irrelevant. Kent Evans's story is the ultimate illustration of a single point of failure. It doesn't matter how robust the other 99 parts of a system are, if one critical component can bring the entire thing crashing down. For Kent, and for all of us, that single point of failure is our own life and health. He could have been the most disciplined saver, the most brilliant programmer, the most insightful business strategist in the world. But none of it mattered in the face of a mountaineering accident. A single risk, realized, negated all other strengths. So, what is the takeaway for our own financial lives? The lesson from Kent's tragic story is the critical importance of a margin of safety. This isn't just about having some cash on the sidelines in case the market dips. It's a broader philosophy. It's about building resilience and redundancy into your life. It's about avoiding situations where one single event, one bad outcome, can wipe you out completely. This means having insurance. It means having an emergency fund. It means diversifying not just your investments, but your skills and income streams. It means not taking on so much debt that a single job loss leads to ruin. It means recognizing that the future is unknowable, and that the most important part of any plan is planning for the plan not to go according to plan. Ultimately, the tale of Bill Gates and Kent Evans is not just a story of success and tragedy. It's a story about probability. Two individuals, standing side by side, were sent on wildly divergent paths by the extreme, unpredictable tales of a probability distribution. One was touched by extraordinary luck, the other by extraordinary risk. The lesson isn't to be cynical or to live in fear. It is to be humble. It is to acknowledge that we are not invincible masters of our own destiny. We are participants in a complex game where the rules are not always clear and the outcomes are heavily influenced by chance. Managing your money well isn't just about maximizing returns. It's about ensuring you can survive the inevitable and unpredictable setbacks. It's about staying in the game long enough to let the odds of success work in your favor. Because, as Kent Evans' story so painfully reminds us, the most brilliant plan in the world is useless if you're not around to see it through. Welcome back. In this chapter, we confront one of the most dangerous paradoxes in finance. Why do people who have everything risk it all for just a little bit more? Morgan Housel's Chapter 6, titled Never Enough, delves into the destructive psychology that drives already wealthy individuals to make baffling, life-ruining decisions. It's a story not just about money, but about ego, envy, and the hardest financial skill of all, getting the goalposts to stop moving. Let's start with a concept known as the hedonic treadmill. Imagine you get a significant raise or a financial windfall. At first, you feel an incredible surge of happiness. You buy the bigger house, the nicer car, the things you've always wanted. Life is good. But then, something strange happens. That new, elevated standard of living becomes your new normal. The initial joy fades. You've adapted to get that same rush of happiness again. You need another, even bigger win. This is the treadmill. You're running faster and faster, accumulating more and more. But your baseline level of happiness stays stubbornly in the same place. It's a race with no finish line, fueled by a simple, powerful, and deeply human flaw. The fuel for this treadmill is a potent poison: social comparison. Housel observes that modern capitalism is a master at two things: generating wealth and generating envy. No matter how much you have, it's incredibly easy to find someone who has more: a bigger house, a faster car, a more exotic vacation. You might be a successful doctor living in a beautiful home, but you look at the investment banker next door with a private jet, and suddenly your success feels diminished. The problem is that the ceiling of your own desires often becomes the floor of what you see someone else enjoying. You're playing a game that is impossible to win, because someone will always be at the next level up. It's like trying to drink from a fire hose of lifestyle inflation. You'll never quench the thirst. This isn't about greed in the traditional sense. It's about a distorted sense of self-worth tied to your relative standing against others. The consequences of this mindset can be catastrophic. Housel presents two stark examples. First, consider Rajat Gupta. Here was a man who had reached the pinnacle of the business world. He was the former CEO of McKinsey, one of the world's most prestigious consulting firms. He sat on the boards of Goldman Sachs and Procter & Gamble. His net worth was estimated to be over $100 million in 2008. Plast by any rational measure, he had won the game. He had more money than he could ever spend. But he wanted to be a billionaire. His social circle included titans like Warren Buffett and Bill Gates. And next to them, his $100 million felt inadequate. This desire, this comparison, led him to engage in insider trading. He illegally passed on a tip about Warren Buffett's $5 billion investment in Goldman Sachs. For this, he hoped to make a relatively small profit, a few $1,000,000. That would be a rounding error on his existing fortune. The result: he was convicted, sent to prison, and his once sterling reputation was irrevocably destroyed. He traded everything he had: his freedom, his honor, his legacy, for something he absolutely did not need. Then there's the infamous case of Bernie Madoff. What's often forgotten about Madoff is that his legitimate market-making business was already wildly successful. He was a multi-millionaire, a respected figure on Wall Street. He and his family were fabulously wealthy. But it wasn't enough. The legitimate profits were impressive, but they weren't the steady, godlike, impossible returns that would earn him the ultimate status and envy of his peers. So, he built a lie, a massive Ponzi scheme that offered the illusion of invincibility. It wasn't just about the money. It was about the adoration and respect that came with being seen as a financial genius. He craved the status more than the cash. When it all came crashing down, he had not only lost his fortune, but had destroyed the lives of thousands of people, including his own family. Both Gupta and Madoff were already at the top, yet they risked everything because their appetite for more money, more status, more prestige, had no limit. So, what's the antidote to this poison? How do you get off the treadmill before it throws you off a cliff? Housel's answer is simple in concept but difficult in practice. You have to define what enough means to you. This is the only off-ramp from the endless pursuit. Enough isn't about being lazy or lacking ambition. It's about recognizing that the undisciplined pursuit of more will eventually lead to regret. It's understanding that there are things that can be destroyed in an instant that no amount of money can ever buy back: reputation, freedom, family, and friends. The ability to say, "I have enough," is a form of wealth that can't be measured on a balance sheet. It means you've stopped moving the goalposts. It means you understand that the cost of reaching for that next incremental bit of wealth might be your own peace of mind. It's about knowing when to stop taking risks that could ruin you. True financial independence isn't just having a lot of money. It's having control over your time and your life, free from the compulsion to keep chasing a moving target set by others. In the end, the stories of Rajat Gupta and Bernie Madoff are cautionary tales about the dangers of a financial appetite that can't be satisfied. They teach us that the hardest financial skill has little to do with spreadsheets or market analysis. It's a soft skill knowing when to say enough. It's realizing that the best way to maintain wealth is to avoid the stupid risks that arise from envy and an insatiable need for more. True wealth is the ability to sleep at night, knowing that what you have is sufficient and that you haven't risked the things that truly matter in a foolish quest for things that don't. Chapter 7: Freedom. We've just discussed the ultimate power of money, the ability to control your time. But what happens when the desire for more times money, eclipses everything else? Even freedom itself. To understand this paradox, we must look at the tragic story of a man who had everything, yet felt he had nothing. Meet Rajat Gupta. His life was the embodiment of the American dream, a true rags-to-riches story. Born in Kolkata, India, he was orphaned in his teens. Yet, through sheer brilliance and determination, he clawed his way to the very top. He earned a coveted spot at Harvard Business School and then joined the world's most prestigious consulting firm, McKinsey & Company. He didn't just join, he conquered it, becoming its global head, its CEO. In 1994, he served 3 terms, an unprecedented feat. By the time he retired from McKinsey in 2007, Rajat Gupta was not just successful, he was extraordinarily wealthy. His net worth was estimated to be around $100 million. Let that number sink in. $100 million for 99.9% of the world's population. This is an unimaginable fortune. It represents absolute financial freedom, the ability to do what you want, when you want, with whom you want, for as long as you want. He had won the game. He had reached the pinnacle. So, why did a man with $100 million, a sterling reputation, and a lifetime of achievements throw it all away for a little more? The answer lies in one of the most powerful and destructive forces in finance: social comparison. After retiring from McKinsey, Gupta joined some of the most exclusive corporate boards in America, including Goldman Sachs and Procter & Gamble. Here, he wasn't just rubbing shoulders with mere millionaires. He was in the same room as billionaires. He sat at tables with titans like Warren Buffett. In this new, rarefied atmosphere, his $100 million suddenly felt inadequate. He was a millionaire, but he desperately wanted to be a billionaire. His goalpost had moved. This insatiable desire, this envy, led him to break the law. In 2008, at the height of the financial crisis, he sat on a Goldman Sachs board call where he learned that Warren Buffett was about to invest $5 billion into the struggling bank. This was market-moving, confidential information. Mere seconds after the call ended, Gupta picked up his phone and called Raj Rajaratnam, a hedge fund billionaire. Rajaratnam's fund immediately bought millions of dollars in Goldman Sachs stock, profiting immensely when the news became public. Gupta wasn't paid directly for the tip, but it was part of a larger web of business dealings he had with Rajaratnam. Dealings he hoped would catapult him into the billionaires club. His gamble failed. The scheme unraveled. And in 2011, Rajat Gupta, the former head of McKinsey, the globally respected leader, was arrested for insider trading. He was convicted and sent to federal prison. He lost his fortune, his reputation, and his freedom. After retiring from McKinsey, Gupta joined some of the most exclusive corporate boards in America, including Goldman Sachs and Procter & Gamble. Here, he wasn't just rubbing shoulders with mere millionaires. He was in the same room as billionaires. He sat at tables with titans like Warren Buffett. In this new, rarefied atmosphere, his $100 million suddenly felt inadequate. He was a millionaire, but he desperately wanted to be a billionaire. His goalpost had moved. If you're a billionaire, you see the multi-billionaires who own sports teams. If you own a sports team, you see the tech titans aiming for Mars. The game never ends. The only way to win is to refuse to play. It's to accept that your own measure of enough cannot be dictated by what you see others have. It requires stepping off the hedonic treadmill and defining your own finish line. It means understanding that the appetite for more money, more power, more prestige will push you to take bigger and bigger risks, until you eventually risk it all. Gupta wasn't paid directly for the tip, but it was part of a larger web of business dealings he had with Rajaratnam. Dealings he hoped would catapult him into the billionaires club. His gamble failed. The scheme unraveled. And in 2011, Rajat Gupta, the former head of McKinsey, the globally respected leader, was arrested for insider trading. He was convicted and sent to federal prison. He lost his fortune, his reputation, and his freedom. Welcome to Chapter 8, The Power of Compounding More Than Just Math. We often hear the word compounding and think of a dry mathematical formula, something you'd see in a finance textbook. But Morgan Housel invites us to see it differently. Compounding isn't just math, it's a force of nature, a principle that governs growth in many areas of life. But its most dramatic effects are seen in finance, and understanding it requires a shift in mindset, not an advanced degree in calculus. Our brains are wired for linear thinking. If you save $100 a month, in 10 months you have $1,000. Simple, predictable. But compounding doesn't work that way. It's deceptive. It starts slow, almost invisibly. and then explodes with a force that feels like magic. The key ingredients are not brilliance or daring, but something far more accessible: time and consistency. To truly grasp this, let's look at the ultimate case study, Warren Buffett. When we think of Buffett, we think of an investing genius, a stock-picking wizard, and he is, but his real secret, the bedrock of his unimaginable wealth, is time. His skill is investing, but his superpower is having been invested for 3/4 of a century. Buffett started seriously investing when he was about 10 years old. By age 30, he had a net worth of $1 million, or about $9 million. In today's money, impressive, but not world-shattering. By age 50, his net worth was around $300 million. Again, incredible wealth. But there were many wealthier people on the planet. Here's where the story defies our linear expectations. Over 99% of Warren Buffett's net worth was earned after his 50th birthday, and more than 95% was earned after his 65th birthday. Think about that. The vast, overwhelming majority of his fortune came when he was eligible for Social Security. His story is not one of explosive, year-over-year returns that no one else could match. In fact, his average annual return is remarkable, but not consistently the world's highest. The real magic is that he's been able to earn very good returns uninterrupted for an incredibly long time. He didn't get derailed by recessions, by market crashes, or by his own changing emotions. He just kept going. If Buffett had started investing in his 30s and retired in his 60s, like a normal person, you likely would have never heard of him. His wealth would have been a fraction of what it is today. This illustrates the central thesis of compounding. Good investing isn't necessarily about earning the absolute highest returns. It's not about finding the one stock that will go up 1,000% this year. That's a lottery ticket, not a strategy. True, durable wealth is built by earning pretty good returns that you can stick with and repeat for the longest possible period of time. The pursuit of the highest returns often leads to taking on excessive risk. It leads to trying to time the market, jumping in and out, and eventually making a critical mistake that wipes out your progress. It's like trying to sprint a marathon. You might lead for the first mile, but you'll never finish the race. The investor who earns a steady, respectable 8% a year for 50 years will almost always end up wealthier than the investor who earns 20% one year, loses 15% the next, and gets scared out of the market. The power of compounding is in the staying power. It's about endurance. Imagine we're looking at a graph on the screen right now. The horizontal axis is time, spanning 50 years. The vertical axis is money. We start a small, consistent investment, let's say $400 a month. For the first 5, 10, even 15 years, the line on the graph barely seems to move up. It's a slow, boring crawl. You're putting money in. It's growing a little, but it doesn't feel life-changing. You might look at your statement after a decade and think, is this really working? This is the period where most people lose faith. They get impatient. They abandon the plan for something that promises faster results. But let's watch what happens if you don't. As we move past the 20-year mark, we see the line begin to curve. The growth starts to accelerate. The earnings on your investments are now earning their own earnings, and that effect is becoming noticeable. Now, look at the graph from year 30 to year 40. The curve becomes dramatically steeper. The growth in this single decade likely surpasses all the growth from the first 20 years combined, and from year 40 to 50, The line goes almost vertical. It's an explosion of wealth. The gains in those final years are staggering, dwarfing everything that came before. That final surge, that exponential takeoff, is where the magic happens. But it is magic you can only witness if you are patient enough to sit through the long, boring, and often discouraging early years. The power is not in the amount you invest or the specific return you get in any single year. The real power is in the length of the runway. This fundamentally changes the question we should be asking. The common question, driven by a get-rich-quick culture, is how can I earn the highest returns? What's the hottest stock? What's the next big thing? Housel argues this is the wrong question. A better question, a more powerful question, is what's the best way to ensure I can stay invested for decades? This shifts the focus from picking winners to managing your own behavior. It's about setting a savings rate you can stick with even when life gets hard. It's about diversifying your investments so that a single bad bet doesn't wipe you out and scare you away forever. It's about understanding your own tolerance for risk so you don't panic and sell at the bottom of a market crash. Locking in your losses, compounding, therefore, is a psychological game more than an analytical one. It's about fighting the urge for immediate gratification. It's about having the humility to accept that you don't need to be the smartest person in the room. You just need to be the most patient and consistent. It's about letting the snowball roll down a very, very long hill, allowing it to gather mass and momentum not through frantic effort, but through the simple, unstoppable force of time. Imagine standing in a vast, open valley, the kind carved out by forces of unimaginable power. You see the towering granite walls, the U-shaped basin stretching for miles. What created this? Not a single violent explosion, not an earthquake that split the world. The force that shaped this landscape was patient. It was subtle. It was ice. An ice age is one of the most powerful geological events on our planet, capable of burying entire continents under miles of frozen water. But how does something so monumental begin? The answer is the key to understanding one of the most powerful forces in finance. It doesn't start with a bang. It starts with a whisper. An ice age is not caused by a series of extraordinarily brutal winters. It's caused by summers that are just a little bit cooler than normal. Think about that. Not a catastrophic freeze, but a summer that simply fails to get warm enough to melt all of the previous winter's snow. The next winter comes, and a little more snow falls. The following summer is again just a degree or two cooler than average, and a tiny fraction of that new snow survives. A thin, insignificant layer of ice is left behind. This process repeats for 10 years, for 100 years, for 1,000 years. A millimeter of ice, then a centimeter, then a meter, or a millennia. That tiny, unbroken surplus of cold, that persistent failure to melt back to zero, accumulates. It compresses under its own weight, turning snow into densey, glacial ice. It begins to move, to flow, to carve the very bedrock of the planet. What began as an unnoticeable change in temperature becomes an unstoppable force that reshapes the world. This is the power of compounding. So, what on earth does a 2-mile thick sheet of ice have to do with your investment portfolio? Everything. The logic is identical. The money you save is the winter snow. The returns you earn on your investments, the dividends, the interest, the capital gains, are the effect of the slightly cool summer in your first year of investing. The returns seem trivial, almost insulting. You put in $1,000, and at the end of the year, maybe you have $1,070. That extra $70 feels like that first unmelted layer of snow. It's nothing. You can't do much with it. It's not life-changing. It's easy to look at that and think, this isn't working. The effort isn't worth the reward. And this is where most people fail. They interrupt the cycle, they spend the $70, or they pull their money out in frustration, effectively creating a warm summer that melts the ice back to bare rock. But what if you don't? What if you leave that $70 in the next year? You aren't earning returns on just your original $1,000. You're earning returns on $1,070. The base has grown. Just like the ice sheet got a millimeter thicker, the next year's gain is slightly larger. It's still not much, but the process has begun. Year after year, decade after decade. The process repeats. Your contributions are the new winter snow. Your returns, reinvested, are the cool summers that allow the base to grow. Small, consistent savings and returns, repeated over an uninterrupted period of time, create a financial glacier. It moves slowly, almost invisibly at first, but given enough time, it builds a momentum that is breathtaking. Here is the most important and most difficult part to grasp. The results are always backloaded. They are deeply counterintuitive. If you could have watched the last ice age begin, you would have seen nothing for the first several thousand years. The change would be imperceptible. All the dramatic action, the carving of valleys, the flattening of mountains, the movement of billion-ton boulders happened at the very end of the process. When the mass of accumulated ice became truly immense. Financial compounding works the exact same way. The growth of your money will not be a straight line. It will be a hockey stick. For years, maybe even a decade or two, the line will feel disappointingly flat. You'll be putting in the work, making the sacrifices to save, but the results will seem minor. This is the long, slow accumulation phase. This is the financial equivalent of the first 10,000 years of the Ice Age. But then, if you have the discipline to not interrupt the process, something magical happens. The base of your wealth, your personal glacier, becomes so large that the returns it generates in a single year can be bigger than your total contributions from the first decade. This is the part of the hockey stick that curves sharply upwards. This is when the glacier starts moving mountains. Consider Warren Buffett. He is a legendary investor. But the secret to his wealth isn't just investment genius. It's time. Over 95% of his net worth was earned after his 65th birthday. His skill built the base for the first 50 years of his career. But it was the compounding on that enormous base in his later years that created the truly staggering wealth. The real work was done when it looked like the least was happening. This brings us to a final, critical lesson from our Ice Age analogy. Seeing the slow pace of the glacier, it's tempting to want to speed things up. We are an impatient species. We don't want to wait 40 years for wealth. We want it in 40 months. Or 40 days. In finance, this temptation manifests as a chase for impossibly high returns. It's the allure of speculative stocks, of high-leverage trading, of trying to find the one magic bullet that will make you rich overnight. Trying to do this is like trying to build a mountain with dynamite. You might make a lot of noise. You might move a lot of dirt in a short amount of time, but you are not engaging in a constructive, sustainable process. You are far more likely to cause a landslide, to blow up your foundation, and to be left with less than you started with. True wealth, like the great geological features of our planet, is not built through explosive force. It is built through relentless, Patient pressure. The goal is not to find the highest possible return in a single year. That's a fool's errand that invites ruin. The goal is to find a pretty good, repeatable rate of return that you can sustain for the longest possible period of time. You need to allow the summers to stay cool. You need to let the snow accumulate year after year without interruption. The power of compounding is not an intuitive force. It feels too slow, too passive, too boring. But like the slow, imperceptible thickening of an ice sheet, it is the most powerful, world-shaping force available to the average person. Your job is not to force a mountain to grow overnight. Your job is to let the glacier do its work. In the grand theater of finance, getting wealthy and staying wealthy are two entirely different plays, demanding completely different skills from their actors. Chapter 10 of The Psychology of Money draws a stark line between these two disciplines. As Morgan Housel puts it, getting money and keeping money are two different things. Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite. It requires humility and fear that what you've made can be taken away from you just as fast. It requires frugality and an acceptance that at least some of what you've made is attributable to luck. So you can't rely on past success to repeat indefinitely. Let's first examine the mindset of getting wealthy. Picture a venture capitalist, or VC. Their entire world is built on optimism and calculated risk. A VC might invest in 10 different startups, fully knowing that 9 of them will likely fail, perhaps spectacularly. They're not looking for modest, consistent returns. They are hunting for the one unicorn, the single investment that delivers a 100x or 1000x return, a return so massive it renders all the other failures irrelevant. This is an offensive strategy. It's about taking big swings, embracing volatility, and constantly looking for the next grand slam. This mindset is essential for building wealth from a low base. You have to be willing to fail, to be wrong, and to take chances that others might deem foolish. Now, contrast this with the mindset of staying wealthy. Here, the protagonist is not the swashbuckling VC, but the quiet, consistent index fund investor. Their goal is not to find the next Amazon in a garage. Their goal is to not lose. The game shifts from offense to defense. Staying wealthy is less about making brilliant decisions and more about consistently not making terrible ones. It's about survival. This mindset is built not on optimism, but on humility and a healthy dose of paranoia. Humility is the understanding that the market can and will do things you don't expect. It's knowing that the strategy that made you rich might not be the one that keeps you rich. The world changes. Industries are disrupted, and black swan events happen. The humble investor knows they cannot predict the future. So they diversify, they save, and they maintain a margin of safety. This is where we see the tragic stories of lottery winners, professional athletes, and overnight millionaires who lose it all. They master the first act, getting wealthy, but have no script for the second. A study showed that 70% of lottery winners go broke within a few years. Why? Because they continue to play an offensive game when they should have switched to defense. They receive a life-changing sum of money, but their mindset doesn't change. They lack the fear, the healthy paranoia that someone who spent decades accumulating their wealth possesses. They don't appreciate the fragility of their newfound fortune. They see it as a limitless resource, not as a finite asset that needs to be protected, preserved, and nurtured. They never learned the skill of survival. Survival is the single most important, yet most underrated, skill in finance. It's not about earning the highest returns, because the highest returns often involve taking unbearable risks. It's about staying in the game long enough for the magic of compounding to work. Compounding is not intuitive. It does not feel powerful in the short term. Its effects are only truly felt over decades. But you can only experience those effects if you survive all the market crashes, recessions, personal emergencies, and foolish temptations along the way. Getting wiped out, even once, means you have to start all over, resetting the compounding clock to zero. This is why a lower but more consistent return is almost always superior to a high but fragile one. So, how do you cultivate this survival mindset? It boils down to a few key principles. First, aim to be financially unbreakable rather than chasing the biggest returns. This means having a high savings rate, avoiding debt, and maintaining liquidity. It means that when the market inevitably tumbles, you are not a forced seller. You can wait out the storm and perhaps even see it as an opportunity. Second, embrace frugality. Frugality provides a buffer between your spending and your income, a gap that protects you from the unexpected. It's a shield against the need to take on ruinous risk to meet your lifestyle goals. And third, plan. But acknowledge that the plan might not go according to plan. This is the essence of humility. A good plan has room for error. It anticipates setbacks. It prepares you for a world where past performance is no guarantee of future results. Getting wealthy might be a sprint, fueled by optimism and risk, but staying wealthy is a marathon. A slow, deliberate journey defined by discipline, caution, and the simple, powerful act of survival. In the grand theater of finance, the most powerful force is not genius, nor is it inside information. It is compounding, the quiet, patient process of growth building upon itself. But compounding has one crucial requirement, one non-negotiable ticket for admission time. And the greatest enemy of time is not poor returns, it is ruin, the complete and utter wipeout that prevents you from ever playing again. This brings us to the most underrated skill in all of finance, the psychology of survival. Winning money is only half the battle. Keeping it, ensuring you can stay in the game long enough for compounding to work its magic, is the other, more critical half. The entire game of investing is not about earning the highest returns, because the highest returns tend to be one-off hits that are hard to repeat. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. And that is a game of survival. Imagine being offered a chance to play Russian roulette. But this isn't the standard 6-chamber revolver. This one has 1,000,000 chambers, and only one contains a bullet. If you pull the trigger on an empty chamber, you win $1,000,000. The odds are overwhelmingly in your favor, 99.99999. A statistician would tell you it's a fantastic bet. But would you play? Of course not. No sane person would. Why? Because while the upside is appealing, the downside is catastrophic and irreversible. The game ends. There are no second chances. This is the perfect analogy for financial ruin. Many investment strategies look like this 1,000,000-chamber revolver. They work wonderfully, generating fantastic returns for years, even decades. They seem infallible, but they have a hidden chamber, a small, often ignored probability of a total wipeout And when that one-in-a-million event occurs, the game is over. All your previous winnings are meaningless because you've lost everything. Two of the most common ways investors load that hidden chamber are through leverage and overconcentration. Leverage, using borrowed money to invest, is a double-edged sword forged in fire. When things go well, it magnificently amplifies your gains. A 10% market gain can become a 50% personal gain. It feels like financial genius. But when the market turns, that same leverage amplifies your losses with brutal efficiency. A 10% market drop can become a 50% loss. A 20% drop could wipe you out completely, triggering a margin call that forces you to sell everything at the absolute worst time. You lose all your capital and are kicked out of the game. Similarly, making highly concentrated bets, putting all your capital into one or two stocks, follows the same pattern. The potential for astronomical wealth is tantalizing, but it carries the symmetric risk of complete devastation. A single bad outcome, one unforeseen event, can erase a lifetime of savings. The key insight here is that you can be right 99% of the time and still end up with nothing. The sequence of your returns matters immensely. Getting a string of great returns, followed by a single return that wipes you out, is mathematically equivalent to having never invested at all. The only difference is the years of your life you wasted getting back to zero. Therefore, the goal must be to make yourself financially unbreakable. This durability is not just about surviving market crashes, it's about surviving life. We tend to focus on market risk, but personal life risk is just as potent. You will experience challenges, a job loss, a sudden medical emergency, a costly home repair. These are not black swan events. They are statistical certainties over a long enough timeline. Your financial plan must account for them. If your financial life is so fragile that you are forced to sell your long-term investments to cover a short-term emergency, you have failed the survival test. This is where compounding is brutally interrupted. You sell your assets, often in a down market, locking in losses and sacrificing all future growth. This is why having a substantial cash emergency fund is not an inefficient use of capital. It is the price of admission for staying in the game. It is the buffer that allows your long-term investments to remain untouched, free to compound in peace. It's your ticket to sleeping well at night, knowing that a broken-down car won't derail your retirement. In the end, the psychology of survival teaches us a profound lesson: not losing is far more important than winning big. Warren Buffett famously said, "The first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule." This doesn't mean your portfolio will never go down in value. It will, and frequently. What it means is to avoid the permanent loss of capital, the kind of loss that comes from being wiped out, from being forced to sell, from taking a risk where the downside is ruin. True wealth is built not by chasing meteoric gains, but by methodically plodding forward, year after year, avoiding the catastrophic mistakes that force you to start over. It's about having a margin of safety, both in your portfolio and in your personal finances. It's about valuing durability over brilliance. Your focus should be less on the size of your wins and more on your ability to endure the inevitable losses, because he who survives wins. He who stays in the game long enough for the magic of compounding to take hold is the one who truly builds lasting wealth. In our quest for success, whether in investing, our careers, or our creative pursuits, we often imagine a linear path. We think that consistent, small wins will gradually accumulate into a large victory. We believe that every decision must be a good one. that every investment should yield a positive return, and that every project must be a step forward. But Morgan Housel, in Chapter 12 of The Psychology of Money, presents a radically different and far more realistic picture of how the world actually works. He calls it tails. You win. This is the concept of the long tail. The idea that extraordinary outcomes are not the result of a long string of successes, but of a tiny handful of monumental events that dwarf everything else. To understand this, let's first look at the world of venture capital, which is perhaps the purest demonstration of this principle in action. A venture capital firm might invest in 50 different startups. They pour immense resources, time, and expertise into each one. If you were to track their progress after a few years, what would you expect to find? Perhaps half of them are moderately successful. Maybe a third are big hits. The reality is startlingly different. A more typical outcome is that half of the companies, maybe 25 of them, will fail completely, losing every dollar invested. Another 15 or 20 might just break even or produce a very modest return, barely covering their costs. But then, there are the remaining 1 or 2 companies. These are the tail events. One of them might become the next Google, the next Uber, the next Airbnb. This single investment doesn't just return 2x or 3x the money. It returns 100x, 500x, or even 1000x. The initial investment, the profit from this one monumental success is so vast that it not only covers all the losses from the 25 failed companies and the mediocre returns from the other 25, but it also provides the entire fund's spectacular overall return. Everything else is just a rounding error. The entire business model of venture capital is built on the understanding that most ventures will fail, but that the magnitude of a few winners will be so enormous that it renders the failures irrelevant. They are not trying to be right 100% of the time. They are trying to be colossally right, just once or twice. Now, you might think, that's interesting for billionaire venture capitalists. But what does it have to do with me? Housel argues that this principle governs our personal financial lives more than we realize. Think about your own investment portfolio over a long period, say 20 or 30 years. You might own dozens of stocks or mutual funds. When you look back, you will almost certainly find that the bulk of your portfolio's total return came from just a few of your holdings. These are the tail events. One of them might become the next Google, the next Uber, the next Airbnb. This single investment doesn't just return 2x or 3x the money. It returns 100x, 500x, or even 1000x. The initial investment, the profit from this one monumental success is so vast that it not only covers all the losses from the 25 failed companies and the mediocre returns from the other 25, but it also provides the entire fund's spectacular overall return. Everything else is just a rounding error. The entire business model of venture capital is built on the understanding that most ventures will fail, but that the magnitude of a few winners will be so enormous that it renders the failures irrelevant. They are not trying to be right 100% of the time. They are trying to be colossally right, just once or twice. Warren Buffett, one of the greatest investors of all time, has admitted that he has owned over 400 different stocks in his lifetime. But the vast majority of his wealth came from just 10 of them. The S&P 500 is often seen as a diversified, stable index, but even its returns are driven by tail events. A tiny fraction of the companies within the index, the Amazons, the Apples, the Microsofts, are responsible for a disproportionately large share of the index's total growth. Rowling wrote the Harry Potter series, which has sold over 600 million copies and become a multi-billion-dollar franchise. while she has written other books. The success of Harry Potter is the tail event that defines her entire career. Its success is so monumental that it outweighs everything else she has done or ever will do combined. Consider a musician. An artist might release 10 albums over their career. 9 of them might be moderately successful, appreciated by a core fan base. But one album might contain a global hit, a song that is played at every wedding, every party, for decades. That one song, that tail event, generates more fame, more royalties, and more opportunities than the other 9 albums put together. This applies to our own careers. You might work on 100 different projects over 20 years. 95 of them might be competent, satisfactory, and quickly forgotten. But a few, maybe just 1 or 2, will be breakthroughs. A single project might get you noticed by senior leadership, lead to a major promotion, or open up an entirely new career path. Your entire professional trajectory can be altered by a handful of key moments, decisions, or accomplishments. Everything else is the foundation. But the tails are what build the skyscraper. So, what is the central lesson Housel wants us to take from this? It is a powerful reframing of failure and success. The takeaway is this: it's okay to be wrong. It's okay to have a portfolio with losing stocks. It's okay to have projects at work that don't pan out. It's okay to try things that fail. Mediocrity and failure are the normal, default states for most things we attempt. What is not okay is to be so afraid of these small losses that you miss the opportunity for a massive, life-changing win. The person who diversifies and stays invested through market downturns will eventually capture the tail returns of the market. The creator who keeps producing work, even after facing rejection, increases their odds of landing that one huge success. The professional who keeps taking on challenges, even if some don't succeed, positions themselves for that one career-defining project. Success, therefore, is not about the frequency of your wins. It is about the magnitude of your wins when you are right. It's about enduring the many small paper cuts of failure in order to be in a position to catch the lightning bolt of a tail event. Nothing is as good or as bad as it seems. Because the long tail of a few events drives the majority of the outcomes. Recognize this. Embrace it. And you'll understand that the path to winning is paved with a lot of unremarkable steps and a few truly giant leaps. Welcome to our exploration of Chapter 13 of The Psychology of Money, where Morgan Housel uses one of the most beloved companies in the world to illustrate a powerful financial concept: tail events. The company is Disney, and its story is not one of constant, steady success, but of surviving long periods of failure punctuated by a few moments of extraordinary, world-changing triumph. When we think of Disney today, we see a global entertainment behemoth, a colossal empire of movies, theme parks, streaming services, and merchandise. It feels invincible, a story of uninterrupted victory. But the truth, especially in its early days, was far more precarious. Walt Disney was a visionary, but he was also a man perpetually on the brink of financial ruin. In the 1,920 seconds and 30 seconds, the Walt Disney Studio was a small, scrappy operation fueled by relentless ambition and mountains of debt. Walt and his brother Roy were constantly borrowing money to keep the lights on. They lost their first major character, Oswald the Lucky Rabbit, in a brutal business deal. Their early Mickey Mouse and Silly Symphony shorts were popular, but they were not massive moneymakers. They were just enough to keep the studio afloat, lurching from one payroll to the next. By the mid-1930 seconds, Walt had a truly audacious idea, one that everyone in Hollywood considered insane. He wanted to create a feature-length animated film. No one had ever done it before. The conventional wisdom was that audiences would never sit through 90 minutes of a cartoon. They believed the bright colors would strain people's eyes, and the novelty would wear off in 10 minutes. Hollywood insiders mockingly dubbed the project Disney's Folly. Even Walt's wife, Lillian, and his brother, Roy, tried to talk him out of it. It was too big a risk. The film was Snow White and the Seven Dwarfs, and its production became a legendary gamble. The budget ballooned from an initial estimate of $250,000 to an astronomical $1.5 million, an almost unthinkable sum during the Great Depression. To finance it, Walt had to mortgage his house and repeatedly plead with bankers from Bank of America, showing them rough footage to convince them to extend more credit. The studio's entire existence was wagered on this single film. If Snow White failed, the Walt Disney Studio would cease to exist. There was no plan B. This is the critical moment. The fate of everything Walt had built rested on one project that the entire industry believed was destined to fail. But then, the premiere happened in December 1937. The star-studded audience, initially skeptical, was captivated. They laughed. They cried. They gave it a thunderous standing ovation. Snow White wasn't just a success. It was a phenomenon. It became the highest-grossing film of its time, earning over $8 million in its initial run, more than 5 times its production cost. This is a perfect example of a tail event. In statistics, the tails of a distribution curve represent the extremely rare, low-probability outcomes. A tail event is something that is highly unlikely to happen, but has a massive, game-changing impact when it does. For Disney, Snow White was a positive tail event of epic proportions. The profits from that one film single-handedly transformed the company. It paid off all their debts. It funded the construction of their state-of-the-art studio in Burbank, which is still their headquarters today. It provided the capital for their next slate of ambitious films, Pinocchio, Fantasia, and Dumbo. Without the monumental success of Snow White, none of that would have been possible. The decades of small wins and near failures were completely overshadowed by one colossal victory. Housel points out that this pattern didn't stop in the 1,930 seconds. It is the fundamental business model of Disney. Even today, think about the hundreds of movies and TV shows Disney produces. Many are modest hits. Some are respectable performers, and a significant number are outright flops that lose money, but the entire enterprise is carried by their modern-day Snow Whites. The acquisition of Pixar, for example, brought a string of tail event successes like Toy Story and Finding Nemo. The purchase of Marvel Studios was an even bigger gamble that paid off spectacularly. Iron Man was a risk, starring a supposedly washed-up actor in Robert Downey Jr. and featuring a B-list superhero. Its success kicked off the Marvel Cinematic Universe, arguably the single most successful tail event in entertainment history, generating tens of billions of dollars. Similarly, the acquisition of Lucasfilm and the Star Wars franchise provided another engine for generating massive, outsized returns. These gigantic successes, the tail events, provide the financial cushion and the funding for hundreds of other projects, from Disney Plus series to theme park expansions to smaller, riskier animated films. The failures don't sink the company because the successes are so astronomically large that they more than compensate for all the losses. The lesson Housel draws for our own financial lives is profound. You don't need to make 100 correct decisions. You don't need every stock you pick to be a winner. In fact, you can be wrong most of the time and still end up incredibly wealthy. This is the core of the venture capital model. They invest in dozens of startups, fully expecting the vast majority to fail. They know that 90% of their portfolio could go to zero. But if just one or two of those companies become the next Google or Amazon, the returns from those single wins will pay for all the failures and produce enormous profits. In our own investing, the same principle applies. A diversified portfolio of stocks might see many companies plod along or even fail over the years, but the one or two that experience exponential growth, the tail event winners, can be responsible for the majority of the portfolio's total returns. The key is not to be right all the time, but to be positioned in a way that allows you to capture the upside when you are very times right. It means having the patience and endurance to stick with your investments through periods of mediocrity and doubt, giving the tail events time to emerge. The story of Walt Disney is the ultimate proof. His legacy wasn't built on a foundation of consistent, predictable wins. It was built on a foundation of near-constant risk and frequent failure, saved and propelled into greatness by a handful of audacious bets that paid off on a scale no one could have ever predicted. In our modern narrative of wealth, we are often sold a very specific picture. It's a picture of luxury cars, sprawling mansions, exotic vacations, and designer clothes. We equate a high net worth with a high consumption lifestyle. But what if this picture is a carefully crafted illusion? What if the greatest, most valuable thing that money can buy isn't an object at all? Morgan Housel, in Chapter 14 of The Psychology of Money, argues precisely this. He posits that the ultimate goal, the highest form of wealth, isn't the ability to buy more stuff, but the ability to control your own time. True wealth, he proposes, is the ability to wake up every single morning and say, I can do whatever I want today. This isn't about laziness or a life devoid of work. It's about agency. It's about having the unwavering, unconditional freedom to choose your activities, your schedule, and your companions. It is the ultimate dividend that money can pay. To truly grasp this concept, let's paint a picture of two different individuals. First, imagine a highly successful investment banker. He earns a 7-figure salary, lives in a penthouse apartment overlooking the city, and drives a car that costs more than most people's homes. By every conventional metric, he is fabulously wealthy. But let's look closer at his life. His alarm rings at 4:30 a.m. He's in the office before sunrise, tethered to his desk by the demands of the market and his superiors. His calendar is a relentless series of meetings, calls, and deadlines, scheduled months in advance and completely outside of his control. A vacation means being glued to his phone in a different time zone. A sick day is a myth. He eats most of his meals at his desk. He rarely sees his family during waking hours. He has an immense income, but he has zero control over his time. He is a slave to his own success, living in a gilded cage. Now, consider a different person. Let's call her Sarah. Sarah is a graphic designer who, over a decade, has diligently saved and invested a significant portion of her income. She doesn't have a penthouse, but she owns a modest, comfortable home. She doesn't drive a luxury sports car, but her reliable car is paid off. Her net worth is a fraction of the banker's. However, she has reached a point where her investment income covers her basic living expenses. She has achieved what some call financial independence. What does her day look like? She wakes up without an alarm clock. She might spend the morning reading, working on a passion project, or going for a long hike. She still takes on freelance design projects, but only the ones that truly excite her, and with clients she enjoys working with. If a friend calls to suggest a spontaneous trip, she can go. If her parent gets sick, she can drop everything to be by their side without asking for permission. She has complete, sovereign control over her 24 hours. Who is truly wealthier, the banker with the high salary and no time, or Sarah with the modest lifestyle and complete freedom? Housel argues compellingly that Sarah is the one living the richer life. The ability to do what you want, when you want, with whom you want, for as long as you want, is priceless. It is the highest dividend money can pay. The psychological bedrock for this idea is powerful and well documented. For decades, psychologists have studied the correlation between wealth and happiness. While it's true that moving from poverty to a stable middle-class income dramatically increases well-being, the happiness benefits of more money diminish rapidly after our basic needs are met. What doesn't diminish, however, is the profound impact of autonomy. Angus Campbell, a psychologist at the University of Michigan, conducted extensive research on happiness. His findings, summarized in his 1981 book, The Sense of Well-Being in America, were groundbreaking. He found that having a strong sense of controlling one's own life is a more dependable predictor of positive feelings of well-being than any of the objective conditions of life we so often associate with happiness, like income, geography, or education. More than your salary, more than the size of your house, more than the prestige of your job. Control over doing what you want, when you want, with the people you want, is the broadest lifestyle variable that makes people happy. Think about the opposite of control being micromanaged at work. Being stuck in a traffic jam? Being forced to attend a meeting you know is a waste of time. These situations don't just feel inefficient, they feel deeply, psychologically draining because they strip us of our autonomy. Money's greatest potential is to serve as an antidote to this feeling. It can buy you a buffer. It provides a cushion that allows you to wait for a good job opportunity rather than grabbing the first one out of desperation. It gives you the power to walk away from a toxic work environment. It provides the freedom to handle an unexpected medical emergency without the added stress of financial ruin. It allows you to take time off to learn a new skill, spend time with your newborn child, or simply take a breath when life becomes overwhelming. This is a fundamental reframing of our financial goals. We are taught to chase specific numbers: $1 million net worth, a six-figure salary, a certain amount in our retirement account. These are not bad goals, but they are incomplete. They represent the what without the why. The real goal should be to use money to gain increasing levels of freedom and independence along the way. Instead of viewing savings as simply a down payment on a future purchase, see it as a down payment on future freedom. Every dollar you save is a piece of your future time that you are buying back from a potential employer. A small emergency fund gives you the freedom from the anxiety of an unexpected car repair bill. 6 months of living expenses saved gives you the freedom to tell your boss no or to leave a job that is destroying your mental health. A larger nest egg gives you the freedom to change careers, start a business, or work part-time on your own terms. The goal doesn't have to be a full, early retirement where you never earn another dollar. For many, that's not even desirable. The goal is to reach a point where you work because you want to, not because you have to. It's the ability to choose your projects, to say no to things that don't align with your values, and to structure your work life in a way that complements rather than consumes your existence. This is the ultimate form of wealth. So, how do we begin to apply this? Start by redefining your financial ambition. Shift your focus from what your money can buy to how many options it can create. When you're considering a lifestyle upgrade, a bigger house, a more expensive car, ask yourself a critical question. Will this purchase increase my freedom? Or will it constrain it? Often, the large mortgage and the high car payment that accompany these status symbols do the opposite of providing freedom. They chain you to a high-stress job for decades to service the debt. They become anchors, not wings. True wealth is having the option to take a lower-paying job with more flexible hours. It's the ability to retire a few years earlier, to spend time with your grandchildren. It's having enough FU money to be able to walk away from any situation that compromises your integrity or well-being. In the end, the highest form of wealth is not about flaunting what you have. It's about not needing to. It's the quiet confidence that comes from knowing you have control over your most precious, non-renewable asset, your time. That is the real prize. That is freedom. In the grand theater of our minds, the word wealth often conjures images of extravagance, sprawling mansions, gleaming sports cars, and vacations on private yachts. We're conditioned to see money as a tool for acquiring more things, bigger things, better things. But Morgan Housel, in Chapter 15 of The Psychology of Money, invites us to pull back the curtain on this flashy spectacle and examine what money's greatest, yet most understated, power truly is. It's not the ability to buy luxury goods, it's the ability to buy control. Specifically, control over your time. This, Housel argues, is the highest dividend money pays. It's the unseen, unfelt asset that contributes more to our happiness than any tangible possession ever could. Let's break down what this freedom, this control, actually looks like in the quiet, ordinary moments of our lives. First, consider the profound luxury of waking up one morning feeling unwell. Not terribly ill, just off. Your head is foggy. Your body aches. And the thought of facing a demanding workday feels insurmountable. For a vast number of people, this scenario triggers a cascade of financial anxiety. They can't afford to miss a day's pay. They worry about falling behind on projects, about appearing unreliable to their boss. The physical discomfort is compounded by a heavy layer of mental stress. Their body is telling them to rest, but their bank account is screaming at them to get up and go. Now, imagine a different reality. One where you have a financial buffer. You wake up with that same foggy head and aching body. But the immediate emotional reaction is different. Instead of panic, there is acceptance. You can simply decide, I am not well enough to work today. I need to rest and recover. You send a simple email to your team. Turn off your alarm and allow your body the recuperation it needs without a single thought about the financial consequences. This isn't about laziness. It's about autonomy. It's the wealth of being able to listen to your own body. That single, stress-free sick day is a form of return on investment that no stock market can quantify. It is a quiet, personal freedom that is worth more than any designer watch. Next, let's explore the freedom to choose your work based on meaning rather than necessity. So many of us end up on career paths dictated by salary expectations. We take the job that pays the most, even if it stifles our creativity, contradicts our values, or slowly erodes our mental health. We become prisoners of a golden handcuff, enduring stressful commute, toxic environments, and unfulfilling tasks, all in service of a paycheck that funds a lifestyle we barely have time to enjoy. Financial security fundamentally alters this equation. When you have savings, when you aren't living paycheck to paycheck, the power dynamic shifts. You are no longer forced to say yes to the highest bidder. You gain the extraordinary ability to prioritize purpose over profit. You can afford to take a lower-paying job at a nonprofit you believe in. You can start your own small business centered around a passion, knowing you have a cushion to survive the initial lean years. You can choose a job with more flexibility and fewer hours, even if it means less income, because you value time with your family more than a larger house. This is the freedom to align your daily life with your deepest values. Money, in this context, becomes a tool that buys you a reason to wake up excited on a Monday morning. It purchases fulfillment, a commodity far scarcer and more valuable than any luxury item. Finally, consider the unshakable security of facing an emergency without facing financial ruin. Life is unpredictable. A sudden health crisis, an unexpected car accident, or an urgent family matter can strike at any moment. For those without a financial safety net, such an event is a dual crisis. There is the emotional trauma of the event itself, and then there is the immediate, crushing weight of its cost. How will we pay for the hospital bills? How will we afford the car repair while still paying rent? The stress can be devastating, straining relationships and making a difficult situation feel impossible. This is where the true protective power of money reveals itself. Having an emergency fund doesn't prevent the crisis from happening, but it insulates you from its financial shockwave. When a loved one is rushed to the hospital, your first and only thought can be, are they okay? Not, how will we afford this when your car breaks down? The problem is an inconvenience, not a catastrophe that threatens your ability to get to work and pay your bills. This financial security is a buffer against life's harshest blows. It is the peace of mind that allows you to focus your energy on what truly matters: health, safety, and the well-being of your family during the most challenging of times. In conclusion, all of these examples, the stress-free sick day, the meaningful career, the secure response to an emergency, all point to one central truth. The greatest intrinsic value of money is its ability to grant you control over your time. It gives you a wider range of options and allows you to make decisions from a place of empowerment, not desperation. The ability to wake up and say, I can do whatever I want today, is the ultimate expression of wealth. This doesn't mean a life of perpetual leisure. It means having the agency to design a life that is truly your own, to spend time with people you love, to work on projects that inspire you, and to have the space to rest and think when you need it. The cars, the houses, the luxuries, they are the loud, visible symbols of wealth, but the true prize is the quiet, invisible freedom to live life on your own terms. That is what your money really buys you. Welcome to our exploration of Morgan Housel's The Psychology of Money. Today, we delve into one of the most subtly powerful chapters, Chapter 16, The Man in the Car Paradox. It's a chapter that dissects a fundamental, yet often unnoticed, flaw in our pursuit of wealth and the things it can buy. Picture this: a sleek, gleaming Ferrari, a vibrant red blur of engineering and opulence, pulls up beside you at a traffic light. The engine hums with a deep, throaty promise of power. What's your first thought? Many of us might think, wow, what a car. We might feel a pang of envy, or a surge of admiration. We might imagine what it would feel like to be behind the wheel, to command that kind of machine. And here lies the paradox that Housel so brilliantly illuminates. When you see that car, you are not thinking, "Wow, the driver of that car is so cool, successful, and admirable." Instead, your internal monologue is almost always, "Wow, if I had that car, people would think I'm cool, successful, and admirable." The person in the car, the very individual who spent a fortune to acquire this symbol of status, is ironically rendered invisible. They become a mere placeholder for our own fantasies of being respected and admired. The admiration we feel is directed at the object, the car itself, and we immediately project ourselves into the driver's seat. We use their possession as a benchmark for our own desires, not as a reason to admire them as a person. Housel confesses that as a young man working as a valet at a luxury hotel, he saw this firsthand. He dreamed of owning the fancy cars he parked, believing that if he did, he would receive the admiration he saw passers-by give the vehicles. It took him years to realize the profound truth: nobody was looking at the drivers. They were looking at the cars, imagining their own lives enriched by such a possession. This is the man in the car paradox. It's the psychological miscalculation we make when we believe that spending money on expensive things will bring us the respect and admiration of others. We think we're buying a ticket to be seen, but we're actually just buying a mirror for other people's aspirations. This flawed logic traps us in what becomes an invisible and deeply unsatisfying chase for external validation. It's an invisible chase because the goal we're pursuing, the genuine admiration of others for who we are, can never be captured by what we own. We buy the expensive watch, the designer handbag, the sprawling house, expecting a wave of recognition and respect to follow, and for a fleeting moment, it might seem to work. People might comment on your new watch. They might compliment your home, but their admiration is shallow and ephemeral. And as we've established, it's mostly directed at the stuff. They're not admiring your character, your intellect, or your kindness. They are admiring a physical object. The chase is unsatisfying because this type of validation doesn't nourish our sense of self-worth. It's like trying to quench a deep thirst with salt water. The more you drink, the thirstier you become. You get the car, but the feeling of being admired is elusive. So, you reason that maybe the car wasn't expensive enough. Maybe you need the next model up, or perhaps a boat, or a private jet. The goalposts of enough are constantly shifting because the validation we receive is for the possession, not the person. And as soon as a new, more impressive possession appears on the horizon, the cycle begins anew. This creates a hamster wheel of consumption, fueled by the mistaken belief that the next big purchase will finally deliver the lasting respect we crave. The truth is, people are overwhelmingly preoccupied with their own lives. When they see your success, they are more likely to use it as a benchmark against which to measure their own, rather than stopping to applaud yours. This brings us to a crucial distinction: the difference between being admired for your possessions and being admired for who you are. Think about the people you truly respect in your own life. The people whose opinions you value, whose company you seek. Do you admire them for the brand of their shoes or the size of their house, or do you admire them for their kindness in a moment of need, their humor that can light up a room, their wisdom that has guided you through a difficult decision, their humility, despite their own successes? True, lasting respect is almost always built on these intangible qualities: kindness, humility, Empathy, generosity, and integrity are the currencies of genuine human connection. You can't buy them. You must earn them through your actions. Day after day. A fancy car might signal that you have money, but it tells no one that you are a good person. A luxury watch might signal that you have taste, but it says nothing about your ability to be a loyal friend or a loving partner. We often confuse the signal for the substance. We see wealth as a proxy for all the things we want to be liked. Respected, loved, but it's a poor substitute. People want to be wealthy to signal to others that they should be liked and admired. But what they often fail to realize is that people who are truly admired are rarely so because of their material possessions. Housel puts it perfectly: if you want respect and admiration, you are more likely to get it through kindness and humility than you are through horsepower and chrome. This leads us to the ultimate takeaway from the man in the car paradox. A simple yet profound truth that can liberate you from the endless chase for validation. No one is as impressed with your stuff as you are. You might be acutely aware of every detail of your new luxury sedan, the hand-stitched leather, the polished wood grain, the advanced sound system. You feel the weight of your expensive watch on your wrist and see the glint of its sapphire crystal. You are immersed in the experience of your possessions. But to the rest of the world, you are just a fleeting image. A person in a car, a wrist with a watch. They are not thinking about you. They are thinking about themselves. Understanding this isn't about shunning nice things or embracing a life of extreme minimalism. There is nothing wrong with enjoying the fruits of your labor. The crucial insight is to understand your motivations. Are you buying something because you genuinely appreciate its craftsmanship, utility, or beauty? Or are you buying it primarily as a tool to broadcast a message to the world about your success, hoping for a return in the form of admiration? If it's the latter, you are likely setting yourself up for disappointment. The real value of money, the true goal of building wealth, isn't to buy things to impress people who don't care. It's to gain control over your own life. It's to buy freedom. Freedom from a job you hate, freedom to spend more time with your loved ones, freedom to pursue your passions, freedom from worry and anxiety about the future. When you stop trying to use your money to signal how much you have, you can start using it to live the life you truly want. The most valuable assets you can accumulate: strong relationships, a good reputation, and peace of mind cannot be bought. This leads us to the ultimate takeaway from the man in the car paradox. A simple yet profound truth that can liberate you from the endless chase for validation. No one is as impressed with your stuff as you are. You might be acutely aware of every detail of your new luxury sedan, the hand-stitched leather, the polished wood grain, the advanced sound system. You feel the weight of your expensive watch on your wrist and see the glint of its sapphire crystal. This paradox serves as the perfect entry point into Chapter 17, where Morgan Housel delves deeper into the futility of trying to impress people we don't know, and reveals where true, lasting wealth actually lies. The core argument of this chapter is profound yet simple. The things that genuinely make life rich: humility, kindness, and empathy are currencies that cannot be minted or spent on luxury goods. They are earned, and their value compounds in ways a stock portfolio never could. Let's begin by dissecting the motivation behind so much of our luxury spending. Why does a person buy a $100,000 car when a $30,000 one serves the exact same functional purpose? Why the designer handbag or the extravagant watch? The surface-level answer is quality or craftsmanship. But the psychological driver is almost always signaling we are sending a message to the world, a message that says, I am successful, I am important. I am worthy of respect. But who is the intended recipient of this message? Housel argues that, more often than not, it's a faceless crowd of strangers. The person next to us at a stoplight, the people we pass on the street, the anonymous followers on social media. We are spending tangible, hard-earned money in pursuit of the intangible, fleeting admiration of people whose opinions hold no real weight in our lives. The irony, as the man in the car paradox reveals, is that the signal is rarely received as intended. They don't see times you times and think, wow, what an accomplished individual. They see the times, car times, and think, wow, if I had that car, people would think I'm an accomplished individual. You, the owner, become an invisible vessel for their own aspirations. Your expensive purchase has done little more than provide a momentary daydream for a stranger. This dynamic creates a dangerous and exhausting cycle. The respect you seek through possessions is the quietest, most ephemeral kind of respect. It evaporates the moment the car turns a corner because it provides no lasting satisfaction. The hunger for it is never sated. This compels us to climb onto a hedonic treadmill, requiring ever larger displays of wealth to achieve the same fleeting buzz of perceived admiration. Now, let's contrast this hollow pursuit with the deep, abiding satisfaction that comes from genuine human connection. Think about the most meaningful moments in your life. Were they moments of consumption or moments of connection, the laughter shared with a close friend, the comfort of a partner's support during a difficult time, the sense of belonging within a community? These are the pillars of a happy life. No luxury good can replicate the feeling of being truly seen, understood, and valued by another human being. A flashy car might attract attention, but it rarely attracts genuine friendship. A large house might signal status, but it doesn't guarantee a home filled with love and warmth. The wealth that comes from strong relationships is a form of wealth that appreciates over time, unlike a car that loses value the second it leaves the dealership. The bonds of trust and mutual respect you build with people grow stronger and more valuable with each passing year. This leads us to the chapter's most powerful argument. True respect is earned through character, not consumption. The admiration we crave cannot be bought. It must be earned through our actions. People may notice your watch, but they will remember your kindness. They might be momentarily impressed by your house, but they will be permanently impacted by your integrity. Humility is far more magnetic than hubris. When you have wealth but don't feel the need to flaunt it, you signal a quiet confidence that is far more impressive than any logo. Empathy, the ability to understand and share the feelings of another, is a superpower in building relationships. It's the currency that buys trust and loyalty, assets that are priceless. Kindness costs nothing, yet its returns are infinite. These qualities, humility, empathy, kindness, are what make people want to be around you. They are what make you a good partner, a loyal friend, a respected colleague, and a valued member of a community. The respect generated by these character traits is deep, resilient, and enduring. It's not dependent on your net worth or the brand of your suit. It is respect for times who you are asterisk, not times what you have asterisk. So, what is the alternative? Housel proposes a radical mindset shift. Instead of using money to acquire things to signal your worth to others, use money to buy back your own life. Use it to gain freedom. This is the ultimate, and perhaps only, logical purpose of building wealth. What is freedom in this context? It's not about being able to buy anything you want. It is control over your time. It is waking up in the morning, and having the autonomy to say, I can do whatever I want today. It's the ability to walk away from a job you despise without fearing financial ruin. It's the freedom to take a lower-paying job that you find more meaningful. It's the capacity to handle unexpected emergencies, a medical issue, a car repair, without spiraling into debt and anxiety. It's the option to spend more time with your children, care for an aging parent, or pursue a passion that doesn't pay the bills. This freedom, this control over your own schedule and life choices, is an invisible asset. No one on the street can see that you have 6 months of living expenses saved up. But this invisible wealth provides a daily dividend of peace and well-being that no visible luxury item can ever hope to match. It's the wealth that lets you sleep at night. It's the wealth that allows you to design a life that is truly your own, not one designed to impress an audience of strangers. In conclusion, Chapter 17 is a powerful reminder that we often play the wrong game with our money. We spend it on expensive liabilities in a futile attempt to gain the admiration of people we don't know. A goal that is both psychologically exhausting and financially counterproductive. The real goal should be to use money as a tool to engineer a life of freedom and autonomy. The greatest dividend that money pays is the ability to control your time by focusing on building invisible wealth savings, investments, and flexibility rather than visible status symbols. We can achieve something far more valuable than the fleeting envy of strangers. We can achieve true contentment. The highest form of wealth isn't the ability to buy a Ferrari. It's the ability to live your life without needing to signal to anyone that you can. Welcome to our exploration of Morgan Housel's The Psychology of Money. Today, we delve into one of its most profound chapters. Chapter 18, Wealth is What You Don't See. Picture this: a gleaming, fire engine red Ferrari pulls up to a stoplight. The engine hums with power. The driver, wearing expensive sunglasses, looks effortlessly cool. What is the first thought that enters your mind? For most of us, it's some variation of, wow, that person must be wealthy. We see the car, $100,000 symbol of success, and we automatically equate it with wealth. But Morgan Housel argues this is one of the most fundamental and dangerous misunderstandings in personal finance. The person in that car is undoubtedly rich. But are they wealthy? We have no way of knowing. In fact, the very presence of the car tells us one thing with certainty. They have $100,000 less in their bank account or investment portfolio than they did before they bought it. This brings us to the core distinction of this chapter, the critical difference between being rich and being wealthy. Being rich is about your current income. It's a measure of cash flow. A high-income doctor or a successful lawyer who earns $1 million a year is rich. This richness is often visible. It manifests as expensive cars, large houses, designer clothes, and luxurious vacations. It's what we see on Instagram and in magazines. It's tangible, impressive, and easy to admire. Because it's so visible, we mistake it for the ultimate goal. Wealth, on the other hand, is what is not seen. Wealth is the income you earned but did not spend. It is the money that has been saved and invested, left to compound in silence. Wealth is the collection of financial assets in your brokerage account, your retirement fund, your real estate holdings. It's the money that you haven't converted into a flashy object. Wealth is quiet. It's hidden. Its purpose isn't to buy things, but to provide something far more valuable: options, flexibility, and freedom. The freedom to change careers, to handle an unexpected emergency, to retire when you want. to live life on your own terms. That freedom is the real dividend of wealth. This leads to a powerful, if counterintuitive, idea. Wealth is the sports car not purchased. It's the diamond necklace not bought. It's the first-class upgrade not taken. It's the watch not worn. Every time you see someone with an expensive possession, you are not seeing their wealth. You are seeing the money they no longer have. You are seeing a piece of their past wealth that they have traded for a physical item. The truly wealthy person might be driving a 10-year-old car, living in a modest house, and wearing a simple watch, all while possessing a fortune that grants them complete control over their time. Their wealth is invisible to the outside world. And that is precisely why it is so powerful. Our minds struggle with this concept. We are visual creatures. We make judgments based on what we can see. We cannot see someone's savings account balance or their investment portfolio's performance. So, we default to judging financial success by its visible proxies: the house, the car, the clothes. Housel provides a brilliant analogy to clarify this. The analogy of physical fitness. Being rich is like looking fantastic in a perfectly tailored, expensive designer suite. The suit makes you look sharp, successful, and put together. It's an immediate, visible signal of status. People see the suit and are impressed. But is the person wearing the suit actually fit? We don't know. The suit could be hiding an unhealthy lifestyle. Wealth, in this analogy, is the unseen discipline required to be genuinely fit. It's waking up at 5 a.m. to go for a run when no one is watching. It's choosing the salad over the pizza for the 1,000th time. It's the hours of grueling, unglamorous work in the gym. This process is completely invisible. The result is a strong, healthy body. But the effort is hidden. The designer suit is an act of spending. The fit body is the result of discipline and sacrifice. Similarly, visible riches are the result of spending. True wealth is the result of financial discipline, of consistently not spending the money you have. This misunderstanding has dangerous consequences, especially in how we choose our role models. We want to become wealthy, so we look for people to emulate. But who do we see? We see the rich people. We see the extravagant spenders. We see the celebrity with a private jet and think, to be wealthy, I need to have a private jet. This logic is completely backward. It's like looking at a marathon winner and focusing only on the celebratory champagne they drink at the finish line, ignoring the years of brutal training that got them there. When we model the behavior of the rich, we are modeling their spending, which is the very act that depletes wealth. We are trying to build wealth by copying the one activity that destroys it. The true role models for wealth are often completely invisible. They are the everyday millionaires who live unassuming lives. They are the engineers, the teachers, the plumbers who diligently saved and invested a portion of their income for decades. They don't make headlines. They aren't on social media showcasing their assets. They are hidden, quietly building a life of freedom and security. So, how do you build wealth? The answer is deceptively simple. And it brings us to the final, crucial point. The only way to build wealth is to not spend the money you have. It doesn't matter if you earn $100,000 or $10 million a year. If you spend it all, you are not building wealth. You might be living a rich life, but you are financially fragile. Wealth creation is not an addition problem. It's a subtraction problem. It is the gap between your income and your ego. It is what's left after you've paid for your lifestyle. The single most important factor in building wealth is your savings rate. And your savings rate is nothing more than the portion of your income you choose not to spend. You can build a fortune without a high income. But you have no chance of building a fortune without a high savings rate. This is the simple, unchangeable law of wealth. In conclusion, true wealth is not about what you can buy. It's about having unspent assets that provide you with options and control over your life. It is the financial security that allows you to sleep at night. It's the freedom to wake up one day and decide to do something completely different with your life. This wealth is, by its very nature, hidden. The next time you see an extravagant display of spending, resist the urge to admire or envy. Instead, remember what you're actually seeing: the absence of wealth. The real power, the true fortune, is the massive, unseen foundation that lies beneath the surface, built one unspent dollar at a time. In Chapter 19, Morgan Housel introduces a mental model so simple, yet so profound, that it has the power to permanently alter how you view money, success, and the very nature of financial well-being. He calls it the Iceberg of Wealth. We live in a world that operates on visible cues. As human beings, we are conditioned to trust our eyes, to make rapid assessments based on the evidence presented directly to us. We see a person living in a magnificent home in an affluent neighborhood, and our minds leap to a conclusion: they are wealthy. We see a colleague sporting a luxury watch worth more than a used car, and we immediately categorize them as financially successful. This is a natural, almost unavoidable, cognitive shortcut. But when it comes to money, this shortcut leads us down a dangerously misleading path. Housel brilliantly argues that our reliance on visible signals creates a massive blind spot. We equate spending with wealth because spending is loud, tangible, and easy to see. True wealth, however, is often the opposite: quiet, intangible, and hidden from view. To illustrate this, picture a colossal iceberg adrift in the vast, deep blue ocean. What first captures your attention is the part above the waterline. It might be jagged and impressive, sparkling in the sunlight. This small, visible peak represents maybe 10% of the iceberg's total mass. This, Housel says, is the part of finance that everyone focuses on. Let's label this glistening tip: what people see: cars, houses, vacations, possessions. This is the grand theater of wealth. It is the tangible evidence of consumption. It's the roar of a V12 engine in a Lamborghini, the square footage of a mansion, the exotic passport stamps, the social media posts from Michelin star restaurants. It is every material, good, and lavish experience that people use to signal their status to the world. And because it is the only part we can see, society has mistakenly defined it as the entirety of wealth. We admire it, we desire it, and we are relentlessly encouraged by marketing and culture to pursue it, often at any cost. But the real story, the source of the iceberg's immense power and stability, lies concealed beneath the waves. Submerged in the quiet darkness is the other 90% of its mass, a monumental foundation of ice, invisible to any casual observer on the surface. This is the true substance. Let's label this immense, hidden portion what wealth actually is: savings, investments, financial assets. This is not a flashy purchase. It is the absence times of a flashy purchase. It is the money that was earned but not spent. It is the portfolio of low-cost index funds and ETFs steadily and silently compounding. It is the ownership stake in profitable businesses. It is the rental properties generating a monthly stream of income. It is the cash reserves sitting in a high-yield account, providing security and opportunity. It is the sum of every dollar that has been put to work to generate more dollars rather than being converted into a depreciating consumer good. This unseen mass is the engine of financial freedom. It is the quiet discipline of saving, the patient wisdom of investing, and the crucial gap between what you earn and what your ego desires to spend. Our modern world is almost entirely fixated on the tip of the iceberg. The entire industry of advertising is built on glorifying consumption. Social media platforms like Instagram have become highlight reels of spending, creating a distorted reality where it seems everyone is living an extravagant life. We scroll through feeds of people's best moments, which are almost always their most expensive moments. This creates an enormous social pressure to keep up. But what are we keeping up with? We are keeping up with other people's spending, not their wealth. Housel uses a critical distinction: rich versus wealthy. A high-income earner, like a doctor or lawyer, can be rich in the sense that they have a large cash flow. They can afford to finance a $150,000 car and a multi-million-dollar home. They look incredibly successful. But if their spending keeps pace with or exceeds their income, they are merely rich. They have a fantastic-looking iceberg tip, but the base underneath is small, fragile, or even non-existent, propped up entirely by debt. They are one job loss, one market downturn, one personal crisis away from total collapse. Now consider someone who is wealthy. This person might earn a good income, but they live modestly. They drive a reliable but unremarkable car. Their house is comfortable but not ostentatious. From the outside, their iceberg tip looks small, perhaps even disappointingly so, but beneath the surface, they have built a colossal foundation of investments. They have prioritized saving and compounding over signaling and spending. Their wealth is not visible. It is silent. It is secure. This person has what the rich person lacks: autonomy. They have options. Their hidden wealth gives them control over their time. The ultimate dividend that money can pay. The most crucial takeaway from Housel's iceberg is a simple but revolutionary idea. Wealth is created by suppressing your desire to spend money, to show people how much money you have. It is an act of deliberate invisibility. Building wealth is not a sprint filled with glamorous, headline-grabbing events. It is a marathon of quiet, unseen, and often mundane discipline. It is the unexciting, automatic deduction from your paycheck that goes into a 401k or an IRA every single month. For decades, it is the decision to cook at home instead of dining out. It is the discipline to ignore the hot stock tip from a friend and stick with your long-term, diversified strategy. It is the patience to let compound interest work its silent, magical mathematics over many years. Each of these individual acts is like adding a single snowflake to the base of the iceberg. Alone, it is insignificant, but compounded over time, these millions of unseen snowflakes build an unstoppable financial force. The ultimate goal isn't to have the biggest, flashiest tip that everyone can admire. The goal is to build the largest, most resilient base, because that hidden mass represents more than just money. It represents security in the face of uncertainty. It represents the ability to walk away from a job you hate. It represents the power to help others, to fund your children's education without debt, and to retire with dignity and peace. It is the freedom to design your own life, a freedom that is purchased with money that is earned but never seen. In the grand, chaotic theater of finance, what is the one lever you, and only you, can truly pull? Is it predicting the next bull market? Is it identifying the next revolutionary stock before anyone else? Is it navigating the labyrinth of global economic policy? Morgan Housel, in Chapter 20 of The Psychology of Money, delivers a stark and liberating truth. You have almost no control over any of those things. The most powerful, predictable, and impactful financial tool at your disposal is not your investment acumen or your high-powered career. It's your savings rate, the one thing that is entirely yours to command. We are conditioned to focus on the external. We spend countless hours and a significant amount of mental energy trying to decipher the market's next move. We read analyst reports. We follow economic forecasts. We listen to gurus on television, all in a frantic attempt to gain a microscopic edge. We chase promotions and higher salaries, believing that a bigger paycheck is the golden ticket. But these are games played on a field where we don't set the rules. A brilliant investment strategy can be obliterated by a sudden recession. A promising career can be derailed by industry disruption or a change in management. These external forces are powerful, fickle, and utterly indifferent to your well-laid plans. They operate on a plane of complexity that is simply beyond any single individual's control. Your savings rate, however, is a different universe. It's an internal decision. It's a personal declaration of your financial priorities, made every single day. With every dollar you earn, it's not dictated by the Federal Reserve. It doesn't care about inflation reports. And it's immune to stock market volatility. It is the simple, quiet space between what you earn and what you choose to spend. And within that space lies a degree of personal power and control that most people tragically overlook. Housel makes a bold claim. Building wealth has less to do with your income or investment returns, and nearly everything to do with your savings rate. This feels heretical in a world obsessed with six-figure salaries and 10-bagger stocks, but the logic is undeniable, especially in the early stages of wealth accumulation. Let's paint a clearer picture. Meet Alex and Ben. Alex is a high flyer, earning $150,000 a year. Impressive, right? But Alex lives a life to match, saving just 10% of that income, which amounts to $15,000 per year. Ben, on the other hand, earns a more modest $60. Ling, ling, ling. However, Ben is disciplined and has structured his life to save an incredible 40% of his income, putting away $24,000 a year. Despite earning less than half of what Alex makes, Ben is building wealth over 50% faster. The raw horsepower of his savings is lapping Alex's financial progress. Now, let's add investments to the mix. Let's say Alex, with his higher risk tolerance, achieves a spectacular 10% annual return. Ben, more cautious, settles for a 6% return. At the end of year one, Alex has his $15,000 savings, plus $1, 500 inches returns, totaling $16. Woo-bye. Ben has his $24 savings, plus $1, 440 inches returns, totaling $25. 440. Even with a dramatically lower return, Ben is significantly ahead. Why? Because, in the beginning, the absolute amount you save the base is far more important than the percentage return you get on it. A huge return on a small base is still small. A modest return on a large base starts to build serious momentum. Your savings rate builds the engine. Investment returns are the turbocharger you add later. Without a powerful engine, a turbocharger is just a noisy ornament. The underlying mathematics of wealth creation are brutally simple. Your wealth is the cumulative result of your income minus your expenses over time. That's it. To accelerate wealth, you must widen that gap. While increasing your income is great, it's often a slow, difficult process. Trying to consistently generate market-beating returns is even harder and fraught with risk. The most direct and reliable way to widen the gap is by controlling your spending. When you save money, you are not just accumulating capital. You are buying something far more precious: resilience. A high savings rate creates a financial cushion that is the ultimate defense against life's inevitable uncertainties. Think of it as personal insurance against fate. When the market inevitably crashes, as it always does, someone with a low savings rate might be forced to sell their stocks at the bottom to cover expenses. They lock in their losses, devastating their long-term prospects. But the person with a high savings rate, they can ride out the storm. They might even see the crash as an opportunity to buy more at a discount. They can afford to be patient precisely because their lifestyle doesn't depend on a perpetually rising market. This resilience grants you the single most important commodity in investing: staying power. The magic of compounding only works if you can remain invested for long periods. Through thick and thin, a high savings rate ensures you can stay in the game long enough for compounding to work its wonders. It protects you from your own panic and from life's emergencies. It gives you options. The option to change careers, to wait for a better job offer, to handle a medical emergency without going into debt. This optionality is a form of wealth that goes far beyond numbers on a screen. So, if the logic is this clear and the benefits this profound, why is saving so difficult for so many? Housel pins the blame on one of the most powerful human forces, the ego. He defines savings with a beautifully concise and cutting observation. Savings is the gap between your ego and your income. Much of modern spending isn't about acquiring utility. It's about broadcasting status: the luxury car, the sprawling house in the right neighborhood, the designer watch. These are not just objects. They are signals. They are a public declaration of success. They are a way to keep score in the social hierarchy. Your ego tells you that you've worked hard and you deserve these things. It whispers that your success needs to be visible to be real. Wealth, however, is what you don't see. It's the money that hasn't been spent. It's the stocks and bonds not converted into a car. It's the financial assets quietly compounding in a brokerage account, not displayed on a driveway. The greatest challenge in building wealth is taming the desire to immediately translate your income into a visible lifestyle. It's about being okay with driving a reliable used car so that you can fund your retirement account. It's about choosing a smaller house so you can achieve financial independence a decade earlier. It's the conscious decision to prioritize your own security over the opinions of others. When you learn to be happy with less, you unlock a financial superpower. You sever the link between your self-worth and your net spending. You find that a less leveraged life is a less stressful life. The goal shifts from looking rich to becoming truly wealthy in security, wealthy in freedom, and wealthy in the peace of mind that comes from knowing you are in control of your own destiny. And that journey begins not with a hot stock tip, but with a simple, conscious decision to save more of what you earn. In Chapter 21, Morgan Housel invites us to look at our savings not as a pile of money, but as an instrument of freedom. He argues that the greatest, and often hidden, the benefit of a high savings rate isn't just the ability to buy more things in the future, but the power it gives you over your time and options right now. This is the power of financial flexibility. First, consider the most immediate and visceral benefit: weathering the unexpected. Imagine two people, both skilled and hardworking, who suddenly lose their jobs. The first person lives paycheck to paycheck. The moment their income stops, panic sets in. The pressure is immense. They need to find any times job, and they need to find it fast. This desperation forces them to accept lower pay, a toxic work environment, or a role that doesn't align with their career goals. Their lack of savings has stripped them of their bargaining power and their ability to make a deliberate choice. Now, consider the second person. They have a year's worth of living expenses saved in cash. The job loss is still stressful, but it's not a catastrophe. There is no panic. They have a cushion. This cushion buys them time to grieve the old job, time to update their resume without haste, time to search for the time's opportunity. Not just the first one. They can negotiate from a position of strength. They can even take a few months off to learn a new skill or simply recharge. Their savings have transformed a crisis into a manageable transition. This isn't about being rich. It's about having the independence to control your own destiny when life throws a curveball. This power extends beyond emergencies into the realm of ambition and life changes. How many people do you know who are stuck in jobs they despise? They are competent, intelligent, but misérable. They are bound by what are often called golden handcuffs, a high salary that supports a lifestyle with no financial buffer. They can't afford to quit. Their high expenses have become a cage. Financial flexibility is the key that unlocks these handcuffs. A substantial savings account gives you the power to say no. You can walk away from a toxic boss, a soul-crushing commute, or a career path that no longer brings you fulfillment. It provides the runway to pivot. Perhaps you want to switch from finance to teaching, or from law to coding. Such transitions often involve a temporary pay cut or time off for education. Without savings, these dreams remain just dreams. With savings, they become viable plans. It gives you the courage to start a business, knowing you can support yourself during the crucial and often profitless early years. Savings, in this sense, is the seed capital for a new life. Furthermore, financial flexibility positions you to seize opportunities that others, constrained by fear and illiquidity, must let pass by. Housel emphasizes that having cash on hand, what investors call dry powder, is a formidable asset, especially during market downturns, when markets panic and asset prices plummet. The unprepared are forced to sell at the worst possible time to cover their expenses. But the person with a strong cash position sees something else entirely: a sale. They can follow Warren Buffett's timeless advice to be greedy when others are fearful. Market crashes, which are terrifying for the unprepared, become once-in-a-decade wealth-building opportunities for the financially flexible. You can buy quality investments at a massive discount, setting the stage for tremendous future growth. This ability to act when others are paralyzed is a direct result of having saved money for no specific goal other than the option to act when the time is right. Ultimately, this brings us to the most profound reframing of all. Housel urges us to stop viewing saving as a sacrifice. It's not about depriving yourself of a coffee today. It's about buying yourself something far more valuable tomorrow: freedom. You are purchasing future options. Every dollar you save is a piece of your future that you own and control. A piece that won't be dictated by a boss, a bill, or a bad turn of events. This wealth isn't measured in luxury cars or fancy vacations. It's measured in the ability to wake up in the morning and say, I can do whatever I want today. It's the freedom to change your mind, the freedom to take a risk, and the freedom to be patient in a world that is inherently uncertain and unpredictable. A high savings rate is your anchor. It is the ultimate financial superpower, granting you control over the one asset that truly matters: your life. In the world of finance, we are taught to worship at the altar of rationality. We build complex spreadsheets, analyze historical returns, and calculate standard deviations to construct the mathematically optimal portfolio. This rational approach tells us that over the long run, a portfolio heavily concentrated in stocks, perhaps even 100% stocks, will produce the highest returns. On paper, it is the perfect strategy. It's logical. It's backed by decades of data. But it has one fatal flaw. It is designed for a robot, not a human being. A human being who feels fear, panic, and regret. Imagine this: perfectly rational investor during a severe market crash, like the one in 2008 or the sudden plunge in March 2020. Their portfolio, once a symbol of logical perfection, is down 40% or more. The numbers on the screen are a sea of red. Every news headline screams of impending economic doom. The rational model says, do nothing. Stay the course. In fact, buy more. But the human brain, hardwired for survival, screams the opposite: get out. Sell everything before it goes to zero. This psychological pressure is immense, an unbearable weight. And so, the rational investor often does the most irrational thing possible. They abandon their perfect plan at the worst possible moment, selling at the bottom and locking in devastating losses. Their pursuit of mathematical optimality leads to real-world ruin. Now, let's consider a different approach: being reasonable. A reasonable investor knows themselves. They understand that while a 100% stock portfolio is theoretically best, they personally cannot stomach the terror of a 40% decline. The thought keeps them up at night. So, they choose a slightly less optimal, but more psychologically sustainable strategy, perhaps a portfolio of 70% stocks and 30% bonds. A spreadsheet would scoff at this. It would show them the lower expected returns over 30 years, but the magic of the reasonable approach reveals itself during the crash. When the market plummets 40%, their portfolio might only fall pump %. It still hurts. But it is a manageable pain. It is not the kind of soul-crushing loss that triggers a panic sale, because the pain is tolerable. They can stick to the plan. They can hold on through the storm, and might even have the courage to rebalance or add more funds. By simply not being forced into a catastrophic mistake, the reasonable investor with their suboptimal portfolio ends up far ahead of the rational investor who is shaken out of their perfect one. The analogy to diet and exercise is perfect here. What is the scientifically best diet for weight loss? It's probably something incredibly restrictive and difficult to follow. The rational choice is to eat nothing but steamed chicken and broccoli. But how long can anyone maintain that? A week, a month? The reasonable diet is one that you can stick with for a lifetime, one that is healthy most of the time, but also has room for a slice of pizza or a glass of wine. Consistency in a good plan is infinitely more powerful than perfection in a plan you can't follow. This concept extends to many financial decisions. like paying off a mortgage. A purely rational analysis would say that if your mortgage rate is 3% and you can expect to earn 8% in the stock market over the long term, you should never pay a single extra dollar to your mortgage. Every extra dollar sent to the bank is a loss of 5% in potential returns. But this ignores the profound emotional return of owning your home outright. The peace of mind that comes from knowing that no matter what happens to your job or your investments, you have a secure roof over your head, is a dividend that doesn't appear on any spreadsheet. For many, that feeling of security is worth far more than the potential extra market gains. This isn't irrational. It's the pinnacle of being reasonable. It's about optimizing for a good life, not just for a high score in a financial game. The goal is not to endure the most volatility, to squeeze out every last possible percentage point of return. The goal is to build a financial plan that gives you the highest odds of achieving your goals, and that requires a plan you can successfully stick with through good times and bad. So, strive to be reasonable, not rational. Aim to be consistently good, not occasionally perfect. Because in the long game of money, the strategy that lets you sleep soundly at night is the one that will ultimately win. In the grand theater of finance, let's imagine two protagonists, separated not by distance, but by time. Their goal is the same, to build wealth, but their methods, their philosophies, are worlds apart. This is the story of the 1,950 seconds investor versus today's spreadsheet guru. A perfect illustration of a core concept from the psychology of money. Being reasonable is often better than being strictly rational. First, meet George, our 1,950 seconds investor. George lives in a world without 24-hour financial news channels, without smartphones buzzing with stock alerts. His connection to the market is the morning newspaper and perhaps a quarterly letter from his broker. His strategy is a reflection of this simpler time. He doesn't look for complex arbitrage opportunities or try to time the market. Instead, he follows a few simple, time-tested rules. The goal is not to endure the most volatility, to squeeze out every last possible percentage point of return. The goal is to build a financial plan that gives you the highest odds of achieving your goals, and that requires a plan you can successfully stick with through good times and bad. So, strive to be reasonable, not rational. Aim to be consistently good, not occasionally perfect. What does he do next? Perhaps the most important thing of all, almost nothing. He takes his paper stock certificates, places them in a safe deposit box, and goes about his life. He focuses on his career, his family, and his community. He isn't checking stock prices daily or even monthly. He understands that businesses have good years and bad years, that economies go through cycles of boom and bust. His plan is not to outsmart these cycles, but to outlast them. He is a buy and hold investor in the truest sense. His approach isn't mathematically perfect. A rational analysis might find flaws in his lack of diversification or his indifference to valuation metrics, but his approach is profoundly reasonable. It's a strategy he can understand, believe in, and, most critically, stick with for decades without losing sleep. Now, let's fast forward 70 years and meet Sophia. Our modern spreadsheet guru, Sophia lives in the nerve center of the digital age. She's surrounded by multiple monitors, displaying a cascade of real-time data, stock tickers, bond yields, currency fluctuations, and news feeds parsed by sentiment analysis algorithms. Her tools are the weapons of modern finance: complex Excel models with Monte Carlo simulations, Python scripts for backtesting strategies, and access to high-frequency trading platforms. Sophia's approach is the epitome of rational. She aims for optimization in every decision. Her goal is to construct a portfolio that is perfectly calibrated to maximize returns for a given level of risk. She analyzes quarterly earnings reports down to the penny. She builds models that account for interest rate changes, inflation expectations, and geopolitical shifts. When the Federal Reserve Chairman speaks, her algorithms are programmed to react in microseconds. She doesn't just buy and hold, she rebalances. She hedges. She tax-loss harvests. Her strategy is a complex, dynamic machine designed to squeeze every last drop of efficiency from the market. On paper, it is a fortress of logic, devoid of emotion, and built on the foundation of pure data. So, who comes out ahead after 50 years? The intuitive answer is Sophia. Her sophistication, her access to information, and her rational models should give her an insurmountable edge. And yet, as Morgan Housel brilliantly explains, it is very often George, the reasonable 1,950 seconds investor, who ends up with more wealth. How is this possible? First, consider the brutal, unrelenting friction of costs. Sophia's active strategy generates a constant stream of expenses. Every trade incurs a commission or a bid-ask spread. Every time she sells a winning position held for less than a year, she faces higher short-term capital gains taxes. These small leaks may seem insignificant on their own, but compounded over decades, they create a massive drag on her performance. George, by rarely selling, keeps his costs to an absolute minimum. His wealth is left to grow, unburdened by the constant friction of activity. Second, and more profoundly, is the battle against behavioral errors. Sophia's greatest strength, her access to information, is also her greatest weakness. Being plugged into the market 24/7 means she is constantly exposed to a fire hose of noise, panic, and hype. Every market dip feels like a potential crash. Every rally feels like a bubble about to pop. While her algorithms are meant to be rational, the human who built them and oversees them is not. The temptation to tweak the model, to override the system during a panic, or to chase a hot trend is immense. Her complex system has more buttons to press, which means more opportunities to press the wrong one at the wrong time. George, in his blissful ignorance of the daily chaos, is immune to these temptations. By doing nothing, he avoids the catastrophic mistakes that so often stem from overreacting to short-term news. Finally, we arrive at the most powerful force in finance, the magic of uninterrupted compounding. George's strategy allows this force to work its wonders in its purest form. His shares in great companies grow, and the dividends from those shares buy more shares, which in turn produce even more dividends. It's a snowball of wealth rolling downhill, gathering mass and speed over decades. Every time Sophia sells a position to chase a new opportunity or de-risk her portfolio, she stops that snowball and has to start a new, smaller one. She has to be right twice when to sell and when to buy back in. George only has to be right once, that over the long run, the value of good businesses tends to go up. In the end, the story of George and Sophia teaches us a vital lesson. The goal of investing is not to create a perfectly rational, complex strategy that works in a spreadsheet. It is to create a simple, reasonable plan that can survive the chaos and uncertainty of the real world. Sophia's rational plan was brittle. It demanded a level of foresight and emotional control that no human possesses. George's reasonable plan was durable. Its simplicity was its strength, allowing him to adhere to it through thick and thin. As Housel concludes, what matters most is not being a financial genius, but being consistent. A reasonable plan you can stick with for a lifetime will always be more powerful than a rational one you abandon at the first sign of trouble. Welcome to our exploration of Morgan Housel's The Psychology of Money. Today, we delve into Chapter 24, titled Surprise, a chapter that serves as a powerful reminder of history's most consistent lesson, its own unpredictability. We tend to view history as a linear progression, a series of cause and effect events that, in hindsight, seem almost obvious. But this is an illusion. The reality is that history lurches forward, driven by seismic shocks and unforeseen events that no one, not the smartest economist, nor the most prescient analyst, saw coming. These surprises are not exceptions to the rule. They are the rule. To grasp this, let's conduct a thought experiment. Imagine it's 1924. You're asked to predict the major forces that will shape the world and its economies over the next century. What would you forecast? Perhaps you'd predict the continued rise of the automobile, bigger and taller skyscrapers, maybe even some advances in radio. But could you have possibly predicted the Great Depression, a cataclysm that would bring global capitalism to its knees just a few years later? Could you have foreseen a second, even more devastating world war, culminating in the invention and use of atomic weapons that would forever alter the nature of conflict and geopolitics? Following that, could you have predicted the half-century-long Cold War, a tense standoff between two superpowers that held the world in a state of suspended nuclear anxiety, or its sudden, largely peaceful conclusion with the fall of the Berlin Wall and the collapse of the Soviet Union? The list of surprises continues, each one more world-altering than the last. The invention of the personal computer, followed by the Internet, which would rewire every aspect of modern life, from commerce to communication. The September 11th attacks, which reshaped global security and travel overnight. The 2008 global financial crisis, a meltdown in the most sophisticated financial system ever created, triggered by instruments few understood. And, of course, a global pandemic in 2020 that would shut down the world economy in a matter of weeks. These events weren't just bumps in the road. They were tectonic shifts that created entirely new landscapes. They defined generations and set the course of history on a path no one could have charted in advance. This phenomenon is what Nassim Nicholas Taleb famously termed black swan events. A black swan has three defining characteristics. It is an outlier, falling outside the realm of regular expectations. It carries an extreme impact, and despite its outlier status, human nature makes us concoct explanations for its occurrence after the fact, making it seem predictable in hindsight. Housel argues that when it comes to money and markets, these black swan events are practically all that matters. The day-to-day fluctuations, the quarterly earnings reports, the endless analyst chatter, it's mostly noise. The real long-term returns, the real wealth creation and destruction, are driven by these massive, unpredictable tail events. Think about it, the rise of a handful of tech companies, themselves a surprise, has driven a disproportionate amount of market gains over the last 2 decades. The 2008 crisis wiped out trillions in wealth almost instantly. The pandemic created an entirely new work-from-home economy. These weren't foreseeable trends. They were jolts to the system. Understanding this is crucial. because it means the future will not be a simple extrapolation of the past. It will be punctuated by its own black swans that will render today's forecasts obsolete. This leads to one of the most important takeaways from the chapter. The biggest risk is always what no one is talking about. We have a tendency to fight the last war. After the 2008 crisis, regulators and investors became obsessed with banking leverage and mortgage-backed securities. After the dot-com bust, everyone was wary of tech stocks with no profits. While it's wise to learn from past mistakes, the danger is that we focus our attention on managing the risks we now understand, leaving us completely blind to the next, entirely different threat, lurking just out of sight. Housel writes, "Things that have never happened before happen all the time. When a risk is well known and widely discussed, like inflation in recent years or geopolitical tensions, it's already being priced into assets and factored into people's decisions. The market, in its own way, is preparing for it. The true, catastrophic risk is the one that no one is discussing in their annual outlooks, the one that isn't on the front page of the Wall Street Journal. It's the unknown. It's the risk that will come from a direction we aren't even watching. Because history is a master of surprising us with new plot twists. So, what is the antidote to a future that is guaranteed to surprise us? The answer isn't better forecasting models or more complex prediction algorithms. The answer is humility. Financial humility is the deep, abiding acceptance that you do not know what the future holds. It's recognizing that the world is complex and that your personal view of how it works is just a tiny sliver of the full picture. This humility isn't a sign of weakness. It is the ultimate source of financial strength and resilience. It's what leads you to build a margin of safety into your finances, not because you predict a specific downturn, but because you know that times unexpected will eventually happen. It's what drives you to diversify, not because you know which assets will perform best, but because you know you don't know. It's what encourages you to hold cash, not just for a planned expense, but as a buffer against the unknown and as dry powder for the opportunities that emerge from chaos. In the end, the most important part of any financial plan is planning for the plan to not go according to plan. The surprises, the shocks, the black swans, they are not an interruption of the main story of economic history. They are the main story. And preparing for them, with humility and a margin of safety, is the only rational way to navigate it. We spend our lives planning for the future. We plan careers, families, vacations, and most importantly, we plan our finances. We create spreadsheets, set goals, and diligently save and invest. But at the heart of all this planning lies a profound and uncomfortable truth. We have no idea what the future holds. Not a vague idea, not a general outline. We have absolutely no idea. Think back 20 years. Could you have predicted the rise of smartphones, the gig economy, a global pandemic that would shut down the world, or the surge in artificial intelligence? The world is a complex, chaotic system, and its path is driven by tail events, low probability, high-impact occurrences that no one sees coming. Financial markets are no different. They are governed by surprise. Yet, the entire financial industry is built on the illusion of prediction. Pundits on television will tell you where the market is headed next quarter. Analysts will give you precise price targets for stocks. Economists will forecast GDP growth to the decimal point. But history shows this is a fool's errand. The most important economic events, the market crashes, and the euphoric bubbles, are the ones that no one forecasted. So, if we can't predict the future, How can we possibly plan for it? The answer is to stop trying to be a prophet and start acting like an engineer. You don't build a bridge to withstand only the weather you forecast for next Tuesday. You build it to withstand the worst storm imaginable, the one that might happen once a century. You build in a margin of safety. You build for resilience. Your financial life should be no different. The goal is not to predict the surprises, but to have the resilience to survive them and even thrive. When they inevitably arrive, this begins with a fundamental shift in mindset, embracing humility about what you know. A globally diversified portfolio is the purest expression of this humility. For decades, it seemed obvious that the United States was the only place to invest. Before that, in the 1,980 seconds, Japan was the unshakable economic titan, destined to take over the world. Investing everything in Japanese companies felt like the safest, most logical bet imaginable. We all know how that story ended. The Nikkei index is still below its 1,989 peak. A lifetime of returns vanished. The lesson is that no country's dominance is permanent. Economic leadership shifts. Political winds change. What seems like a sure thing today can become a cautionary tale tomorrow. When you invest only in your home country, you are making a specific, highly concentrated bet and preparing for them with humility and a margin of safety is the only rational way to navigate it. We spend our lives planning for the future. We plan careers, families, vacations, and most importantly, we plan our finances. We create spreadsheets, set goals, and diligently save and invest. But at the heart of all this planning lies a profound and uncomfortable truth. We have no idea what the future holds. Not a vague idea, not a general outline. We have absolutely no idea. By owning a piece of the entire world economy, you are insuring yourself against the risk of being spectacularly wrong about one part of it. You are guaranteeing that your wealth is not tied to the fate of a single nation. This isn't about chasing higher returns. It's about risk management. It's about building a portfolio that can withstand shocks you can't even imagine today. The next pillar of resilience is something that modern finance often scorns: a large cash savings buffer. In a world obsessed with optimizing every dollar, cash is seen as inefficient. It earns little to no return. It's a drag on performance. But this view mistakes the true purpose of cash. Cash is not an investment. It is an insurance policy against life's inevitable and unpredictable turmoil. Its return is not measured in interest, but in the control, flexibility, and peace of mind it provides when things go wrong. Unexpected things happen. You might lose your job. Your car might break down. A medical emergency could arise. The stock market might crash by 40%. When these events occur, you are faced with a choice. If you are fully invested with no cash reserves, your only option is to sell your assets, often at the worst possible time. You are forced to sell stocks during a market panic, locking in devastating losses and permanently derailing your long-term compounding. A short-term problem becomes a long-term catastrophe. But if you have a healthy cash buffer, 6 months, a year, or even more of living expenses, the dynamic changes completely. A job loss is still stressful, but it's not a financial emergency that forces you to liquidate your future. A market crash is a scary event on paper, but it doesn't change your life, because you don't need to sell anything to pay your bills. Cash gives you the single most important thing in a crisis: staying power. It allows you to wait out the storm. It lets you survive the downturn without interrupting the magic of compounding. It's the oxygen that keeps your financial plan alive during a fire. Finally, let's talk about the antithesis of resilience: debt. Debt is a powerful tool, but it is also a profound source of fragility. Every dollar of debt you take on is a promise you make to your future self. It's a claim on your future income, an income that is far from guaranteed. It reduces your margin for error. Think of it this way: a life without debt has a tremendous amount of slack. If your income drops, you can reduce your spending. It's unpleasant, but manageable. A life with significant debt mortgages, car payments, student loans, credit card balances has no slack. Those payments are non-negotiable. They must be made, whether you get a raise or get laid off. Debt makes a bad situation catastrophic. It turns a recession into a foreclosure. It turns a job loss into bankruptcy. By avoiding debt, especially high-interest consumer debt, you are building one of the most powerful moats around your financial life. You are creating a buffer that protects you from the shocks of an unpredictable world. It means you don't have to take the first job offer during a layoff just to make your car payment. It means you can weather a period of low income without spiraling into a debt cycle. It means your financial future is determined by your savings and investments, not by your obligations to lenders. These three pillars: global diversification, a large cash buffer, and an aversion to debt are not about forecasting. They are about acknowledging the reality that the future is unknowable. They are about building a system so robust that it doesn't need a correct forecast to succeed. The most important financial skill is not picking the winning stock or timing the market. It is survival. It's about staying in the game long enough for your assets to compound, and you only stay in the game by building a plan that can withstand the unexpected. The biggest risks are always the ones you don't see coming, so don't try to predict them. Instead, build a financial life that is so resilient, so fortified with a margin of safety, that it doesn't matter what the future holds. That is how you plan for a future you can't predict. In the world of engineering, there is a concept so critical, so fundamental, that without it, our modern world of skyscrapers, airplanes, and bridges would literally crumble. It's called a margin of safety, a room for error. Morgan Housel argues this isn't just an engineering principle. It is the single most important concept in managing your money. Imagine a team of brilliant engineers tasked with building a bridge. They run thousands of simulations, analyze the strength of steel and concrete, and account for wind, weight, and wear. Their calculations conclude, with absolute certainty, that the bridge can withstand a load of 30,000 pounds. This is the theoretical limit, the point of failure calculated on a spreadsheet. But when the bridge is complete, what does the sign at its entrance say? It doesn't say maximum load 30,000 pounds. It says maximum load 10,000 pounds. Why is this inefficiency? Is it a waste of potential? No, it's wisdom. It's the acknowledgement of a simple but profound truth. The world is not a spreadsheet. The engineers know that reality is messy and unpredictable. Perhaps there are microscopic, undetectable flaws in the steel. Perhaps a once-in-a-century storm will produce winds far stronger than the models predicted. Perhaps a convoy of trucks, each overloaded, will try to cross at the same time. The gap between the bridge's calculated strength and its posted limit is the room for error. It's a buffer against the unknown, a protection against reality's tendency to surprise us. This margin of safety is what turns a fragile structure into a resilient one. Now, Let's apply this life-saving principle to your financial life. Your financial plan, your budget, your investment strategy. Your retirement calculation is your bridge. You build it with assumptions about future salary increases, expected investment returns, and projected expenses. It looks perfect in your spreadsheet. But the economy is not a spreadsheet. Life is not a spreadsheet. The financial world is rife with its own version of freak storms and overloaded trucks. We call them recessions, market crashes, job losses, unexpected medical emergencies, and runaway inflation. A financial plan that requires everything to go exactly as forecast is a fragile bridge, destined to break under the first real-world stress. A plan built with a margin of safety, however, is a resilient one. It can bend without breaking. So, how do we build this financial room for error? It comes down to 3 core practices. First, you must underestimate your future returns. It's tempting to plug the historical average stock market return of 8 or 10% into your retirement calculator and watch the magical numbers grow. But history is no guarantee of the future. The next 10 years might be spectacular, or they might be flat. Building your plan on the assumption of high returns is like building a bridge and assuming the wind will never blow hard. Instead, build your plan around a more conservative estimate, perhaps 5 or 6%. If the market does better, wonderful. That's a bonus. But if it underperforms, your plan isn't shattered. You've given yourself room for error. Second, you must overestimate your future expenses. When planning for retirement or a large purchase, don't just take your current costs and add a little for inflation. Life has a habit of becoming more expensive in ways we cannot predict. Your health might decline. A child might need support. The roof might need replacing. Be aggressively pessimistic about your future costs. Pad your budget. If you think you'll need $60,000 a year in retirement, plan for $75. Ling, ling, ling. This buffer isn't wasted money. It's an insurance policy against life's inevitable surprises. Third, and most importantly, you must save more than you think you will need. This is the ultimate expression of a margin of safety. If your calculations say saving 10% of your income will get you to your goal, save 15%. That extra 5% is your 20,000 pound buffer on the bridge. It is what allows you to absorb a pay cut without derailing your future. It's what lets you navigate a bear market without being forced to sell your investments at the worst possible time. It's what gives you the freedom to change careers or handle a family emergency without spiraling into debt. This is not about pessimism, it's about pragmatism. A plan without a margin of safety is brittle. It relies on precision in a world that is anything but precise. It creates a single point of failure, where one bad outcome, 1 year of poor returns, one unexpected expense can cause the entire structure to collapse. Room for error, on the other hand, is the essence of financial survival. It is the invisible force that allows you to endure volatility and come out the other side intact. It lets you stay in the game long enough for the magic of compounding to work. When you have a buffer, you are less likely to be forced into bad decisions by panic or necessity. You can afford to be patient. You can afford to let your investments recover after a crash. You can afford to look for a new job without the desperation of looming bills. In the end, the most important part of any financial plan is planning for the plan not to go according to plan. The future is unknowable. You will be wrong about your future income, your future returns, and your future expenses. Everyone is. The question is whether your plan can withstand being wrong. The difference between a financial plan that succeeds and one that fails often comes down to this single concept. It's not about finding the highest returning investment or timing the market perfectly. It's about building a bridge so strong that it can easily withstand the weight of an uncertain future. That gap, that buffer, that room for error, is the most valuable asset you can have. In the world of finance, optimism is often hailed as the ultimate virtue. We are told to believe in the future, to trust in progress, and to hold on for the long term. But what if the secret to enduring long-term optimism is a healthy, consistent dose of short-term pessimism? This is the paradoxical but powerful idea Morgan Housel explores. A mindset that separates those who merely hope for the best from those who actually survive to see it. Housel argues that true financial optimism isn't blind faith. It's the product of a strategy that is so robust it can withstand the inevitable chaos the world will throw at it. To understand this, we must first distinguish between two concepts that are not opposites, but partners: long-term optimism and short-term paranoia. Long-term optimism is the unwavering belief that the arc of history, technology, and markets bends upward. It's the conviction that human ingenuity will solve problems, that economies will grow, and that good companies will create value over decades. Statistically, this is a sound bet. The odds are, in fact, in your favor over a long enough timeline. But this optimism is utterly useless if you can't survive the journey. That's where short-term pessimism, or what we might call productive paranoia, comes in. This is the frank acknowledgement that the road to long-term success is not a straight line. It's a treacherous path filled with recessions, market crashes, personnel emergencies, pandemics, and simple bad luck. Pessimism, in this context, is not about believing everything will fail. It's about respecting the very real possibility that anything times can times fail, especially when you least expect it. Imagine you are planning a cross-country road trip. The optimist in you is excited about the destination, confident that you will eventually arrive and have a wonderful time. The pessimist in you packs a spare tire, a first aid kit, extra water, and downloads offline maps. The pessimist knows a flat tire, a dead battery, or a closed road isn't a possibility. It's an inevitability given a long enough journey. It is the pessimist's preparation that ensures the optimist's dream becomes a reality. Without the spare tire, the journey ends in frustration on the side of a highway. This brings us to one of the most actionable financial strategies: save like a pessimist and invest like an optimist. Let's break that down. Saving like a pessimist means you fully expect the unexpected. You assume that your car will break down at the worst possible moment. You plan for a surprise medical bill. You anticipate the risk of losing your job during an economic downturn. Because you expect these things, you build a cash buffer, an emergency fund that is robust and easily accessible. This isn't money you're hoping to invest for high returns. This is money for survival. It's the financial equivalent of a fire extinguisher. You hope you never have to use it, but you're deeply relieved. It's there when the kitchen catches fire. This pessimistic saving strategy is what enables you to invest like an optimist. Because you have a cash cushion to handle life's emergencies, you are not forced to sell your long-term investments at the worst possible time. When the market crashes, and it will, you don't have to panic sell your stocks to pay for a new transmission in your car. Your pessimistic savings plan absorbs the short-term shock, allowing your optimistic investment plan to keep working, compounding, and growing for the long haul. The person without savings is forced to liquidate their future dreams to pay for today's disasters. The pessimist's savings protect the optimist's investments. This core idea is also captured in the engineering and investment principle known as the margin of safety. When engineers design a bridge, they don't calculate the maximum load for an average day. They calculate the absolute theoretical breaking point and then build it to be several times stronger. They are pessimistic about traffic jams, high winds, material fatigue, and unforeseen stresses. That over-engineering, that margin for error, is what makes the bridge safe. In your financial life, a margin of safety is a form of practical pessimism. It's the gap between what you expect to happen and what you can actually withstand. It can be a high savings rate that gives you flexibility. It can be a diversified portfolio that doesn't put all your eggs in one basket. It can be a reasonable timeline for your goals that allows for setbacks. It's building a plan that doesn't require everything to go perfectly right. You assume some things will go wrong, so you build in a buffer. So, what is the ultimate lesson here? Optimism and pessimism are not at war. They are a yin and a yang, a partnership that creates financial resilience. Optimism is the belief that the odds are in your favor over time, while pessimism is the crucial understanding that the journey to get there will be a minefield of setbacks. Real optimism is not just cheering from the sidelines. It is about staying in the game. And staying in the game requires a defensive strategy, a plan that anticipates failure, respects risk, and prepares for shocks. By embracing a little short-term paranoia, by saving for a rainy day you know is coming, you give your long-term optimism the one thing it needs to succeed: time. You are building a plan that expects things to go wrong, so you can survive long enough to see them go right. Let's begin with a simple thought experiment. I want you to pause and think about the person you were 10 years ago. Really picture them. What kind of music did you listen to? What were your career ambitions? What did you value most in your friendships? How did you spend your free time and your money? Chances are, the person you're picturing is remarkably different from the person you are today. You can clearly see the evolution, the growth, the changes in taste, priority, and personality. You have changed profoundly. Now, for the second part of the experiment, think about the person you will be 10 years from now. What will they be like? What will their goals be? What will they value? If you're like most people, you probably imagine a person who is essentially just a slightly older version of your current self. You expect your core personality, your values, and your biggest desires to remain largely the same. This is the paradox at the heart of what psychologists call the end of history illusion, coined by psychologist Daniel Gilbert. This illusion describes our tendency to correctly recognize how much we've changed in the past, while simultaneously underestimating how much our personalities, preferences, and values will change in the future. We are all works in progress that mistakenly believe we are finished. We look back at our past selves, our teenage obsession with a particular band, our college-era dream of living in a bustling city, our early career conviction that climbing the corporate ladder was the only thing that mattered, and we see them as naive, fledgling versions of who we are now. Yet, we look forward and assume the person we are today has finally arrived at the final, permanent version of me. What kind of music did you listen to? What were your career ambitions? What did you value most in your friendships? How did you spend your free time and your money? Chances are, the person you're picturing is remarkably different from the person you are today. You can clearly see the evolution, the growth, the changes in taste, priority, and personality. You have changed profoundly. Now, for the second part of the experiment, think about the person you will be 10 years from now. A 5-year-old decides their ultimate goal is to retire at 60 to a large house on a golf course in Florida. Driving a luxury sports car, to achieve this, they map out a rigid, decades-long plan. They commit to a high-stress, high-paying career they don't particularly love. They minimize spending on travel and hobbies. And they pour every spare dollar into investments earmarked for the Florida house. For 40 years, they stick to the plan. They sacrifice. They delay gratification. They finally reach 60, buy the house, buy the car, and they are miserable. The 60-year-old version of themselves doesn't care about golf. They find the Florida heat oppressive. What they truly crave is living in a smaller, walkable city, close to their grandchildren. They wish they had spent more time with their family during those grueling career years. The luxury car feels ostentatious and impractical. Their meticulously executed plan, designed by a person who existed 4 decades ago, has become a golden cage. The plan succeeded, but the person failed. This is the danger of locking ourselves into extremely rigid financial goals. We are trying to satisfy the desires of a person we haven't met yet. Using today's values as an immutable guide, the end of history illusion makes us overconfident in our predictions about our future desires. So, what is the alternative? The answer isn't to abandon planning altogether. That would be like setting sail without a rudder. Instead, the solution is to build a plan that prioritizes flexibility and adaptability over hyper-specific, unchangeable goals. The goal of your financial plan shouldn't be to fund a single, specific dream. The goal should be to maximize the number of options your future self will have. Think of it this way. Instead of saving for the Florida house, you save for financial independence. Financial independence isn't a place or an object. It's a state of being. It's having enough capital that you have control over your time. A 50-year-old with financial independence has options. If they hate their job, they have the option to quit and find a new one that pays less but offers more fulfillment. If they want to work part-time to care for an aging parent, they have that option. If they want to take a year off to travel the world or start a business, they have that option. A flexible plan values things like liquidity and a lack of debilitating debt. It favors accumulating money, enough savings to walk away from any situation that makes you miserable over accumulating assets tied to a single, rigid life path. The ultimate takeaway from understanding the end of history illusion is to avoid the extreme ends of the financial planning spectrum. On one end is having no plan at all, which leaves your future self at the mercy of circumstance. On the other, far more seductive and subtly dangerous end is the creation of a detailed, rigid plan that leaves no room for your inevitable personal evolution. The middle path is the wise path. Have a sense of direction, but not a fixed destination. Use your plan as a compass that points you toward more freedom and greater security, not as a GPS that calculates a single, unchangeable route to a specific address. Acknowledge that the person you are 10 or 20 years from now will have learned things you haven't, experienced things you can't imagine, and will value things that might seem trivial to you today. You are saving for a stranger, so give that stranger the greatest gift imaginable, the freedom of choice. In the world of personal finance, there's a seductive siren song, the promise of absolute freedom, achieved at lightning speed. It's the gospel of the extreme work, 100-hour weeks for a decade to retire at 30, save 80% of your income, live a life of monastic frugality now for a life of supposed luxury later. These paths are presented as the ultimate hack, the shortcut to beating a system designed to keep you working for 40 years. But as Morgan Housel brilliantly illustrates, the most mathematically optimal financial plan is often the most psychologically disastrous. The danger lies not in the numbers, but in our own humanity. Let's analyze the most prominent example of this ideology, the FIRE movement, which stands for Financial Independence. Retire early. On the surface, FIRE is incredibly appealing and holds many virtues. It encourages a high degree of financial literacy, promotes intentional spending, and champions the powerful idea of owning your time. It teaches people to question consumer culture and to value freedom over material possessions. For many, adopting FIRE principles has led to a more secure and purposeful financial life. These are undeniably positive outcomes. The problem arises when FIRE is taken to its dogmatic extreme. The version that captures headlines involves saving upwards of 70% of one's income, shunning all but the most essential expenses, and channeling every ounce of energy into earning and investing. This is where the psychological cracks begin to show. The core fallacy of such an extreme plan is its failure to account for the single most important variable in any long-term strategy, the fact that you will change. The person who starts the journey is rarely the same person who finishes it. A two-year-old, fueled by ambition and a tolerance for ramen noodles, might eagerly design a plan to achieve financial freedom by 35. They are making a binding contract on behalf of a 3-5-year-old. They have never met a person who might have a partner, children, a new passion that requires funding, or simply a different definition of a life well lived. This leads us to the immense risk of burnout and regret. Sacrificing your prime years, your 20 seconds and 30 seconds, decades, often defined by peak health, energy, and social opportunities, is an enormous gamble. You are trading a tangible, vibrant present for an uncertain, abstract future. The assumption is that the 40-year-old you will want the exact same things the 20-year-old you planned for. But what if they don't? What if, after a decade of relentless grind, you arrive at your goalpost, only to find that the finish line feels empty? You may have a vast portfolio, but you may have also missed the spontaneous road trips, the formative relationships, the hobbies you never had time to explore, and the simple, everyday joys you deferred for a tomorrow that looks nothing like you imagined. This is the ultimate tragic irony. You sacrifice your life to save for it, only to realize that the life you wanted changed along the way. Regret is a price that no amount of compound interest can repay. You can't get your youth back. So, what is the alternative? Is it to abandon planning and live with financial recklessness? Absolutely not. Housel's wisdom points towards a middle path, the power of moderation. The goal of a good financial plan is not to be the fastest or the most aggressive. The goal is to be sustainable. The best plan is the one you can stick with for a lifetime, through all of life's unpredictable twists and turns. An extreme plan is brittle. It has no room for error, for surprise expenses, for a change of heart, or for a simple human desire to enjoy life now. When faced with the inevitable pressures of reality, a brittle plan doesn't bend, it shatters. People burn out, give up entirely, and often swing to the opposite extreme of financial irresponsibility. A balanced approach, however, is resilient. It means saving a reasonable percentage of your income, perhaps 15–20%, instead of 70%. It means investing consistently for the long term, but also allocating funds for travel, for hobbies, for dinners with friends, for the things that make life rich and meaningful in the present. It's a plan that allows you to provide for your future self without punishing your current self. It acknowledges that the journey is just as important as the destination. This approach recognizes that wealth isn't just a number in a bank account. It's having the options and flexibility to live a good life today, tomorrow, and for decades to come. The magic of compound interest works best when it's given a long, uninterrupted runway. A moderate, sustainable plan is far more likely to remain in place for 40 years than an extreme one is for 10. In the end, the moderate saver who sticks with their plan for a lifetime will almost always end up in a better position financially and emotionally than the extremist who sprints for a decade and then collapses. The best plan is the one that lets you sleep at night. One that builds wealth without destroying your well-being. It's the one that grows with you, adapting to your evolving dreams, because the purpose of money is to serve your life, not the other way around. Welcome to the world of investing, where the most common saying is that there's no such thing as a free lunch. But what does that truly mean, Morgan Housel? In his book, The Psychology of Money, dedicates a crucial chapter to this very idea. Titled Nothing's Free, he argues that everything in finance has a price. But this price is rarely visible on a tag. You don't pay it with dollars and cents from your account. Instead, you pay it with doubt, fear, uncertainty, regret, and the gut-wrenching volatility that accompanies any potential for significant reward. Let's delve into this concept. The price of outstanding long-term returns in the stock market is not hidden in expense ratios or trading fees. The real price is the emotional turmoil you must endure to earn those returns. It's the feeling you get when you check your portfolio and see it has dropped 10%. By Vince Archer. Or even 40%. It's the barrage of headlines screaming about an impending recession. The chatter from so-called experts predicting further doom, and the primal urge to sell everything just to make the pain stop. This is the price of admission. Housel presents a brilliant analogy to reframe our thinking. Imagine you want to buy a new car. You find the perfect one, and the sticker price is $40,000. You wouldn't walk into the dealership, see the price, and consider it a fine or a punishment. You see it as the cost of acquiring the car. It's a straightforward transaction. You pay the price, you get the car. Simple. Now, apply this logic to the stock market. Over the long run, the market has historically provided excellent returns. That's the product you're buying. The price tag for those returns is volatility and uncertainty. So when the market drops 10%, that isn't a fine for making a bad decision. It's the fee you are paying for the opportunity to earn long-term growth. It's the sticker price showing up. Most investors, however, treat it like a fine. They panic. They think they've done something wrong and try to avoid the fee by selling at the worst possible time. A successful investor, in Housel's view, understands that volatility is the cost of doing business. They see the market downturn not as a sign of their failure, but as the price for a ticket to wealth creation. They are willing to pay it. This concept doesn't just apply to stocks. Every financial strategy has a price. You might think you can avoid the gut-wrenching volatility of stocks by keeping all your money in cash. You feel safe, protected from market crashes. But you are still paying a price. The price of holding cash is inflation. Every single day. The purchasing power of your money is silently eroding. The hamburger that cost $5 last year costs $5.50 this year. Your cash is losing its value. That gradual, almost invisible loss is the fee you pay for the feeling of stability. What about bonds? the traditional safe haven. They too have a price. It's called interest rate risk. If you buy a bond that pays a 3% coupon, and a year later, new bonds are being issued at 5%, your bond is suddenly less attractive. Its market value will fall. You've paid a price for that perceived safety. The key takeaway from this chapter is not to find an investment that is free. It doesn't exist. The goal is to identify the price of whatever strategy you choose and be willing to pay it. You need to look at your chosen assets and ask, what is the cost of admission here? For stocks, it's enduring the roller coaster of ups and downs without panicking. For cash, it's accepting the slow decay of your purchasing power. For bonds, it's understanding that their value can and will fluctuate. Once you define the price, you have to make a conscious decision to pay it. You have to be prepared for the inevitable downturns and see them for what they are, the fee for future returns, not a fine for a mistake. When you can look at a 20% drop in your portfolio and think, this is the fee I was expecting to pay for eventual growth, you have fundamentally changed your relationship with money. You have moved from being a speculator, trying to get something for nothing, to being an investor who understands that everything worth having comes at a price. Welcome to our exploration of Morgan Housel's The Psychology of Money. Today, we delve into one of the most powerful mindset shifts an investor can make, a concept we'll call the fee of investing. Not the fine. Imagine you've discovered the most incredible theme park in the world. The roller coasters are legendary. The attractions are breathtaking. And everyone who spends time there leaves happier and wealthier. There's just one catch. The price of admission isn't a fixed dollar amount. Instead, the park occasionally closes for a random amount of time. The lights go out, and some of the rides might even go backward for a little while. That uncertainty, that occasional chaos, is the price you pay to enjoy the wonders inside. Now, how you view that price determines everything about your experience. Do you see it as a punishment? A fine for showing up on the wrong day? Or do you see it as the necessary, expected fee for getting access to the magic? This is the core dilemma investors face. When the stock market drops, and it always does, eventually, our instinctive reaction is to feel penalized. A 10% correction feels like a fine for bad timing. A 20% bear market feels like a severe punishment for making a huge mistake. We think, I did something wrong. I should have seen this coming. I should have sold. This is the fine mentality. It's a mindset rooted in the idea that market returns should be a smooth, upward climb, and any deviation from that path is an error, a penalty for failing to predict the future. This perspective is not only stressful, but it's also incredibly destructive to our long-term wealth. Why? Because when you feel you're being fined, your natural response is to try to make the pain stop. You sell your investments to stop the punishment, often locking in your losses permanently. You vow to wait on the sidelines until things calm down. A vague and unknowable future state. In essence, you run out of the theme park screaming the moment the lights flicker, missing the incredible spectacle that follows when they turn back on. Morgan Housel proposes a radical reframing of this experience. He argues that market volatility, the drops, the scares, the periods of gut-wrenching uncertainty is not a fine at all. It is the fee. It is the cost of admission for the extraordinary long-term returns that capitalism can generate. You don't get the 7-figure returns over a lifetime without enduring a few 6-figure pullbacks along the way. The fee is the price for compounding to work its magic. Just like you can't enjoy the movie without buying the ticket, you can't enjoy long-term market growth without paying the fee of volatility. Once you internalize this, your entire perspective shifts. You stop asking, how can I avoid the next downturn, and start thinking, the price of great returns is dealing with downturns. The people who try to avoid this fee are the market timers. They are the ones who believe they can cleverly sneak into the theme park only when the best rides are running with no lines, and slip out just before the daily thunderstorm arrives. They sell when they fear a drop and buy when things feel euphoric. But history and data have shown, time and time again, that this is a losing strategy. The market's best days are often clustered right next to its worst days. Selling after a big drop to avoid the fine is the surest way to miss the explosive recovery that often follows. A study from Bank of America found that if an investor had missed the S&P 500's 10 best days in any given decade since the 1,930 seconds, their total return would be significantly lower. For the decade ending in 2020, missing the 10 best days meant your return was more than halved. In trying to dodge the fee, these investors ended up paying a far greater price, the loss of their future wealth. A better analogy than a one-time park ticket might be a subscription service, like Netflix or Spotify. You pay a monthly fee for access to a massive library of content. You don't get angry or panic when that fee is charged to your credit card. You don't see it as a fine. You see it as a normal, predictable cost for a valuable service. You should view market declines in the same way. They are the regular subscription fee for access to wealth creation. Sometimes the fee is small, a minor 5% dip. Sometimes it's larger, a 30% crash. But it's always part of the deal. It's the cost of doing business in the best business there is for growing your money over the long haul. When you see volatility as a fee instead of a fine, your behavior changes dramatically. You are less likely to panic. A market crash is no longer a sign that your strategy has failed. It's a sign that the system is working as it always has, charging the required fee for future gains. You begin to understand that without these downturns, there would be no premium for investing in stocks. If returns were guaranteed and linear, the prices would be so high that the returns themselves would disappear. The risk, the uncertainty, the fee of volatility is precisely what generates the opportunity for high returns. It scares some people away, leaving more for those with the endurance to stick around. So, the next time the market plummets and your portfolio value drops, take a deep breath. Remind yourself that you are not being fined for a mistake. You are simply paying the price of admission. You are paying the fee that the market has always charged and always will charge for the incredible opportunity to build real, long-term wealth. Accepting this fee is the key to staying invested, to allowing the power of compounding to do its work over decades. It's the psychological hack that separates the successful long-term investor from the frantic market timer. The theme park of wealth is open for business. The price is volatility. Pay the fee and enjoy the ride. Welcome to Chapter 32, You and Me. Let's start with a simple image. Imagine you've spent months training for a marathon. You've focused on endurance, pacing, and long-distance strategy. On race day, you line up at the start, but the person next to you is a 100-meter sprinter. The starting gun fires, and they explode off the line in a burst of pure speed. For a moment, a wave of panic hits you. Am I doing this wrong? Should I be running that fast? If you try to match their pace, you'll burn out before the first mile marker. It's an absurd comparison. Yet in the world of investing, we make this exact mistake every single day. We take our financial cues from people who are not running our race. They are playing a completely different game. Morgan Housel argues that understanding this distinction is one of the most critical skills in managing your money. Because when you try to play someone else's game, you are almost guaranteed to lose. Let's make this concrete with an example. Meet Sarah, the day trader, and Tom, the long-term retirement investor. Sarah's game is measured in minutes and hours. She sits at a desk with multiple monitors, watching market fluctuations tick by tick. Her goal is to capture tiny profits from short-term price movements. She uses leverage, complex option strategies, and her definition of risk is what might happen between now and lunchtime. One morning, Abiotech stock, Innovate Pharma, announced promising, but very early, trial results. The stock instantly jumps 25%. For Sarah, this is a clear signal. The momentum is strong. She buys a large position, not because she believes Innovate Pharma will cure cancer in 10 years, but because she believes she can sell it for a 2% gain in the next 30 minutes. Her action is perfectly rational within the rules of her game. Now, meet Tom. He's 35, saving for a retirement that's 30 years away. His game is about long-term compounding, diversification, and dollar-cost averaging into low-cost index funds. He checks his portfolio maybe once a quarter. But today, he logs into his brokerage account and sees the news about Innovate Pharma. He sees the stock soaring. He reads excited chatter on social media from people like Sarah. A powerful emotion kicks in: FOMO, the fear of missing out. He thinks, everyone is making money on this, I need to get in. So, he sells a chunk of his stable index fund and buys Innovate Pharma at its peak. What happens next? An hour later, a regulator raises a question about the trial data. The momentum reverses. The stock plunges 40%. Sarah, the day trader, might have already sold for her small profit. Or maybe she took a small, manageable loss, which she considers the cost of doing business. It's just one of hundreds of trades she'll make that month. But Tom, he's now holding a highly speculative stock that has cratered in value. And he's sold a piece of his reliable, long-term plan to acquire it. The exact same action buying Innovate Pharma was a calculated move for Sarah, but a potentially devastating mistake for Tom. They were on the same field, but playing different games. Tom was tempted by the sprinter's pace and abandoned his marathon strategy. This dynamic is the engine of financial bubbles. A bubble doesn't inflate because a mass of people suddenly agrees on the true, long-term value of an asset. It inflates because a growing number of participants are drawn into a short-term game. The game isn't, does this asset have durable value? The game is, can I sell this asset to someone else for a higher price tomorrow? It's a game of momentum, speculation, and psychology. People who are playing a long-term game, investing in a company for its decade-long earnings potential, get lured onto the field. They see prices going up and assume it's a reflection of fundamental worth. But they are unknowingly playing against people with a completely different objective and a much shorter time horizon. When the short-term players decide the game is over and rush for the exits, the long-term investors are the ones left holding the vastly overpriced asset. Identifying which game is being played is crucial. Are you investing, or are you participating in a game of hot potato, where the only goal is not to be the last one holding the potato? This brings us to financial pundits, the so-called experts you see on television or social media. It's tempting to listen to their top 5 stocks to buy now, but we must ask, what game are they playing? Their game is not to make you, personally, wealthy. Their game is engagement. Their goal is to attract eyeballs, generate clicks, and keep you tuned in. Bold, exciting predictions and hot tips are far more entertaining than the boring, sensible advice that actually works for most long-term investors, which is buy a diversified portfolio and don't touch it for 30 years. A pundit doesn't know you. They don't know your age, your income, your debt, your family situation, your career prospects, or your personal tolerance for risk. Their advice is, by definition, generic. Taking a specific stock tip from a pundit is like taking a prescription from a doctor who has never met you and knows nothing about your medical history. The advice might be right for times someone asterisk, but the odds that it's right for times, you times, and times your game times are vanishingly small. They are the announcers in the booth, commentating on the overall event. You are the player on the field. Don't let the announcer dictate your next move. So, what's the solution? It's simple, but not easy. You have to shut out the noise and figure out what game times you times are playing. Before you make any investment decision, you must be able to answer a few fundamental questions. First, what is my time horizon? This is the most important question. Are you investing money you'll need in 1 year for a house down payment? Or is this money you won't touch until retirement in 40 years? The answer drastically changes what constitutes a good investment. A short time horizon demands safety and liquidity. A long time horizon allows you to tolerate volatility for the potential of greater growth. Second, what is my goal? Why are you investing this money in the first place? To make more money is not an answer. Is it to fund a comfortable retirement? To pay for a child's college education? To achieve financial independence by age 50? Ampere's specific goal helps you calculate how much risk you actually need to take. Often, people take on far more risk than is necessary to reach their stated goals, simply because they get caught up in someone else's game of maximizing returns at all costs. And third, what is my personal tolerance for risk? Be honest with yourself. How would you feel, not just financially, but emotionally, if your portfolio lost 30% of its value in 6 months? Would you panic and sell at the bottom? Or would you have the conviction to stick with your plan? Or even buy more? There is no right answer. But knowing your own psychology is vital. Once you have defined your game, your horizon, your goals, and your risk tolerance, you have your own personal rulebook. This rulebook becomes your filter. You can now see the day trader making a frantic bet or the TV pundit shouting about the next big thing. And you can calmly say to yourself, that's fine for them, but they are not playing my game. Winning at money isn't about getting the highest possible returns or beating everyone else. It's about setting up a strategy that lets you meet your own goals on your own timeline so you can sleep well at night. It's about playing your game, and your game alone. Welcome to our exploration of Morgan Housel's The Psychology of Money. Today, we delve into a concept that is foundational to sane and successful investing: identifying your own financial game. It's easy to look at the world of finance and see it as one giant arena where everyone is competing for the same prize. But this is a dangerous illusion. A day trader trying to scalp a tiny profit from a stock's hourly fluctuation is playing a completely different game than a young professional saving for retirement in 40 years. A venture capitalist betting on 10 startups, expecting 9 to fail, is not playing the same game as a couple saving for a house down payment in 3 years. The problem arises when we, playing our own unique game, start taking cues from players in a completely different one. It's like a marathon runner trying to match the explosive starting pace of a 100-meter sprinter. The result is inevitable exhaustion. failure, and frustration. To avoid this fate, you must first define the rules, boundaries, and victory conditions of your own personal game. This isn't about complex spreadsheets or advanced economic theory. It's about introspection. Let's build a framework to help you do just that. Start by asking yourself the most fundamental question: what is this money for? Be specific. Is it for a comfortable retirement? Ensuring you don't have to worry in your old age? Is it for a down payment on a home? A tangible goal with a relatively short timeline. Is it to fund your children's education, or is it for financial independence? Allowing you to leave a job you dislike in 10 years. Each of these goals represents a different game. The strategy for a 3-year house fund is fundamentally different from a 30-year retirement fund. For the house, capital preservation is key. For retirement, long-term growth is the priority. And you can afford to weather more volatility. The next question follows directly: what is my time horizon? This might be the single most important factor that defines your game. Time is the magic ingredient that allows compounding to work and helps smooth out the terrifying bumps of market volatility. If you need the money in 3 years, your tolerance for a 30% market drop is, and should be, near zero. You're not playing the growth game, you're playing the preservation game. If you don't need the money for 30 years, that same 30% drop, while emotionally difficult, can be a long-term opportunity. Your long time horizon is your superpower, allowing you to ignore the short-term noise that panics other players. Finally, ask yourself, what does true financial success look like to me? Personally, forget what you see on social media. Forget the neighbor's new car. What brings times you, times peace of mind? Is it a specific net worth number? Or is it the ability to wake up every morning and say, I can do whatever I want today? Is it the security of knowing your family will be okay, no matter what? Your definition of success determines the finish line of your game. Without knowing where the finish line is, you'll just keep running, susceptible to every trend and every hot tip because you have no anchor. Once you've defined your goals and timeline, you must honestly assess your risk tolerance. This isn't just a simple quiz. It's a deep understanding of two distinct components: your financial capacity for risk and your emotional temperament for risk. Financial capacity is the math part. It's a measure of how much you can objectively afford to lose without jeopardizing your critical financial goals. A 25-year-old with a stable job and a small nest egg has a high financial capacity for risk in their retirement account. Even if the market crashes by 50%, they have decades of earning years to recover. A 60-year-old on the cusp of retirement has a very low financial capacity for risk with their core living expense funds. A major loss at that stage would be catastrophic. This is objective. But the second part, emotional temperament, is far more personal and often more important. This is your psychological ability to handle volatility. How do you feel when you see your portfolio value drop by 20% in a month? Do you get a pit in your stomach? Do you lose sleep? Do you feel an overwhelming urge to sell everything and stop the bleeding? If so, your emotional tolerance for risk is lower. Regardless of your financial capacity, there is no shame in this. The worst financial mistake is to be a forced seller, and panic is the most powerful force. Knowing your emotional limits allows you to build a portfolio you can stick with through thick and thin, which is infinitely more important than building a theoretically optimal portfolio that you'll abandon at the first sign of trouble. The goal is to align your strategy with both your financial capacity and your emotional temperament. Now, how do you codify all this introspection into a practical tool? You create what's known as an investment policy statement, or IPS. This sounds intimidating, but it doesn't have to be. Think of it as a simple, one-page letter you write to your future, panicked self. This is your rule book for your game. It should be written when you are calm and rational. Your IPS can be as simple as this. My primary financial goal for this account is E.g. retirement in 2055. My strategy is to invest E.g. $500 every month into a low-cost global stock market index fund. I am playing a long-term game. And I acknowledge that markets will experience significant downturns. When the market falls by more than 20%, I will not sell. Instead, I will remind myself of my long time horizon and stick to my monthly investment plan. I will only consider changing this strategy if my fundamental life circumstances or goals change, not because of market noise or what others are doing. This simple paragraph is incredibly powerful. It's a pre-commitment. It's a contract with yourself. When fear and greed, the two great enemies of the investor, inevitably show up, you don't have to think. You don't have to debate. You just read your statement and follow the rules you set for yourself when you were thinking clearly. This document, this personal rulebook born from understanding your goals, your timeline, and your true risk tolerance, becomes your financial North Star. In a world saturated with financial news, overnight crypto millionaires, and recession fears, it's dangerously easy to get lost. You see others getting rich playing a game you don't understand, with rules you don't know, and you feel the powerful pull of envy and FOMO, the fear of missing out. You start to question your own slow and steady game. Your North Star is what pulls you back. It reminds you that their game is not your game. Their success doesn't mean you're failing. Just as a sprinter finishing their race doesn't mean the marathon runner is behind schedule. You are on a different course, headed for a different destination, on a different timeline. By defining your own game, you give yourself the greatest advantage any investor can have: the ability to ignore the chaos and focus only on what matters to you and your own journey toward financial well-being. Welcome to our exploration of Morgan Housel's The Psychology of Money. Today, we delve into one of the most counterintuitive yet powerful ideas in the book, The Seduction of Pessimism. Have you ever noticed how the person predicting doom and gloom often sounds more intelligent, more sophisticated, than the one promising a bright future? A warning of imminent disaster captures our attention, while a forecast of steady progress often gets dismissed as naive. This isn't a coincidence. It's a deep-seated feature of human psychology, and understanding it is crucial for long-term financial success. Housel argues that while optimism is the most rational and profitable long-term stance, pessimism is intellectually captivating, and its siren call is difficult to ignore. Let's break down why this is. First, we must look back, way back. Our brains are hardwired for survival, a product of millennia of evolution, where threats were immediate and existential. Imagine an early human hearing a rustle in the grass. It could be the wind, or it could be a saber-toothed tiger. The one who assumed it was the wind and was wrong didn't pass on his genes. The one who assumed it was a tiger and ran survived. Even if he was wrong 99 times out of 100, this is the essence of loss aversion. The pain of a loss is psychologically far more powerful than the pleasure of an equivalent gain. Our brains evolved to prioritize threats over opportunities. A missed opportunity might mean you go hungry for a day. A missed threat could mean you never eat again. This ancient software is still running on our modern hardware. When we hear bad news about the economy or a potential market crash, that primitive alarm system goes off. It screams, Pay attention, this could be a tiger. Good news. On the other hand, doesn't trigger the same urgent response. It feels less critical, less vital for our immediate survival. This evolutionary bias is the first layer of pessimism's seductive power. It's not that we enjoy bad news. It's that we are biologically programmed to give it our undivided attention. This leads directly to the second point, the psychological framing of pessimism versus optimism. Pessimism feels like it's protecting you. When someone warns of a market downturn, they appear to be looking out for your best interests, helping you avoid danger. Their advice feels like a shield. It's a cautious, prudent approach. Even if the disaster they predict never materializes, their advice seems harmless. They were just being careful. Right. On the flip side, optimism often feels like a reckless sales pitch. The person telling you to invest for the long term, to believe in future growth, sounds like they are trying to sell you something. Their advice requires a leap of faith, an acceptance of risk and uncertainty. If they're wrong, you could lose money. Therefore, optimism is perceived as inherently riskier. A pessimist who is proven wrong loses nothing. An optimist who is proven wrong can look like a fool and cause tangible harm. This dynamic makes pessimism an easier and socially safer position to hold. It sounds smarter because it signals an awareness of risk, which our threat-obsessed brains appreciate. The third reason for pessimism's allure is a fundamental asymmetry in how we perceive time and events. As Morgan Housel brilliantly explains, progress happens too slowly to notice, but setbacks happen too quickly to ignore. Think about the greatest advancements of the last century: the rise of the internet, massive gains in life expectancy, the compounding growth of the stock market. None of these were single events. They were the result of millions of people making small, incremental improvements every single day. Progress is a slow, grinding process. It's like watching a glacier form. You know it's happening, but you can't see it in real time. Setbacks, however, are the opposite. They are sudden, dramatic, and all-encompassing. A market crash happens in a day. A pandemic shuts down the world in a week. A war breaks out overnight. These events are traumatic and dominate the headlines and our consciousness. Because they happen so quickly, they feel more potent and more real than the slow, almost invisible march of progress. This creates a distorted view of history. We remember the crashes, the wars, and the plagues far more vividly than the decades of quiet, uninterrupted growth that surrounded them. We give disproportionate weight to the sudden trauma, forgetting the resilient, compounding progress that defines the long-term trend. Finally, this entire psychological apparatus is amplified and exploited by the financial media. The media's business model is not to provide you with a calm, rational, long-term perspective. Their business model is to capture your attention. And what captures attention better than fear? A headline that reads, "Market ticks up 0.1% on low volume" will get ignored. A headline screaming, "Market collapse looms, are you prepared for the trillion-dollar wipeout?" will get clicks, views, and shares. Fear sells. Pessimism is profitable for the media companies. They are not necessarily acting with malice. They are simply responding to the market. They are feeding the beast of our own evolutionary biases. By constantly bombarding us with negative news, worst-case scenarios, and expert predictions of doom, the media creates a feedback loop. It validates our innate fear and makes the world seem far more dangerous and unstable than it actually is. This distorted reality makes it incredibly difficult to remain optimistic. even when long-term data overwhelmingly supports an optimistic view. So, what is the takeaway? The point is not to become a blind optimist who ignores real risks. That is just as dangerous. The key is to understand the powerful, seductive pull of pessimism. It's to recognize that our brains, our psychology, and our media environment are all tilted in its favor. Real optimism is not the belief that nothing bad will happen. It is the belief that the future will be better. A belief rooted in the historical arc of progress and human ingenuity. It's the understanding that setbacks are a normal, albeit painful, part of the journey, but they don't negate the long-term upward trend. To build wealth, you have to be able to survive the short-term dramas long enough to benefit from the long-term compounding of progress. And to do that, you must first resist the seduction of pessimism. Turn on the news any given day. And what do you see? A looming recession, a geopolitical crisis, a shocking corporate scandal, a devastating natural disaster. The headlines are an endless drumbeat of negativity, a constant stream designed to grab your attention through fear and urgency. In this environment, pessimism is not only easy, it's seductive. It sounds intelligent, cautious, and protective. The person who predicts a market crash is hailed as a prescient sage, while the one who expects long-term growth is often dismissed as a naive Pollyanna, dangerously out of touch with reality. We are evolutionarily wired to pay more attention to threats than opportunities. A single threat can kill you, while a missed opportunity just means you try again tomorrow. This bias makes pessimism a natural default. And yet, Morgan Housel argues with compelling force, for your long-term financial well-being, for building real wealth, optimism is the most reasonable, logical, and profitable bet you can make. First, we must clarify what we mean by optimism. It is not the belief that nothing bad will ever happen. It's not a blind faith that every investment will go up or that the path to success will be smooth. That's a dangerous delusion. True, productive optimism, as Housel defines it, is the belief that the odds are in your favor over the long run. It's a sober acknowledgement that while the world will always be filled with problems, setbacks, recessions, and tragedies, humanity has a remarkable and persistent track record of solving those problems. Progress isn't a straight line. It's a messy, chaotic, often brutal process of one step back for every 2 or 3 steps forward. An optimist doesn't ignore the step back. They simply have faith in the eventual steps forward. They don't expect a perfect garden of roses. They understand that there will be droughts, pests, and bad seasons, but they also believe that the gardeners, the scientists, innovators, entrepreneurs, and workers will, over time, figure out how to grow more roses than weeds. This isn't wishful thinking. It's a pragmatic conclusion drawn from observing centuries of human history. An optimist is simply a realist with a long-term perspective. Let's make this concrete. Imagine you could view a chart of the Dow Jones Industrial Average, not over the last day or the last year, but since its inception in 1896. From a distance, the chart tells a simple, powerful story. It looks like an almost vertical line, rocketing up and to the right. But as you zoom in on any given decade, the simplicity vanishes. Replaced by chaos, you see the dot-com bubble burst, where fortunes were wiped out overnight. You see the sheer cliff of the 2008 financial crisis, when the entire global banking system teetered on the brink of collapse. You see, the Black Monday crash of 1987, the oil crisis of the 70s, the Great Depression where the market lost nearly 90% of its value, two devastating world wars, the Spanish flu pandemic, and countless recessions and corrections. Each of those downward spikes represented a period of intense, gut-wrenching fear and uncertainty. At each point, the most intelligent-sounding people declared that this time was different, that the old rules no longer applied, that the system was fundamentally broken for good. Pessimists had powerful, data-driven arguments every single time. And every single time, they were eventually proven wrong by the relentless forward march of innovation and adaptation. The line recovered, healed, and climbed to new, previously unimaginable highs. This isn't just a stock market phenomenon. Plot a chart of global GDP per capita, life expectancy, infant mortality, or literacy rates over the last 200 years. The pattern is identical, a long-term, undeniable upward trend, punctuated by terrifying but ultimately temporary setbacks. The world breaks, and then it gets put back together stronger. The logic of the bet. This long-term historical reality is the bedrock of the most logical financial strategy for the average person. Pessimism might win you debates and make you sound smart at a dinner party. But it's optimism that builds wealth. Why? Because the global economy is not a static entity. It is a massive, decentralized, adaptive problem-solving machine. Every single day, billions of people wake up with a fundamental desire to improve their own lives and the lives of their families. They invent new technologies to solve old problems. They start businesses to meet unmet needs. They find more efficient ways to work. They share ideas that spark further innovation. This collective, chaotic, and self-interested ambition is the unceasing engine of economic growth. It doesn't stop for recessions. It doesn't care about political turmoil. It is a force of nature that compounds over time. When you invest in a broad market index fund, you aren't just buying abstract shares of companies. You are making a direct, long-term bet on this engine. You are betting that humanity's desire to progress will outweigh its capacity for self-destruction. While any single company can and will fail, and any single year can be a disaster, a diversified bet on the collective progress of humankind has been the single greatest wealth-creating bet in history. Betting against it by hoarding cash under a mattress or trying to time the market based on frightening headlines is a bet against the most powerful and persistent force in the financial universe. This brings us to the most crucial distinction of all the difference between reasonable optimism and blind optimism. A blind optimist might say, "The stock market always goes up, so I'll take out a massive loan, put it all into one speculative tech stock, and expect to be a millionaire by next year." This is not optimism. It is reckless gambling. It ignores risk, probability, and the very real possibility of ruin. A reasonable optimist, on the other hand, says something quite different. Over the long term, the market has a strong historical tendency to trend upwards, driven by human ingenuity and economic growth. Therefore, I will consistently invest in a diversified portfolio. I will expect volatility and even severe downturns as a normal part of the process. But I will remain invested through the turmoil, because the odds of a positive outcome over a span of several decades are overwhelmingly in my favor. A reasonable optimist knows the journey will be a roller coaster, not an escalator. They expect recessions. They budget for market crashes. They see downturns not as a reason to panic and sell, but as a feature of the system, and perhaps even an opportunity. They don't sell in a panic because their belief isn't in a perpetually rising market, but in the long-term ability of people to solve problems. Pessimism sounds smarter and feels safer in the moment. But optimism is what pays the bills for retirement. It is the simple, powerful belief that while bad news is loud, urgent, and everywhere, human progress is quiet, slow, and unrelenting. For the long-term investor, betting on that quiet, unrelenting progress isn't just a hopeful, feel-good strategy. It is the most rational, evidence-based one there is. We have reached the part of our journey where we confront one of the most powerful and potentially dangerous forces in finance. The story. In his chapter, When You'll Believe Anything, Morgan Housel delves into why the human mind is fundamentally wired to prefer a compelling narrative over cold, hard data. It's a cognitive feature that has helped us thrive for millennia, but one that can lead to financial ruin in the modern world. Let's begin by considering a simple truth. Stories are the most powerful form of persuasion. Imagine you are presented with two investment opportunities. The first is laid out on a spreadsheet, dense with columns of data, price-to-earnings ratios, discounted cash flow models, revenue growth percentages, and standard deviations of returns. It's statistically sound, but it's sterile. The second opportunity is presented as a story. It's the tale of a visionary founder who, after a personal tragedy, dedicated her life to creating a technology that will save millions. It's a story of struggle, innovation, and an inevitable, world-changing triumph. Which one captures your imagination? Which one makes you feel something? For almost everyone, it's the story. Statistics and data appeal to our analytical brain, the part that requires effort and energy to engage. Stories, on the other hand, slip past our critical faculties and connect directly with our emotions. They provide context, meaning, and a sense of purpose that raw numbers can never offer. Our brains didn't evolve in an environment of spreadsheets. They evolved around campfires, where information about survival, threats, and opportunities was passed down through narrative. A good story is easy to remember, easy to share, and emotionally resonant. A table of data is none of those things. This inherent preference creates a significant vulnerability. We want to make sense of the world, especially the chaotic and unpredictable world of finance. We crave explanations for why things happen. Why did the market go up today? Why did that stock plummet? The reality is often a complex interplay of millions of actors, algorithms, and random events, a truth that is unsatisfying and difficult to grasp. So, we create stories to fill the void. We construct simple, linear cause and effect narratives. We might say, the market rose because the inflation report was better than expected, or this stock is failing because the CEO is incompetent. These stories might contain a kernel of truth, but they are almost always gross oversimplifications. They filter out the inconvenient data, the randomness, and the nuance that doesn't fit the clean narrative arc. We do this because a simple story gives us the illusion of understanding and control. If we believe we know why something happened, we feel more confident that we can predict what will happen next. This is where the real danger lies. We become so attached to our narratives that we engage in confirmation bias, actively seeking out information that supports our story while dismissing anything that contradicts it. If you believe a certain technology is the future, you will gravitate towards articles and experts who sing its praises and ignore the critics pointing out its flaws. The story becomes a self-reinforcing reality tunnel. Now, let's apply this to one of the most dramatic financial phenomena of recent years: speculative bubbles, such as those seen in meme stocks or certain cryptocurrencies. What fueled their astronomical rise wasn't valuation models or cash flow analysis. It was an incredibly powerful story. Take the case of meme stocks like GameStop. The story wasn't about the company's future earnings potential as a brick-and-mortar video game retailer. The story was a modern-day David versus Goliath. It was a narrative of a decentralized army of retail investors, united on social media, taking on the greedy, manipulative hedge funds of Wall Street. It was a story about rebellion, community, and justice. The catchphrases, "apes together strong," "diamond hands," "to the moon," were not financial terms. They were the slogans of a movement. People weren't just buying a stock. They were buying a role in an epic tale. They were part of a tribe fighting a common enemy. This narrative was so compelling that it made the actual price of the stock almost irrelevant. The story was the asset. Similarly, consider the stories behind many cryptocurrencies. For some, it's a libertarian narrative of freedom from centralized banks and corrupt governments. It's a story of creating a new, democratic financial system for the people. For others, it's a story of technological inevitability, that you are getting in on the ground floor of the next internet. A revolution that will change everything. These stories tap into deep-seated desires for control, for a fairer world, or for the simple, powerful fear of missing out on a once-in-a-generation opportunity. When the story is that good, the details like what the asset actually does, how it generates value, or its extreme volatility can seem like minor footnotes. The narrative provides the fuel, creating a feedback loop where rising prices seem to validate the story, which in turn attracts more believers, pushing prices even higher. This brings us to Housel's crucial lesson: the more you want something to be true, the more likely you are to believe a story that supports it, regardless of the evidence. This is the heart of the matter. Our desires and our needs are the tinder that allows the spark of a good story to burst into an inferno of belief. If you are desperate to get rich quick, you are the perfect audience for a story about a little-known stock that's about to explode. If you feel powerless in the current financial system, you will be drawn to a narrative about a revolutionary asset that will upend the old order. The story gives you permission to believe what you already want to believe. So, how do we protect ourselves? The goal is not to reject stories entirely. They are an inescapable part of how we think. The key is to develop the ability to separate the narrative from the investment case. It requires a conscious effort to step back from the emotional pull of the story and ask critical questions. Ask yourself, is this story compelling because it aligns with what I want to be true? What facts or data would have to be true for this investment to make sense? Independent of the narrative, what are the counter-arguments that this beautiful story is conveniently leaving out? Try to argue against your own beliefs. Actively seek out the bearish case for the investment you love. If the story is about a visionary founder, remember that even visionaries can fail. If the story is about a technological revolution, remember that history is littered with revolutionary technologies that failed to become profitable investments. By recognizing our innate hunger for narrative, we can treat appealing stories with a healthy dose of skepticism. We can appreciate a good tale for its entertainment value without letting it dictate our financial decisions, because in the world of money, the best stories are often the most expensive ones to believe. Chapter 37. A case study In narrative Bernie Madoff, we often think of finance as a world of numbers, of cold, hard data, spreadsheets, earnings reports, interest rates. But if there is one lesson to take from the wreckage of the largest financial fraud in history, it's this: the most powerful force in money is not a number, it's a story. And no one in modern history told a better, more destructive story than Bernard L. Madoff. To understand the Madoff affair is to understand the seductive power of narrative. It's a case study not just in greed, but in how a compelling story can blind even the most sophisticated minds, causing them to abandon the most basic principles of due diligence. The story Madoff sold wasn't one of spectacular, unbelievable returns. That would have been too obvious, too crude. Amateurs promise to double your money overnight. Masters of deception offer something far more alluring: certainty. Madoff's story had three core, irresistible elements. First, there was the storyteller himself. Madoff wasn't some slick outsider. He was the ultimate insider, a former chairman of the Nasdaq Stock Exchange, a respected figure on Wall Street for decades. He was the system. This gave him a cloak of unimpeachable credibility. He didn't need to sell you. His reputation did the work for him. Second, there was the secret. He claimed to use a complex strategy called a split-strike conversion. The name itself was a stroke of genius, vague enough to be mysterious, yet technical enough to sound legitimate. When asked for details, his fund would demur, claiming it was proprietary. The strategy was a black box, and that was a feature, not a bug. It allowed investors to believe they were privy to something no one else understood. It made them feel special. And third, and most powerfully, there was the exclusivity. You couldn't just give Bernie Madoff your money. You had to be invited. He cultivated an aura of being a private club for the elite. He would famously turn people away, claiming the fund was closed. This wasn't a sales tactic. It was psychological warfare. The more he rejected people, the more desperately they wanted in. They weren't just investing for returns. They were seeking validation, a sign that they had made it. To be a Madoff client was to be a member of the financial aristocracy. These three elements: the credible wizard, the secret recipe, and the exclusive club, combined to create the perfect narrative. And what was the product of this narrative? The most beautiful, impossible financial statements anyone had ever seen. While the S&P 500 gyrated wildly, Madoff's fund delivered smooth, consistent returns of 10 to 12%, year in, year out, through bull markets and bear markets, through recessions and booms. The line went up. It never wavered. It was a story of safety in a dangerous world, of order in the midst of chaos. And people believed it because they were desperate to. The story was so powerful that it made the red flags invisible. And there were so many. His auditor was a tiny, two-person firm in a suburban strip mall, a ludicrous choice for a multi-billion-dollar operation. He refused to allow electronic statements or online access, providing only old-fashioned paper mailings. The trading volumes he claimed to be making were often larger than the entire market volume for those specific options contracts. Sophisticated hedge funds that tried to reverse engineer his strategy concluded it was mathematically impossible. Yet, the money kept pouring in. Why? Because investors weren't looking at the facts. They were invested in the story. Social proof was overwhelming. If your friends, your country club peers, major charities, and savvy international banks were all invested in getting rich. Who were you to question it? To doubt Madoff was to doubt your entire social circle. The narrative became self-reinforcing. This leads us to a fundamental truth about human psychology and money. We are wired to invest in the story first and the asset second. A good story provides a simple, coherent explanation for a complex world. It gives us a sense of control and predictability. Madoff didn't sell a financial product. He sold a narrative of financial invincibility. People weren't buying his split-strike conversion strategy. They were buying a good night's sleep. The Madoff scandal is an extreme example, but we see echoes of this behavior everywhere. The charismatic CEO who paints a grand vision for a company with no profits, the cryptocurrency with a revolutionary white paper that promises to change the world, the hot stock tip from a friend that comes with a compelling backstory. The story is the hook. The numbers are just the justification we look for later. So, how can we protect ourselves? How do we separate a good story from a good investment? First, learn to love boring. Madoff's fraud was hidden behind a story of exclusivity and complexity. The truth was in the boring, mundane details, the name of the auditing firm, the format of the trade confirmations, the identity of the custodian holding the assets. Scrutinize the plumbing. Frauds almost always fall apart in the unglamorous operational details. Second, demand a simple explanation. As Einstein reportedly said, if you can't explain it simply, you don't understand it well enough. This also applies to your money manager. If they can't explain their strategy in a way you can understand, it's not because you're not smart enough. It might be because the strategy doesn't make sense. Or worse, it doesn't exist. Complexity is the friend of the charlatan. Third, actively seek out the counter-narrative. Instead of asking for reasons why an investment will succeed, make a habit of asking, how could this fail? What would have to go wrong for this beautiful story to fall apart? If you can't find a compelling bear case, you're not looking hard enough. Every investment has a downside. Finally, remember that the most seductive stories are the ones that promise an escape from uncertainty. Madoff's promise of steady returns was a fantasy. Real investing is messy, unpredictable, and uncomfortable. Any story that promises a smooth, easy path to wealth is almost certainly leaving out the most important chapters. The lesson from Bernie Madoff is not that people are stupid or greedy. It's that we are all susceptible to a good story. And the best defense is to be the critical editor of the stories we are told, especially the ones we tell ourselves. We've spent the last several chapters dissecting the core principles Morgan Housel lays out in The Psychology of Money. We've talked about luck and risk, the power of compounding, and the critical difference between being rich and being wealthy. But theory is one thing, application is another. How do these ideas actually play out in a real person's financial life? That's what this chapter is about. I'm going to pull back the curtain on my own finances. Not the numbers, but the philosophy behind them. These are my personal financial confessions. The ways I've tried to internalize the lessons from this book and build a life around them. Before I dive in, I need to make a few things crystal clear. First, my overarching financial goal isn't a number in a bank account. It's not a fancy car or a bigger house. My goal is simple. And it's the same one Housel advocates for: independence. The freedom to wake up every morning and say, I can do whatever I want today. It's about having control over my time, which I believe is the highest dividend money can pay. Second, I need to acknowledge the giant, unavoidable role of luck in my own story. I was born in a country with a stable economy, to a family that valued education, and I entered the workforce during a period of incredible technological growth and market expansion. To ignore this would be arrogant and would miss one of the book's most vital points. Humility is paramount in finance. And third, and this is the most important point, what follows is not advice. It is not a prescription for you to follow. This is simply my personal blueprint. A system built around my own goals, my own fears, and my own psychological quirks. The entire premise of this book is that we are all different. We have different risk tolerances, different timelines, and different definitions of success. The value here isn't in copying my actions, but in seeing the process of how one person can take these timeless principles and forge them into a personalized strategy. This is my attempt to humanize the content, to move from abstract theory to tangible application. Let's begin. My first confession is that I view wealth primarily through the lens of endurance. My financial plan is not optimized for maximizing returns. It's optimized for maximizing my ability to stay in the game. I am obsessed with the idea of being financially unbreakable. This means my savings rate is far more important to me than my investment strategy. While others chase the highest possible alpha or the next hot stock, I focus maniacally on widening the gap between what I earn and what I spend. Why? Because that gap is my defense. It's the moat around my financial castle. A high savings rate gives me options. It means I don't need to take on excessive risk in the market to meet my goals. It means a job loss is a setback, not a catastrophe. It means I can weather a prolonged bear market without being forced to sell my assets at the worst possible time. It's the ultimate form of control in a world filled with financial uncertainty. My second confession flows from the first. I choose to be reasonable, not rational. A purely rational investor might put 100% of their long-term savings into stocks, as they have historically provided the best returns. I don't do that. I hold a significant amount of cash, far more than any financial advisor would deem optimal. Rationally, this cash is a drag on my net worth, eroded by inflation every single day. But reasonably, it's the best money I've ever spent. That cash is the price I pay to sleep soundly at night. It's the psychological buffer that prevents me from panicking when the market inevitably plunges 20% or 30%. Knowing that cash is there allows me to let my stock investments do their work over the long term. Without me meddling and making emotional decisions, I am not a spreadsheet. I am a human being, susceptible to fear and greed. My financial plan acknowledges this. It's built for a real person, not a perfectly rational robot. This leads to my third, and perhaps most controversial, confession. I own my home outright. I have no mortgage. From a purely rational, mathematical standpoint, this is a terrible decision. Mortgage rates have been historically low, and I could almost certainly earn a higher return by investing the money I used to pay off my house into the stock market. The math is clear, but again, I'm not playing a mathematical game. I'm playing a psychological one. The feeling of knowing that no matter what happens in the world, a market crash, a recession, a personal health crisis, my family will have a roof over their heads, is a psychological dividend that no stock market return can match. It is the bedrock of my financial independence. It removes a massive, non-negotiable monthly expense from my life, which dramatically lowers the bar for what I need to earn to be free. It's a move that prioritizes being unbreakable over being optimal. Finally, my fourth confession is that I don't have specific, granular goals for my money. I don't have a plan to retire at exactly 62 with exactly $3 million. My goal is much looser: to save as much as I can, for as long as I can, to maximize my future options. The world is an unpredictable place. The person I am today may have wildly different desires from the person I will be in 20 years. Instead of saving for a specific thing, I'm saving for a future, unknown version of myself. I'm saving for flexibility. Maybe that flexibility will mean retiring early. Maybe it will mean changing careers to something less lucrative but more fulfilling. Maybe it will mean having the ability to help a family member in need or seize an unexpected opportunity by focusing on a high savings rate and a durable, long-term strategy. I am essentially buying options for my future self. The more I save, the more options I will have when the time comes. So there you have it. A financial strategy built on durability, a high savings rate, being reasonable instead of rational, prioritizing psychological comfort, and saving for future flexibility. It is not the most aggressive or mathematically optimal plan. It won't make me the richest person I could possibly be. But that's not the goal. The goal is to be independent. And this strategy, tailored to my own psychology, gives me the best chance of achieving that independence and, more importantly, sustaining it for the rest of my life. In the world of finance, we are often asked for our specific strategies, our hot stock tips, our predictions for the next quarter. But the most powerful financial strategies are often the most personal, born not from complex spreadsheets, but from a deep understanding of our own psychology and the world's inherent unpredictability. Today, I want to share my first financial confession. The bedrock of my family's financial plan. We have a high savings rate, and it has almost nothing to do with what we want to buy. For years, my wife and I have saved a significant portion of our income, not because we're planning to buy a yacht or retire to a private island at 40. We do it for one reason, and one reason only: humility. We save because we are acutely aware that the future is unknowable. The world is a complex, chaotic system, and our ability to predict what will happen next year, let alone in the next decade, is virtually zero. A high savings rate is our explicit acknowledgement of this reality. It's a hedge against the inevitable surprises that life will throw our way. Think of it as a margin of safety. When an engineer designs a bridge, they don't build it to withstand the average times weight of traffic. They build it to withstand a weight far greater than anything they expected to encounter: a traffic jam of the heaviest trucks. In a hurricane, during an earthquake, that gap between the expected and the possible is the margin of safety. Our savings serve the exact same purpose. We don't save for what we expect to happen. We save for the vast range of things that could happen. A sudden job loss, a medical emergency, a market crash that wipes out 40% of our investments, a global pandemic that shuts down the economy. These aren't just theoretical risks. They are inevitable parts of the human experience. This is where the concept of wealth is what you don't see becomes tangible. The fancy car in the driveway isn't wealth. It's the absence of wealth. Money that has been spent. True wealth is the money not spent. It's the financial assets that haven't been converted into stuff. It's the unspent income sitting in a savings or investment account, working quietly in the background. This unseen wealth is what provides the real, lasting value. It buys something far more precious than any material possession: control over your own time. It creates options. Having a high savings rate means you can look at your boss and say, "I can afford to wait for a better job if this one doesn't work out." It means you can look at an investment opportunity and say, "I can afford to be patient and wait for the right price." It means you can look at a broken furnace in the middle of winter and say, "This is an annoyance, not a financial catastrophe." Savings in the bank gives you a level of independence and flexibility that people living paycheck to paycheck can only dream of. The ability to change course, to weather a storm, to seize an unexpected opportunity that is the true return on savings. Let me share a story that crystallizes this. A friend of mine, let's call him David, worked for a very successful, fast-growing tech company in the late 2010s. He was brilliant at his job, and his compensation, mostly in company stock, was soaring. Many of his colleagues lived a life that reflected this success. They bought Teslas, expansive homes, and took lavish vacations. David, however, was different. He and his wife continued to live in their modest home and saved aggressively. They saved close to half their income, investing it in a diversified portfolio, completely separate from his company stock. His colleagues privately thought he was crazy. Why not enjoy the fruits of his labor? Then, the tide turned. The company, once a Wall Street darling, hit a series of unforeseen roadblocks. A key product failed, a competitor surged, and regulatory issues mounted. The stock price, which had seemed unstoppable, plummeted by over 80% in less than a year. Then came the layoffs. David, along with thousands of others, lost his job. For his colleagues, it was an unmitigated disaster. Their net worth was decimated because it was tied to the company's stock. Their high monthly expenses, once easily covered, became an anchor, dragging them down. They were forced into a panic, taking the first job they could find, often for much less pay, just to stay afloat. David's situation was starkly different. While losing his job and seeing his company stock become nearly worthless was painful, it wasn't a crisis. His substantial savings, his unseen wealth, acted as a powerful buffer. It gave him the most valuable asset in a time of crisis time. He didn't have to panic. He spent 6 months re-evaluating his career, took some courses to update his skills, and eventually found a new role that was an even better fit for him in a more stable industry. His savings didn't just save him from financial ruin. It gave him the freedom to turn a potential catastrophe into a strategic career move. That is the power of a high savings rate. It's the ultimate insurance policy against a world that will always be full of surprises. Welcome back. We now arrive at my second confession. A principle that might sound counterintuitive in a world obsessed with complexity and secret formulas. My financial plan is simple, and I embrace the fact that it's boring. The most powerful force in my investment strategy isn't my intellect or my ability to pick winning stocks. It's time, it's patience. So, what does this boring strategy look like? It's not a complex web of exotic assets. My wife and I have all of our stock market investments in just a handful of low-cost index funds. That's it. We own a Vanguard Total Stock Market Index Fund, a Vanguard Total International Stock Market Index Fund, and a small portion in a bond index fund. We don't own individual stocks. We don't trade. We don't try to time the market by jumping in and out. The philosophy here is straightforward. I have no edge. I don't believe I can consistently pick individual stocks that will outperform the market average. And frankly, the data shows that very few professional investors can do it either over the long run. So, instead of trying to times beat times the market, my goal is to times beat times the market. By owning a total stock market index fund, I effectively own a tiny piece of every publicly traded company in the country. My returns will perfectly mirror the market's returns, minus a minuscule fee. I am guaranteed to capture the full power of the market's long-term growth. I won't get the exhilarating highs of picking the next Tesla, but I also won't suffer the devastating lows of picking the next Enron. My success isn't dependent on being smarter than everyone else. It's dependent on my patience and discipline to just hold on. This is where the psychology comes in. The single biggest advantage of a simple strategy is behavioral, because it's easy to understand. It's easy to stick with. When the market crashes, I don't have to analyze a dozen different company reports to decide what to sell. I know exactly what I own, a diversified slice of the entire economy. There's nothing to second guess. The plan is to do nothing, which is the easiest plan to follow during a panic. This simplicity acts as a shield against my own worst instincts: the instinct to panic sell, the instinct to chase performance, the instinct to believe I can outsmart the system. This brings us back to a core theme of this book: being reasonable is more important than being rational. A rational investor might spend hours building a complex, algorithmically optimized portfolio that promises an extra 0.5% return per year. But that complexity introduces more points of failure. When the market gets volatile, will they stick to that complex plan, or will they start tinkering? Convinced they can improve it, my simple plan might not be perfectly rational on paper, but it is eminently reasonable. It's designed for a human, not a computer. It acknowledges that my behavior is the biggest risk to my long-term success. Furthermore, this strategy is my defense against the seduction of pessimism. The financial news cycle thrives on fear and urgency. Every day, there's a new reason to panic, a new crisis on the horizon. A complex, active strategy tempts you to react to that noise. Should I sell my tech stocks because of this new regulation? Should I buy oil stocks because of that conflict? A simple index and hold strategy allows you to tune it all out. The plan doesn't change based on headlines. The plan is to let the broad engine of global capitalism do its work over decades, a force that has historically been one of the most powerful sources of optimism and wealth creation, despite constant short-term pessimism. In the end, my goal isn't to find excitement in my investments. My life provides plenty of that. My goal for my money is to let it compound quietly and effectively in the background. My greatest edge is not a secret algorithm or inside information. It's my long time horizon and my willingness to be patient. It's embracing the idea that when it comes to investing, the most effective strategy is often the one that feels the most like doing nothing at all. And that is the simple, boring, and powerful truth of my second financial confession. In the grand theater of personal finance, there are few scripts as powerful, as deeply ingrained, as the one titled The American Dream. It's a narrative whispered to us from birth, projected on screens big and small, and reflected in the lives of those around us. It's a story of upward mobility, of tireless work leading to boundless prosperity. But as Morgan Housel's principles teach us, the most influential factors in our financial lives are often the psychological ones, the stories we tell ourselves. And the modern story of the American dream has, for many, become a dangerous financial trap, disguised as aspiration. Historically, this dream was rooted in something intangible yet profound: freedom. It was the dream of escaping rigid class structures, of owning a piece of land, of building a life based on one's own effort, not one's lineage. It was the freedom to choose your path, the opportunity to create something from nothing. The reward was autonomy. The house and the farm were symbols of this independence, not the end goals themselves. But over generations, a subtle and perilous shift occurred. The symbols of the dream became the dream itself. The narrative was slowly hijacked by consumerism. Today, when we hear the American dream, the images that flood our minds are far more specific and far more expensive. It's no longer just about freedom. It's about a 3,000 square foot house in the suburbs, 2 new cars in the garage, an SUV for the family trips, and a sedan for the commute annual overseas vacations, and a life filled with the latest gadgets and fashionable brands. The abstract concept of opportunity has been replaced with a concrete checklist of possessions. This new dream is visible, tangible, and perfectly calibrated for social comparison. Which brings us to its insidious engine, the pressure to keep up with the Joneses. Housel reminds us that humans are social creatures, wired to gauge our own success by looking at our peers. We see our neighbor's new BMW in their driveway, and suddenly our perfectly functional Toyota feels inadequate. We see a friend's kitchen renovation on Instagram, and our own kitchen becomes a source of discontent. The problem is, this game is unwinnable. As Housel would argue, we are trying to satisfy a deep psychological need for respect and admiration with the blunt instrument of material possessions. We think, if I had that car, that house, that watch, people would admire me. But what we fail to realize is that when people see you in a fancy car, they aren't thinking about how cool you are. They are imagining how cool times would look in that car. It's a shallow form of admiration that rarely translates into genuine respect. Furthermore, this social comparison focuses exclusively on the visible tip of the wealth iceberg. We see the car, but we don't see the crushing monthly payment. We see the big house, but we don't see the suffocating mortgage and the property taxes that keep the owner chained to a high-stress job. We see the luxury vacation photos, but we don't see the credit card bill that follows. Wealth, as Housel defines it, is what you don't see. It's the money not spent. It's the cars not bought, the diamonds not worn. It's the financial assets in a portfolio that are quietly compounding, buying you something far more valuable than a new gadget freedom. This modern interpretation of the American dream, fueled by social comparison, creates a dangerous duality. On one hand, it can be a powerful motivator. The desire for a better life can fuel ambition, pushing people to study harder, work smarter, innovate, and build businesses. It can drive economic progress and personal achievement. The dream, in its purest form, encourages us to reach for our potential. But for every person it inspires, it pushes another toward financial ruin. When the goal becomes a lifestyle that our income cannot yet support, the gap is inevitably filled with one thing: debt. This is the dark side of the dream. It's the mountain of student loans for a degree that promised a certain lifestyle. It's the 72-month car loan that makes a vehicle 30% more expensive. It's the home equity line of credit used to fund renovations meant to impress rather than to serve a real need. It's the persistent hum of credit card debt, financing a life that is lived for the approval of others. This debt is the antithesis of the original dream. Instead of creating freedom, it builds a prison. Every dollar of debt is a claim on your future earnings, a piece of your future time that you have already sold. Historically, this dream was rooted in something intangible yet profound: freedom. It was the dream of escaping rigid class structures, of owning a piece of land, of building a life based on one's own effort, not one's lineage. It was the freedom to choose your path, the opportunity to create something from nothing. The reward was autonomy. The house and the farm were symbols of this independence. not the end goals themselves. But over generations, a subtle and perilous shift occurred. We see the big house, but we don't see the suffocating mortgage and the property taxes that keep the owner chained to a high-stress job. We see the luxury vacation photos, but we don't see the credit card bill that follows. Wealth, as Housel defines it, is what you don't times see. It's the money not spent. It's the cars not bought. The diamonds not worn. It's the financial assets in a portfolio that are quietly compounding, buying you something far more valuable than a new gadget freedom. When the goal becomes a lifestyle that our income cannot yet support, the gap is inevitably filled with one thing: debt. This is the dark side of the dream. It's the mountain of student loans for a degree that promised a certain lifestyle. It's the 72-month car loan that makes a vehicle 30% more expensive. It's the home equity line of credit used to fund renovations meant to impress rather than to serve a real need. First, we must change the goalpost from visible wealth to time and autonomy. The ultimate goal of money is not to buy more things, but to gain control over your own life. The new American dream isn't about retiring at 65 with a McMansion. It's about having the ability to walk away from a toxic job in your 40 seconds. It's about being able to take a year off to be with your family or start a new venture. Find satisfaction not in the praise of others, but in the quiet confidence that comes from having a robust emergency fund. This unseen wealth is your fortress of solitude. It's what protects you from the inevitable shocks of life. It's what buys you peace of mind. Redefining the American dream is not about deprivation. It's not about rejecting ambition or success. It is about reclaiming its original, powerful spirit, the pursuit of a life lived on your own terms. It limits your options, forcing you to stay in a job you dislike, preventing you from taking risks, and creating a constant, low-grade anxiety that permeates every aspect of your life. You have the big house and the nice car, but you are not free. You are a servant to your possessions. So, how do we escape this trap? How do we reclaim the dream? The solution lies in consciously redefining it for ourselves. Using the core principles of financial psychology, we see our spending habits, our savings goals, and our attitudes toward debt as the logical conclusion of clear-eyed thought. But what if they aren't? What if our most deeply held beliefs about money are not universal truths, but rather local dialects, spoken only in the time and place we happen to live? In this chapter, we zoom out from the individual to the global, embarking on a journey to explore the fascinating and wildly different ways cultures around the world approach wealth. It's about understanding that the house, the car, and the stuff are just tools. They should serve your life, not define it. The true dream, the one worth chasing, is to have a life rich in options, control, and the profound freedom to choose your own path, unburdened by the expectations of others and the weight of unnecessary debt. We often walk through our financial lives assuming our own perspective is the baseline, the default setting for what is normal and rational. Let's begin with one of the most stark contrasts in the modern financial world: the savings habits of East Asia versus those of the West. For decades, countries like China, Singapore, and South Korea have consistently boasted some of the highest personal savings rates on the planet, often exceeding 30% or even 40% of disposable income. An American, whose national average savings rate often hovers in the low single digits, might look at this and see extreme, almost superhuman discipline. But it's not just about individual willpower. It's a behavior deeply rooted in collective experience. In China, for generations, the social safety net was the family itself. Limited government support for retirement or health care meant that personal savings were not a choice, but a necessity for survival. This was magnified by the one-child policy, which placed the immense responsibility for aging parents on the shoulders of a single child. This created a powerful, culturally ingrained imperative: you save. And you save a lot, because no one else is going to save you. Furthermore, as China's economy exploded with unprecedented speed, saving became the essential entry ticket to opportunity. You needed a substantial pool of capital to start a business, to make a down payment on a home in a soaring real estate market, or to give your child an educational edge in a hyper-competitive society. Saving wasn't just a defensive measure against poverty. It was the primary offensive tool for achieving upward mobility. Now, pivot 8,000 miles to the United States in the aftermath of World War II. The nation emerged as a global superpower. Its industrial base, not just intact, but supercharged. A completely different message took hold. One broadcast on every new television set and plastered on every billboard: consume. Spending was ingeniously framed not as a vice, but as a patriotic duty, a way to fuel the great American economic engine and demonstrate the prosperity of its way of life. The rise of financial innovations like the credit card made this consumption frictionless. A home, a car, a college education, all could be had times now, times and paid for times later. Asterisk. An entire culture was built around the idea of keeping up with the Joneses, where identity was increasingly tied to what you owned. In this environment, a high savings rate could be interpreted as pessimistic, even un-American. The cultural script didn't say, hoard for a rainy day. It shouted, invest in the good life today, because tomorrow will be even better. Here we see two different histories creating two radically different, yet internally logical, psychologies of money. Let's travel now to Germany, where we find a financial mindset encapsulated by a single, potent word: Sparsamkeit. Translating it simply as thriftiness or frugality misses its profound cultural weight. Sparsamkeit is a national virtue, a moral good. It implies prudence, responsibility, and a careful, almost sacred stewardship of resources. To understand its power, we must look back to the 1920 seconds and the searing national trauma of the Weimar Republic's hyperinflation. Imagine your family's life savings, diligently built over generations, turning into worthless paper in a matter of months. Stories of people using stacks of banknotes as firewood or wallpapering their homes with currency that was cheaper than wallpaper are not myths. They are real, painful memories passed down through families. A wheelbarrow full of cash couldn't buy a single loaf of bread. This event burned a permanent lesson into the German psyche. Debt is a dangerous fire, and the value of money can be terrifyingly fragile. This history explains why, even in a hyper-digital age, Germany remains a surprisingly cash-heavy society. It explains the deep-seated cultural aversion to borrowing for consumption and the profound skepticism toward volatile investments. The post-war Wirtschaftswunder, or economic miracle, was built not on credit, but on a foundation of stability, hard work, and saving. The Deutsche Mark became a revered symbol of this stability. Therefore, Sparsamkeit is more than just saving money. It's a psychological defense mechanism, a generational shield forged in the fires of economic catastrophe. An American might view taking on a 30-year mortgage as a standard rite of passage to wealth building. For many Germans, whose cultural memory is steeped in the horror of worthless currency, That level of long-term debt feels inherently reckless and frightening. Their financial logic is calibrated to prevent their worst historical day from ever happening again. This brings us to a crucial, often invisible, factor that shapes our financial behavior: the social safety net. The promises a society makes to its citizens fundamentally alter the risks each individual must personally manage. Consider a country like Denmark or Sweden. Citizens pay some of the world's highest taxes, but in return, they receive a comprehensive cradle-to-grave support system. Healthcare is universal and high quality. Higher education is largely free. Unemployment benefits are generous, and childcare is subsidized. When the state absorbs the risk of life's most crippling financial blows, a devastating illness, a sudden job loss, the cost of raising a family, the psychological pressure on an individual to build a massive personal fortress of cash is dramatically reduced. This doesn't mean Scandinavians don't save, but the purpose times of their savings often shifts from survival to enhancement. It may be less about a what if I get cancer fund and more about a what if I want to take a sabbatical fund. The baseline of existential financial fear is simply lower because of a shared belief in collective responsibility. Now, contrast this with the United States. The philosophy is one of rugged individualism. The social safety net is far less comprehensive. The fear of a single major medical event leading to bankruptcy is a real and pervasive anxiety. The burden of funding a decades-long retirement and a child's six-figure college education falls almost entirely on the individual's shoulders. This environment breeds a different financial psychology, one driven by a potent mixture of soaring ambition and deep-seated anxiety. The pressure to save isn't just about getting ahead. For many, it's about not falling off a terrifyingly high cliff from which there may be no institutional rescue. The American dream and the American nightmare are two sides of the same individualistic coin. So, what is the ultimate takeaway from this global tour of money psychology? It is a simple but profound one. There is no single right or rational way to think about money. Our financial decisions are not made in a vacuum of pure logic. They are the product of the stories we've been told, the histories we've inherited, and the economic and social systems we inhabit. The high-saving engineer in Seoul, the credit-happy entrepreneur in San Francisco, the debtor-averse shop owner in Berlin, and the tax-happy teacher in Stockholm are all acting logically within their own contexts. Their behaviors are the rational responses to the unique set of risks, opportunities, and cultural narratives their environment presents. Morgan Housel's great insight here is to encourage us to move from judgment to empathy. Instead of criticizing how others handle their money, be it a family member or someone from another culture, we should ask why they do it that way. What historical echoes and cultural currents are guiding their hands, and, most importantly, we must turn this lens of curiosity upon ourselves. Why do you save, spend, and invest the way you do? What unspoken cultural assumptions, learned from your parents and your society, are driving your most important financial decisions? Recognizing that your financial worldview is just one of many possibilities is incredibly liberating. It frees you from the tyranny of thinking there's a single correct answer and empowers you to consciously design an approach that is truly right for you. In your own unique corner of this vast and varied world, welcome to our exploration of the psychology of money. Today, we delve into a topic that feels less like a spreadsheet and more like a tightrope walk over a canyon debt. Morgan Housel reminds us that managing money is more about psychology than intelligence. And nowhere is this more true than with debt. We think of debt as a math problem: interest rates, principal, payment schedules. But it's not. Debt is a human behavior problem. A story we tell ourselves about what we deserve now versus what we can afford later. It's a story written by marketers, whispered by our insecurities, and paid for with our future freedom. Let's pull back the curtain on the psychology of debt. The most powerful hook debt uses is the promise of immediate gratification. Our brains are wired for the now. The pleasure of driving a new car off the lot today feels infinitely more real and potent than the abstract concept of being financially secure in 10 years. This is a cognitive bias known as temporal discounting. We discount the value of a future reward in favor of a smaller, more immediate one. Debt is the financial embodiment of this bias. It allows you to collapse time, to pull your future earnings into the present. That vacation you haven't saved for, you can take it now. That new phone with the better camera, it can be in your pocket by this afternoon. The cost, the interest, the years of payments, those are problems for future you. And present you doesn't really care much about that person. This creates a dangerous loop. Each time you use debt to get something instantly, you reinforce the neural pathway that links spending with immediate pleasure. The act of swiping a credit card becomes a dopamine hit, a quick fix for a desire. The bill, when it arrives weeks later, is disconnected from that initial moment of joy. The pain of payment is separated from the pleasure of purchase, making it easier to repeat the behavior. You're not buying a product, you're buying a feeling. And the debt is the hidden price tag on that emotion. This is why Housel argues that getting wealthy has more to do with your savings rate than your income or investment returns. Resisting the siren call of immediate gratification, of pulling your future into the present, is the single most important financial skill. It's a battle fought not on a calculator, but in the trenches of your own mind, every single day. If the pull of immediate gratification is the hook, then the marketing of debt is the masterfully crafted bait. We are never sold debt. We are sold opportunity, flexibility, empowerment, and convenience. Credit card companies don't offer you a high-interest loan. They offer you rewards points, cash back, and exclusive access. A car loan isn't presented as a $30,000 liability. It's presented as a manageable, low monthly payment. The language is intentionally designed to shift your focus from the risk to the reward, from the cost to the benefit. Think about the rise of buy now, pay later services. Their marketing is brilliant in its psychological precision. It reframes a purchase not as a single, painful, financial hit, but as a series of small, almost negligible payments. A $400 jacket becomes 4 easy payments of $100. Suddenly, the mental barrier is lowered. Your brain doesn't process it as a $400 decision. It processes it as a $100 decision, which is far easier to justify. This reframing makes us feel smart and resourceful, as if we found a loophole in the system. But the system was designed for us to find that loophole. Debt is marketed as a tool for modern life, a way to smooth out your expenses and live the life you want today. It's a compelling narrative, especially in a culture that relentlessly showcases lifestyles far beyond the average person's immediate financial reach. The message is clear: you don't have to wait. You deserve it now. And this helpful tool can make it happen. The problem is that a tool can also be a weapon. When used without a deep understanding of its true cost, debt turns against you. It transforms from a tool of convenience into a cage where your future income is already spoken for, serving the desires of your past self. The marketing never shows you that side of the story. It never shows the stress, the anxiety, or the freedom you've traded away for that low monthly payment. Beyond the numbers and the marketing lies the heaviest burden of all the emotional and psychological weight of being in debt. This isn't something you can calculate on a spreadsheet. It's a constant, low-grade stress that follows you everywhere. It's the knot in your stomach when an unknown number calls your phone. It's the mental gymnastics of deciding which bill to pay and which to delay. This constant mental strain is called cognitive load. When your mind is perpetually occupied with managing debt, your capacity for other important decisions at work, in your relationships, and even for your long-term financial planning is significantly diminished. You're more likely to make impulsive, short-sighted choices because you're in a state of scarcity, focused only on getting through the next day or week. This creates a vicious cycle. The stress of being in debt leads to poor decisions, which can often lead to more debt. Perhaps you take out a high-interest payday loan to cover a credit card minimum payment, digging the hole deeper just to get a moment's relief. Shame is the other silent companion of debt. We are taught that being in debt is a moral failing, a sign of irresponsibility, or a lack of discipline. This shame often prevents people from seeking help or even talking about their situation with loved ones. It becomes a secret burden, isolating you and amplifying the stress. You see others on social media living seemingly perfect, debt-free lives, and the feeling of inadequacy grows. This emotional turmoil, the combination of stress, shame, and anxiety, makes it incredibly difficult to think logically and strategically about a solution. Escaping debt requires a clear head and a forward-looking plan. The very things that the psychology of being in debt actively works to destroy. Finally, it's crucial to understand that not all debt is created equal. The financial world often distinguishes between good debt and bad debt. And the difference is not just mathematical, but psychological. Good debt is typically used to purchase an asset that has a high probability of increasing in value or generating income. The classic example is a sensible mortgage. You're borrowing money to buy a home, an asset that historically appreciates over the long term. A student loan for a degree that leads to a high-paying career can also be considered good debt. It's an investment in your future earning potential. The key here is that the debt is tied to an asset or an investment that should, in theory, grow in value and help you build wealth. Bad debt, on the other hand, is consumadebt. It's the money you borrow for things that lose value the moment you buy them: cars, electronics, clothes, vacations. High-interest credit card debt is the quintessential example of bad debt. It finances consumption, not investment. It offers a fleeting moment of pleasure in exchange for a long-term financial drag that actively subtracts from your net worth. The psychological difference is immense. A mortgage, while a huge liability, is connected to a tangible, valuable asset. It feels like a step towards stability and wealth building. High-interest consumer debt feels like a weight. It's a constant reminder of past consumption, a financial hangover with no corresponding asset to show for it. It drains your monthly cash flow, preventing you from saving and investing for the future. The stress and shame we discussed earlier are almost exclusively the domain of bad debt. Understanding this distinction is vital. It allows you to use debt strategically as leverage for wealth creation, while ruthlessly avoiding it as a tool for instant gratification. Debt, at its core, is a simple concept that preys on complex human emotions. It offers a shortcut to our desires, disguised as a tool of financial convenience. It speaks to our impatience, our insecurities, and our deep-seated bias for the present over the future. It operates in the shadows of our financial lives, cloaked in clever marketing, and fueled by the silent shame it creates. To truly master your money, you must first master the psychology that debt exploits. It requires you to trade the intoxicating thrill of now for the profound, lasting freedom of later. It means seeing past the low monthly payment to the total cost and understanding that the most valuable things in life, peace of mind, flexibility, and control over your own time, can't be bought with credit. They can only be earned by saving more than you spend and by telling yourself a different story, a story of patience, discipline, and the quiet power of living below your means. Welcome to our exploration of Chapter 44, The Psychology of Bubbles. Here, we delve into one of the most fascinating and dangerous phenomena in finance. What happens when the price of an asset, be it a stock, a house, or even a tulip bulb, detaches completely from its intrinsic value and soars to unimaginable heights, only to come crashing down? Morgan Housel argues that bubbles are not driven by spreadsheets and valuation models, but by the powerful and often irrational currents of human psychology. They are a story of social dynamics, where the desire to belong and the fear of being left behind overwhelm logic and reason. A bubble forms when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to mostly short-term. The new short-term investors are speculators, drawn in by the allure of quick profits. Their presence is a gamble on the excitement of others, a bet that the person they sell to will be even more eager than they are. This creates a feedback loop. Rising prices, fueled by optimism, attract more buyers. This new demand sends prices even higher, which in turn attracts even more buyers and reinforces the optimism. It's a party that seems like it will never end, but it is built on a foundation of sand. To understand this, we must look at the powerful forces at play: herd mentality, the creation of compelling new era narratives, and the paralyzing fear of missing out. Let's begin with the social dynamics. Humans are social creatures. We look to others for cues on how to behave, especially in situations of uncertainty. This is known as social proof. When we see thousands of people rushing to buy a particular stock, our brains interpret this as a signal that it must be a good idea. The more people who join in, the stronger the signal becomes, creating a powerful herd mentality. Even rational individuals, who might privately question the sky-high valuations, can get swept up. They see their neighbors, friends, and colleagues getting rich. The social pressure to conform becomes immense. Doubting the crowd feels like doubting reality itself. This is the breeding ground for what former Fed Chairman Alan Greenspan famously called irrational exuberance. People stop asking, "Does this price make sense?" and start asking, "Is everyone else buying?" The second question becomes a substitute for the first. This was perfectly illustrated during the dot-com bubble of the late 1990s. The narrative was intoxicatingly simple and powerful. The internet was changing the world. It was a new era, a paradigm shift, and the old rules of business and valuation no longer applied. Companies with no profits, sometimes no revenue, were valued at billions of dollars. Why? Because they had eyeballs, mind share, or a come at the end of their name. This new era story provided the justification for the suspension of disbelief. It gave people permission to ignore the fundamentals. The story was more compelling than the balance sheet. Consider a company like Pets.com. The business model was to sell pet supplies online. It raised $82.5 million in its IPO in February 2000. Less than a year later, in November 2000, it liquidated. The company spent lavishly on marketing, including a Super Bowl ad. But its business model was fundamentally flawed. It was losing money on nearly every sale because shipping heavy bags of pet food was incredibly expensive. Yet, for a brief, shining moment, investors didn't care. They were buying the story, not the business. They were part of the herd, chasing the dream of the new digital economy. This brings us to the emotional engine of every bubble: FOMO, or the fear of missing out. FOMO is perhaps the most powerful financial motivator. There is nothing more painful than watching people all around you get rich, doing something you could have done but didn't. It feels like a personal failure. During a bubble, stories of overnight millionaires are everywhere. The taxi driver who gives you stock tips, the college student who made a fortune trading tech stocks. These stories create an intense psychological pressure. You start to feel like a fool for sticking to your sensible, long-term investment plan. Logic and caution are drowned out by the siren song of easy money. This fear is what pulls the last wave of investors in at the absolute peak. They are not investing based on analysis. They are capitulating to the emotional pain of being left behind. They buy at the top just as the early, smarter money begins to quietly head for the exits. So, how can you protect yourself? How do you know if you're in a bubble? Housel provides some timeless warning signs. First, be wary when you see a massive disconnect between an asset's price and its underlying fundamentals. When people justify astronomical valuations with the phrase, "This time it's different," it's a major red flag. History is littered with the financial wreckage of those who believed they were exempt from the laws of economic gravity. Second, listen to the social conversation. Are stories of ordinary people getting rich quick, with little skill or effort becoming common, when speculation becomes a national pastime and everyone seems to be an expert? It's a sign of a frothy market. The temptation to join in is at its peak. Third, watch for the ridicule of skeptics. In a healthy market, doubt and debate are welcome. In a bubble, anyone who questions the ever-rising prices is dismissed as old-fashioned, a fool who just doesn't get it. This intolerance for dissent is a classic sign that belief has unmoored itself from reality. Finally, recognize the pull of FOMO within yourself. When your primary motivation for buying an asset is the fear that its price will keep going up without you, you are not investing. You are speculating. Your decision is being driven by emotion, not by a rational assessment of value and risk. In conclusion, financial bubbles are a recurring feature of human history. Because our psychology doesn't change, we are wired to follow the herd, to be seduced by compelling stories, and to feel the acute pain of being left out. Understanding these psychological drivers is the first and most crucial step in avoiding the devastating financial and emotional fallout when the bubble, as it always does, inevitably pops. We've spoken at length about the slow, intoxicating climb of a financial bubble, but every asset that goes up with euphoric speed has a dark twin: the panic. The crash, the moment the music stops and everyone realizes the floor has vanished beneath them. This is the psychology of panics. It's not an intellectual exercise. It's a visceral, gut-wrenching experience that tests the resolve of even the most seasoned investor. To understand it, you have to feel it. So, imagine this. It's a Tuesday morning. You open your brokerage account. just like any other day. But today is different. A sea of red floods the screen. -4%. The number is jarring. News alerts pop up on your phone. Market plummets on fear of recession. You feel a knot forming in your stomach. But you tell yourself, it's just one day. Stay calm. I'm a long-term investor. By lunchtime, that 4% drop is 7%. Your colleagues are whispering by the water cooler. The TV in the lobby is on a financial news channel. And the faces of the anchors are grim. They're using words like bloodbath, capitulation, and freefall. The knot in your stomach tightens. You check your account again. Your decision is being driven by emotion, not by a rational assessment of value and risk. In conclusion, financial bubbles are a recurring feature of human history. Because our psychology doesn't change, we are wired to follow the herd, to be seduced by compelling stories, and to feel the acute pain of being left out. The rational, long-term investor you thought you were is being shouted down by a primal scream in your head, "Get out. Get out now." This is the contagious nature of fear. It spreads faster than any virus. You see that everyone else is running for the exit. The trading volume is astronomical. It feels like every person on earth is selling, and you are the last fool holding on. This is the herd instinct in its most powerful form. We are social creatures, wired to find safety in numbers. If the entire herd is stampeding away from something, our ancient brain doesn't stop to analyze the threat. It just runs. They must know something I don't. You think, the professionals, the insiders, they're all selling. I have to sell too before it goes to zero. The pain becomes unbearable. It's not just about the money. It's about regret. The feeling that you times have saved yourself, that you could have gotten out at the top, or at least gotten out this morning. Now, every moment you wait feels like another mistake, another knife twist of regret. You stare at the sell button, your finger hovers over it. It promises relief. It promises an end to the pain, an end to the uncertainty. This immense pressure to sell at the very worst time is not a character flaw. It's a feature of being human. Our brains are simply not wired for modern financial markets. They are wired for survival in the savannah. When our ancestors saw a shadow in the grass, the ones who assumed it was a lion and ran away survived. Even if it was just the wind. The ones who stopped to gather more data often became lunch. This is our fight-or-flight response. A market crash triggers the exact same circuitry. Your brain perceives the collapsing value of your portfolio as an immediate, life-threatening danger. It floods your system with cortisol and adrenaline, short-circuiting the rational, analytical part of your mind, the prefrontal cortex, and handing control over to the amygdala, the brain's fear center. The result is pro-cyclical decision-making. We feel euphoric when prices are high and everyone is making money, so we buy more. We feel terror when prices are low and everyone is losing money, so we sell everything. We are biologically programmed to buy high and sell low. Compounding this is the principle of loss aversion, famously identified by psychologists Daniel Kahneman and amassed. The pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $1,000 hurts far more than gaining $1,000. Feels good. During a panic, you aren't just watching numbers go down. You are experiencing a cascade of powerful, painful losses. Your brain will do anything to make that pain stop. And the most immediate way to do that is to sell. So, how do we fight against millions of years of evolution? How do we resist the siren call of panic? The solution is not to have more willpower or to be smarter than everyone else. The solution is to create behavioral systems that protect you from yourself first, and most critically, is to have a long-term plan written down times before the crisis hits. Your investment plan is a contract you make with your rational, future-oriented self. When you are calm, you decide on your asset allocation, your contribution schedule, and, most importantly, the conditions under which you would ever sell when the panic-driven, present day you wants to hit the sell button. This document is your anchor. It reminds you that you anticipated this volatility. You planned for it. The storm is not a surprise. It's a feature of the journey you signed up for. Second is the power of automation. Set up automatic contributions to your investment accounts every single month or every single paycheck. This is perhaps the most effective behavioral hack in finance. Automation removes the single biggest point of failure. You don't have to decide whether it's a good or bad time to invest. The decision is already made. Your system continues to buy, regardless of the headlines. In fact, during a crash, automation turns your fear into an advantage. As prices fall, your fixed dollar amount buys more and more shares. You are systematically buying low without ever having to time the market or overcome your own terror. Lastly, cultivate a long-term perspective by studying market history. Every major market crash in history, 1929, 1987, 2000, 2008, 2020 was followed by an eventual recovery and new all-time highs. Every single one felt like the end of the world at the time. Every panic was filled with seemingly rational arguments for why this time is different. But the engine of long-term growth, human ingenuity, innovation, and the desire for a better life has always proven more powerful than the temporary paralysis of fear. When you view market panics not as a sign of the end, but as a regular, painful, yet temporary feature of a system that trends upward over time, it changes your reaction. A crash transforms from a catastrophe into a sale. Resisting the urge to panic is the ultimate financial skill. It's not about complex spreadsheets or economic forecasts. It's about understanding that the biggest risk in investing is not the market, but yourself. It's about knowing your own psychological wiring and building a framework strong enough to withstand the inevitable storm. Chapter 46, The Psychology of Simplicity. In our quest for financial success, there is a powerful, almost magnetic, pull towards complexity. We equate complexity with sophistication, and sophistication with superior results. We believe that the more moving parts a strategy has, the more intricate the financial models, the more intelligent the investor must be. But what if this is a dangerous illusion? What if, in the world of money, the path to durable wealth is paved not with complexity, but with profound simplicity? This chapter makes the case that a simple, good enough financial strategy will almost always beat a complex, optimized one, because it is more robust, more sustainable, and far less prone to the single greatest point of failure in any system. You consider two investors. The first, let's call her Jane, adopts a classic, almost boringly simple strategy, the three-fund portfolio. She allocates her savings into three low-cost index funds, one for the total U.S. stock market, one for the total international stock market, and one for the total U.S. bond market. That's it. She sets her allocation, automates her contributions, and rebalances once a year. Her entire financial plan can be written on a postcard. Now, consider our second investor, Mark. Mark scoffs at simplicity. He believes the edge is found in the esoteric. His portfolio is a complex tapestry of investments. He has a core of individual stocks he's picked himself, supplemented by sector-specific ETFs. He delves into alternative investments, a stake in a private equity fund with a 10-year lockup, a portion in a hedge fund that promises market-neutral returns, some venture capital, and even a small allocation to fine art and cryptocurrencies. His spreadsheet has dozens of tabs, and he spends hours each week monitoring macroeconomic trends to adjust his positions. On the surface, who seems like the smarter, more engaged investor? Most would say Mark. His strategy feels active, intelligent, and tailored. Jane's feels passive, generic, and almost lazy. Yet, over the long run, Jane has a significantly higher probability of reaching her financial goals. Why? The first reason is that complexity creates a false sense of control and sophistication. Mark feels like he's at the helm of a sophisticated machine, pulling levers and turning dials. This activity gives him the illusion of control over an inherently uncontrollable system, the market. He believes his constant tinkering is adding value, that he is outsmarting the collective wisdom of millions. In reality, he is simply increasing the number of decisions he has to make, and therefore, the number of opportunities to make a mistake. Every new investment he adds comes with its own unique risks. Fee structures, liquidity constraints, and tax implications, many of which are opaque and difficult to fully understand. This complexity doesn't reduce risk. It just hides it in corners he can't see. Jane, on the other hand, has surrendered the illusion of control. She accepts that she cannot predict the future or outsmart the market. Her strategy is an admission of this humility. By simplifying, she has drastically reduced the number of decisions she needs to make, focusing only on the things she can control: her savings rate, her asset allocation, and her own behavior. This brings us to a crucial concept known as the paradox of skill. As skill levels in a competitive field increase, luck becomes more important in determining outcomes. Think of professional sports. In the early 20th century, a single, supremely talented athlete could dominate. But today, the gap between the best and the average professional is razor thin. Everyone is big, fast, and highly trained. Games are now won and lost, not on brilliant plays, but on small mistakes, a missed free throw, a dropped pass, an unforced error. Investing has undergone the same transformation. Décades ago, information was scarce, and a diligent analyst could gain a real edge. Today, we are drowning in information. Millions of the brightest minds from the best universities, armed with supercomputers, are all playing the same game. The competition is ferocious. In this environment, trying to be brilliant like Mark is a losing game. The advantage no longer comes from making more brilliant decisions than everyone else. The advantage shifts to those who make the fewest mistakes. The winner is not the person who hits the most home runs, but the person who strikes out the least. Simplicity is the ultimate tool for mistake prevention. A 3-fund portfolio is easy to understand. When the market crashes, Jane knows exactly what she owns and why. She isn't tempted to sell one of her 17 complex positions because she doesn't understand why it's suddenly down 30%. She has a simple plan, and her only job is to stick to it. Mark's complexity is his undoing. A market downturn sends ripples of chaos through his portfolio. His private equity investment is illiquid. His hedge fund isn't performing as promised. He starts to second-guess his stock picks. With so many moving parts, it's impossible to know what's working and what isn't. The temptation to do something, to sell the losers, to reallocate, to chase anew. Even more complex strategy becomes overwhelming. His complexity, which gave him a sense of control in good times, becomes a source of terror and confusion in bad times. He is far more likely to make a fatal behavioral error, like selling at the bottom. The final argument for simplicity is this: simplicity is the ultimate sophistication. Leonardo da Vinci is often quoted as saying this, and it applies perfectly to investing. Anyone can make something more complex. It takes a true understanding of a system's core principles to make it simple. A simple investment strategy is not a sign of ignorance. It is a sign of wisdom. It reflects an understanding that a few key variables, savings rate, time horizon, and broad market exposure, drive the overwhelming majority of returns. It acknowledges the destructive power of fees and the critical importance of behavior. A simple plan is durable. It can survive market crashes, economic recessions, and, most importantly, the ever-present temptation to tinker that resides within us all. It's a strategy you can explain to a teenager, stick with for 50 years, and pass on to the next generation. Mark's complex strategy is brittle. It relies on his constant attention and the accuracy of his assumptions. It is fragile. Jane's simple strategy is robust. It relies on timeless principles and the long-term growth of the global economy. It is anti-fragile. So, resist the allure of the complex. The secret to long-term financial success is not found in elaborate spreadsheets or exotic financial products. It is found in crafting a simple, elegant plan that is good enough, and then having the discipline and humility to stick with it for a very, very long time. In the world of investing, complexity is often mistaken for sophistication. The financial industry thrives on the idea that you need intricate strategies, proprietary algorithms, and brilliant, godlike managers to navigate the treacherous waters of the market. To succeed, you must be smarter, faster, and more insightful than everyone else. But what if the greatest financial innovation of the last century wasn't born from complexity, but from its polar opposite? What if it was born from a radical embrace of simplicity? This is the story of the index fund. A perfect case study in the power of being reasonable instead of relentlessly rational. To understand its revolutionary impact, we must travel back to the mid-1970s. Wall Street was a place of legends, dominated by celebrity stock pickers who graced the covers of magazines. The prevailing belief was that the market was a game to be won, and these were the masters of the game. The goal was not to do well. The goal was to beat times the market. Into this arena stepped a man named John Bogle. Bogle had a simple, almost heretical idea, one he'd been nursing since his senior thesis at Princeton University. His research had shown him a startling truth: the vast majority of professional money managers, after accounting for their fees and trading costs, did not beat the market average. In fact, their very activity, the constant buying and selling, was a drag on performance. They were, as a group, extracting huge fees for delivering subpar results. Bogle's solution was elegantly simple. If it's so hard to beat the average, why not just buy the average? Instead of paying a manager to pick a handful of stocks they thought Times would win, Why not create a fund that simply bought and held all the stocks in a broad market index, like the S&P 500? This fund would require no brilliant manager, no expensive research team, and very little trading. As a result, its fees could be microscopically low. It would guarantee you the market's return, nothing more, nothing less. In 1976, Bogle put this idea into practice, launching the first index investment trust, which would later become the Vanguard 500 Index Fund. The reaction from the financial industry was not just skeptical, it was openly hostile and mocking. The fund was derisively nicknamed Bogle's Folly. A poster, circulated by a competitor, showed Uncle Sam admonishing investors help stamp out index funds. Indexing is un-American. The very idea of aiming for average was seen as a surrender, a guarantee of mediocrity. Who in their right mind would pay for average Wall Street was built on the promise of excellence, of alpha, of being better than the rest. Bogle's fund was an indictment of their entire value proposition. It suggested that the highly paid experts were inaggregate, useless. The initial launch was a commercial failure, raising only $11 million, far short of its $150 million target. But Bogle had something more powerful than a marketing budget on his side. He had math, and over time, the math proved to be relentless and undeniable. Year after year, data began to pile up, showing just how right he was. S&P's regular SPIVA reports, which stand for S&P Indices versus Active, consistently reveal a brutal reality. Over any 10, 15, or 20-year period, somewhere between 85% and 95% of actively managed large-cap stock funds failed to beat their benchmark. The S&P 500. Think about that. You have a 9 in 10 chance of picking a fund manager, a highly educated, well-paid professional who dedicates their life to this, who will underperform a simple, unmanaged, low-cost index fund over the long term. The average that was so widely mocked turned out to be a brutally effective, high-performing benchmark that very few could consistently surpass. This is where the story of the index fund transcends finance and becomes a profound lesson in psychology. It is the perfect embodiment of the core themes of Morgan Housel's work. First, it is the ultimate expression of humility. Investing in an index fund is an admission that you do not know more than the collective wisdom of the market. It is accepting that you cannot predict which stocks will be the next big winners, which sectors will soar, or when the next crash will come. Instead of relying on your own or someone else's forecasting brilliance, you simply trust in the broad, long-term upward trend of the economy as a whole. You are giving up the ego-driven quest to be right in exchange for the much higher probability of being successful. Second, the index fund is a masterclass in patience and long-term optimism. Its strategy is not about clever moves or market timing. It's about buying and holding. It's about harnessing the slow, grinding power of compounding over decades. An index investor isn't worried about this quarter's earnings or tomorrow's headline. Their bet is simple that over the next 30 or 40 years, human ingenuity, innovation, and the desire for progress will lead to corporate growth and economic expansion. The fund's success is built on the belief that the long game is the only game that matters. It forces you to think in terms of decades, not days, which is the correct time horizon for building real wealth. Finally, the index fund is the epitome of being reasonable, rather than purely rational, asterisk, asterisk. A cold, rational economist might argue that if there's even a small chance of outperforming the market, you should take it. But the reasonable person, as Housel describes, knows that the best strategy is the one you can stick with. The emotional roller coaster of trying to beat the market, the thrill of victory, the agony of defeat. The constant second-guessing causes many investors to buy high and sell low, sabotaging their own returns. The index fund is behaviorally robust. It's boring. And because it's boring, it's easy to stick with. There are no star managers to disappoint you. No complex strategies to question. You said it. You forget it. And you let the power of the global economy work for you. It's a good enough strategy that, by virtue of its simplicity and staying power, ends up being a brilliant one. From Bogle's folly to a multi-trillion-dollar industry. The index fund didn't win because it was complex or exciting. It won because it was simple, cheap, and effective. It proved that in investing, avoiding stupidity is often more profitable than striving for genius. It is a humble, patient, and reasonable tool that has allowed millions of ordinary people to achieve financial success, not by outsmarting the market, but by simply owning it. In an age defined by immediacy, where groceries appear at our door in an hour and entire seasons of television are consumed in a single weekend, we have come to view patience as a quaint, outdated virtue. We see it as a passive act of waiting, a frustrating delay in a world that should and could move faster. But this understanding is fundamentally flawed in the world of money, and particularly in investing. Patience is not passive. It is an active, powerful, and perhaps the most underrated strategic advantage you can possess. It is a weapon in a world obsessed with short-term results. Our digital culture has systematically dismantled our ability to be patient. Every notification, every instant update, every like is a small dopamine hit that trains our brains to crave and expect immediate feedback and gratification. We have been conditioned to believe that if something is not happening now, it is not happening at all. This conditioning is catastrophic when applied to our finances. We carry this expectation of speed into the stock market, checking our portfolios daily, sometimes hourly. We see a stock soar 20% in a week and feel the pang of missing out. We see our own investments dip 5% and feel the immediate urge to sell. To stop the pain, this constant reactivity, fueled by impatience, is a recipe for disaster. We are primed to buy high out of greed and sell low out of fear. The exact opposite of any sound investment strategy. It is in this environment of frantic activity that the individual investor finds their single greatest edge over the professionals. Think about the manager of a multi-billion-dollar hedge fund. They are brilliant. They have access to cutting-edge technology, and they can execute trades in microseconds. But they have a crippling weakness. Their time horizon is brutally short. They are judged not by their performance over decades, but over quarters. A few bad months can lead to massive client withdrawals. An underperforming year can end a career. They are enslaved to short-term metrics, forced to play a game of inches, day by day. You, on the other hand, have a luxury. They can only dream of time. You have no clients to answer to, no quarterly performance reviews. Your time horizon can be 10, 20, even 50 years. This is not just a small advantage. It is the entire game. Your ability to patiently wait for a decade while a professional must show a profit by next Thursday, is an unfair fight. And it's gloriously stacked in your favor. Consider the metaphor of planting a tree. You cannot rush a tree. The process begins with active, thoughtful work. You must research the right type of tree for your climate and soil. This is your initial investment research and asset allocation. You must do the hard work of digging the hole and planting the seed. This is making your first investment. And then, the most crucial phase begins, the phase of active patience. For a long time, nothing appears to happen. You water the ground. You protect it. But you see no visible growth. An impatient person would dig up the seed every day to check its progress, inevitably killing it. The patient gardener, however, understands that the most important work is happening unseen, beneath the surface. As roots take hold, then, one day, a small sapling breaks through the soil. Even then, its growth is agonizingly slow for years. But the patient gardener continues to tend to it. Décades pass. That tiny sapling transforms into a massive, unshakable oak, providing shade and stability. The majority of its mass, its true strength, was built in its later years. This is a perfect illustration of compounding. The initial work is essential, but the subsequent growth is powered almost entirely by time and patience. Trying to rush it with more risk is like pouring too much fertilizer on a seed. You will scorch the very thing you are trying to grow. This patient approach unlocks 3 critical benefits. First, and most obviously, it allows the miracle of compounding to work. Compounding is a quiet, subtle force. It doesn't produce dramatic results overnight. It needs a long, uninterrupted runway. The first 5 years of investing may feel disappointing. The next 5 feel a little better. But it's in decades 2, 3, and 4 that the growth curve turns exponential, where your money starts making more money than your contributions do. Patience is the oxygen that compounding breathes. Second, patience is your greatest defense against behavioral errors. The urge to do something times during periods of market volatility is immense. Impatience tells you to sell when everyone is panicking or to pile into a hot trend at its peak. Patience is the discipline to override that instinct. It is the active choice to stick to your plan, to trust the process you established when you were calm and rational. It is the understanding that market crashes are temporary storms, not the end of the world. The greatest returns are often realized not by those who make the cleverest moves, but by those who simply have the fortitude to not make stupid ones. That fortitude is called patience. Finally, patience allows you to outlast the impatient. The financial markets are a transfer of wealth from the impatient to the patient. Those who chase quick profits often take on excessive risk, get wiped out, and leave the game. Those who try to time the market inevitably fail, selling at the bottom and missing the recovery. By simply remaining invested, by being durable, you outlast them. You are there to buy when they are panic selling. You are there to benefit from the long-term growth of the economy that they abandoned. It is a game of survival, and the survivor is almost always the one who can sit still the longest. In the end, building wealth has less to do with the speed of your actions and more to do with the length of your timeline. Patience is not the art of waiting. It is the art of actively giving your investments the one resource they need most, and that our modern world is most determined to take away time. Welcome to our deep dive into the financial mind. Today, we're exploring a concept that underpins nearly every successful financial journey. A principle so simple a child can understand it. yet so profound it shapes entire lifetimes. We're talking about Chapter 49, Your Money and the Marshmallow Test. Imagine a small room. Inside, a 4-year-old sits at a table. In front of them is a single, fluffy, delicious marshmallow. A researcher makes them a simple offer: you can eat this one marshmallow right now. But if you wait for me to come back in 15 minutes, and this marshmallow is still here, you will get a second one. Then, the researcher leaves. What follows is a silent, agonizing battle between impulse and patience. This was the setup for the famous Stanford marshmallow experiment, conducted by psychologist Walter Mischel in the late 1960 seconds and early 1970 seconds. The experiment wasn't just about willpower. It was a window into a critical life skill: delayed gratification. The children who managed to wait distracting themselves, singing songs, or even trying to sleep, were choosing a greater future reward over a smaller immediate one. Years later, Mischel followed up with these children. The findings were astonishing. The kids who successfully waited for the second marshmallow generally grew up to have higher SAT scores, better stress responses, lower levels of substance abuse, and were less likely to be obese. The ability to delay gratification was a powerful predictor of future success. So, what does this decades-old experiment with children and candy have to do with your bank account? Everything. You are living in the marshmallow test every single day. The test is no longer about a single treat on a table. It's about the constant barrage of financial decisions you face. The one marshmallow now is the siren song of immediate consumption. It's the brand new smartphone released just a year after you bought your current one. It's the enticing buy now, pay later offer for a pair of shoes you don't really need. It's the daily expensive latte, the weekend getaway charged to a credit card, the car loan that stretches your budget to its breaking point. These things offer an instant hit of pleasure, a tangible reward you can enjoy times. Right now, asterisk. There's no waiting required. The 2 marshmallows later is the silent, often invisible, power of saving and investing. It's the money you automatically transfer to your retirement account each month. It's the extra payment you make on your mortgage. It's the index fund you contribute to, which seems to do very little day to day, but is quietly compounding into a formidable sum over decades. This is the ultimate delayed reward. It lacks the immediate thrill of a new purchase. It's abstract, distant, and requires you to sacrifice present enjoyment for a future benefit you can't yet see or touch. Every dollar you spend is a choice. Are you eating the marshmallow now? Or are you waiting for the second one? Choosing the second marshmallow consistently is how wealth is built. It's not about earning a massive salary. It's about the gap between what you earn and what you spend. That gap, invested wisely, is your second marshmallow. And thanks to the magic of compound interest, it often grows into a third, a fourth, and a whole pile of marshmallows down the line. If it were that simple, however, we would all be wealthy. The problem is that our modern world has been meticulously engineered to make us fail the marshmallow test. Marketers and advertisers are the researchers who have perfected the art of making that first marshmallow seem absolutely irresistible, while making the thought of waiting seem like a fool's errand. Think about it. One-click ordering removes the friction, the moment of pause where you might reconsider a purchase. Credit cards separate the pleasure of buying from the pain of paying, making you feel like you're spending abstract numbers, not real money. Targeted social media ads know your insecurities and desires, dangling the perfect one marshmallow solution in front of you 24/7. The entire fear of missing out or FOMO culture is a large-scale marshmallow test, pressuring you to spend on experiences, clothes, and gadgets to keep up with an illusion of perfection you see online. You are constantly being told, "You deserve it now. The world is screaming at you to eat the marshmallow." So how do you fight back? How do you build the discipline to wait for the bigger reward? You need to strengthen your delayed gratification muscle. Here are 4 practical strategies to do just that. First, automate your success. This is the single most powerful technique. The best way to win the marshmallow test is to take the decision out of your hands. Set up automatic transfers from your checking account to your savings, retirement, and investment accounts the day you get paid. The money is gone before you even have the chance to spend it. You are essentially pre-committing to waiting for the second marshmallow, removing the daily temptation to eat the first. Second, create a purchase waiting period. For any non-essential item over a certain price, say $50 or $100, implement a mandatory 30-day waiting period. If you still want the item with the same intensity after 30 days, you can consider buying it. More often than not, the initial impulse will fade. This friction is a powerful antidote to the frictionless world of one-click buying. It gives your rational brain a chance to catch up with your emotional impulse. Third, make the future reward tangible. It's hard to get excited about a retirement fund. It's an abstract concept. Instead, visualize what that fund represents. It's the freedom to quit a job you hate. It's the ability to travel the world without worrying about money. It's the security of knowing you can handle a medical emergency. Create a vision board or write down your long-term goals. Look at them often. When you make the 2 marshmallows a vivid, emotional, and concrete goal, the 1 marshmallow of an impulse buy starts to look a lot less appealing. Fourth and finally, curate your environment. You are a product of the information you consume. If your environment is constantly tempting you, change it. Unsubscribe from marketing emails that scream 24-hour flash sale. Unfollow social media influencers whose sole purpose is to make you feel inadequate and sell you products. Mute advertisements. By reducing your exposure to temptation, you don't have to rely on sheer willpower, which is a finite resource. You're simply taking the first marshmallow off the table, making it easier to wait for the second. In the end, the path to financial well-being is less about spreadsheets and stock picking, and more about mastering the psychology of your own mind. It's about recognizing that you are in a constant, lifelong marshmallow test. The difference between financial struggle and financial freedom is rarely a matter of intelligence or luck. It's a matter of patience. It is the accumulated result of thousands of small decisions, of choosing the second marshmallow again and again, until it becomes a habit. The gap between your current financial reality and your future financial goals is paved with the marshmallows you chose not to eat today. Choose wisely. We have traveled through stories of janitors who became secret millionaires and Wall Street geniuses who went bankrupt. The first pillar is humility. Financial humility is the honest acceptance that the world is a complex and unpredictable place. It's recognizing the immense role that luck and risk play in every outcome. The brilliant investor who succeeds may have been skillful, but they were also likely lucky. The failed business owner may have made mistakes, but they were also likely unlucky. Let us begin by reaffirming the single most important idea in this entire book, the bedrock upon which this unified theory is built. Financial success is not a hard science. It's a soft skill. How you behave is far more important than what you know. You can have a Ph.D. in finance, but if you panic sell during a market crash, you will lose. Conversely, You can be a school teacher with a basic understanding of index funds. But if you consistently save and invest for decades without interruption, you will almost certainly build wealth. The gap between what we know and what we do is the Grand Canyon of finance. Our unified theory is the bridge across that canyon, built upon three foundational pillars: humility, patience, and discipline. If you still want the item with the same intensity after 30 days, you can consider buying it. More often than not, the initial impulse will fade. This friction is a powerful antidote to the frictionless world of one-click buying. It gives your rational brain a chance to catch up with your emotional impulse. Third, make the future reward tangible. It's hard to get excited about a retirement fund. It's an abstract concept. Instead, visualize what that fund represents. Humility forces us to ask the most important question: and what if I'm wrong? This question is the architect of a margin of safety. It leads you to save more than you think you'll need, to diversify your investments beyond what feels necessary, and to avoid taking on debt that could wipe you out if the future doesn't unfold exactly as you planned. The humble investor doesn't try to be coldly rational, predicting the future with pinpoint accuracy. Instead, they aim to be reasonable, acknowledging uncertainty, and building a plan that is resilient enough to survive a wide range of possible futures. Humility is your defense against the one thing that can permanently remove you from the game ruin. The second pillar is patience. If humility is your defense, patience is your greatest offense. Patience is the catalyst for the most powerful force in finance: compounding. We are all told about compounding, but our linear thinking brains struggle to grasp its exponential magic. Compounding doesn't work if you interrupt it. It's like planting a tree. You can't keep digging it up to check on the roots. You must plant it in good soil and then let it be. Patience is the act of letting it be. It is the quiet confidence to do nothing when every fiber of your being screams to act, to buy the hot stock, to sell during a panic, to constantly tinker with your portfolio. Warren Buffett's fortune isn't just due to his skill as an investor. It's a testament to his timescale. He started investing as a child and has never stopped. His wealth is a product of a good rate of return multiplied by an almost unimaginable amount of time. Patience is the understanding that the biggest gains don't happen overnight, or even over a few years. They happen in the final, boring, unexciting years of a long-term plan. It's a superpower in a world that craves instant gratification. The third and final pillar is discipline. If patience is about time, discipline is about the space you create in your finances. Specifically, it is the gap between your income and your ego. Morgan Housel defines wealth as the nice cars not purchased, the diamonds not bought, the watches not worn. Wealth is the financial assets that haven't yet been converted into visible stuff. This requires discipline. Discipline is the ability to save, not saving for a specific purchase, like a house or a car, but saving for the sake of saving. This undirected saving is what creates your margin of safety, your resilience, and your freedom. It's the money that protects you from a job loss, a medical emergency, or a broken-down car. But more importantly, it's the money that allows you to seize opportunities. Discipline means taming the social comparison beast that lives within all of us. It's the quiet resolve to run your own race, to define enough on your own terms, and to derive satisfaction not from what you show others, but from the security and options you are building for yourself. Discipline isn't about depriving yourself. It's about paying yourself first in the currency of future freedom. This brings us to the peak of our unified theory, the ultimate goal: Why do we practice humility, patience, and discipline? What is the purpose of accumulating assets? It is not to have the biggest number in an account. It is not for the luxury goods. The ultimate goal, the highest dividend money can pay, is control over your time. It is freedom, the ability to wake up every morning and say, I can do whatever I want today. This doesn't necessarily mean not working. It means having the option to do work you love, on your own terms, on your own schedule. It means having the ability to retire when you want, not when you are forced to. It means being able to handle life's emergencies without spiraling into financial stress. This freedom, this absolute ownership of your time, is the real prize. The fancy car in the driveway is a fleeting signal of wealth. But the ability to take an unpaid sabbatical, to pursue a passion, or to spend a random afternoon with your children without worry, that is true wealth. And here is the most empowering part of this entire unified theory. It is universally accessible. This mindset does not require a high income, a prestigious degree, or insider knowledge. It is a psychological skill, not a financial one. A janitor who masters humility, patience, and discipline can achieve more financial security and freedom than a high-powered executive who lacks them. Your savings rate is more important than your income or investment returns. Your behavior is more important than your intelligence. It's about playing a game you can win, setting goals that are reasonable, and understanding that the true purpose of money is to be a tool to build a life defined not by what you own, but by the choices you have. This mindset is your key. The journey to financial well-being begins and ends not in the banks or on the stock market, but in the quiet, powerful space between your ears. We've explored the deep psychology behind wealth, but as Morgan Housel brilliantly illustrates, knowledge without action is just entertainment. It's time to stop being a passive listener and become an active participant in your own financial life. Welcome to your 7-day Psychology of Money Kickstart. This is your practical plan to turn these powerful ideas into lasting change. Ready? Let's begin. For day 1 and day 2, your task is simple in concept but profound in practice. Define your enough. Housel argues that the hardest financial skill is getting the goalpost to stop moving. Modern capitalism is a master at making you feel inadequate. There's always a bigger house, a faster car, a more luxurious vacation. So, for the next 48 hours, your mission is to disconnect from that noise. Grab a pen and paper, or open a new document on your computer. I want you to write down, in detail, what a truly rich life means to you. But here's the crucial rule. You must focus on freedom, autonomy, and time, not just material possessions. What does financial freedom allow you to do? Does it mean waking up without an alarm clock and deciding how you want to spend your day? Does it mean having the ability to leave a job you hate without panicking? Is it being able to spend unlimited, unstressed time with your children or parents? Be specific. Describe what a perfect Tuesday looks like for you. This isn't about setting a vague goal like become a millionaire. It's about painting a vivid picture of the life that money is supposed to enable. This definition of enough will become your compass, guiding your decisions and protecting you from the endless cycle of more. Moving on to day 3 and day 4. With your personal definition of enough as your motivation, we're going to install a system. Your task is purely mechanical, but its psychological power is immense. Automate one thing. Right now, or as soon as you can, log in to your online banking. You are going to set up one single, automatic, Recurring transfer from your checking account to a savings or investment account. The amount is almost irrelevant. It could be $5. It could be $25. It could be $100. The point is not the amount. The point is the action. You are building the habit by automating. You are removing future you, the tired you, the stressed you, the you who wants that new gadget from the decision-making process. You are paying your future self first, making savings the default. This is the essence of what Housel calls reasonable over rational, a perfectly optimized, complex savings plan you never follow is useless. A simple, good enough automated transfer that happens every single month without fail is how wealth is actually built. You are creating a gap between your ego and your income, and you're doing it on autopilot. Make the transfer, set it, and let it build the foundation of your financial future. Now for day 5. This is your margin of safety audit. One of the most critical lessons from Housel is that the world is inherently unpredictable. Things will go wrong. Good planning isn't about predicting the future. It's about surviving its surprises. A margin of safety is the gap between what could happen and what you can withstand. So today, your task is to honestly assess your finances and identify one single point of failure. Just one. Don't try to solve everything at once. Where are you most fragile? Is it a complete lack of an emergency fund? Meaning, a single unexpected car repair could force you into high-interest debt. Is it having all your retirement savings tied up in your company's stock? Making your job and your investments a single point of failure. Is it having no life or disability insurance? Leaving your family vulnerable. Identify that one glaring weakness. Then, and this is the important part, write down one simple sentence outlining a plan to begin addressing it. For example, this week, I will open a high-yield savings account for my emergency fund. Or, this month, I will research term life insurance quotes. You are not fixing it today. You are acknowledging the risk and taking the very first step to building a buffer. You are building resilience. Finally, day 6 and day 7. We've defined our destination, built a system, and audited our risks. Now, we go to the source. It's time to write your money story. Your beliefs and behaviors around money weren't formed by reading financial textbooks. They were forged in your childhood, by observing your parents, by the economic environment you grew up in, and by your own unique experiences. For these next 2 days, find a quiet space to journal. Reflect on these questions. What is your earliest memory involving money? Was it positive or negative? What did your parents teach you about money? Either directly with their words or indirectly with their actions. Was money a source of joy and security, or a source of stress and conflict in your household? How did your family's financial situation compare to those around you? And how did that make you feel? There are no right or wrong answers. The goal here is not to blame or judge. The goal is radical self-awareness. By understanding the origins of your financial instincts, why you might be an impulsive spender, or why you might hoard cash fearfully, you can begin to consciously choose behaviors that align with the life you defined on day 1. Rather than simply reacting based on old programming, this understanding is the key to unlocking lasting change. It's the ultimate tool in the psychology of money. Complete these 7 days, and you will have laid a powerful foundation for a wealthier, more intentional life. We have journeyed through the intricate and often counterintuitive world of personal finance, exploring stories of janitors who became secret millionaires and executives who went broke. We've seen how luck and risk are 2 sides of the same coin, and how our own biases can be our greatest financial enemy. Now, As we draw this exploration to a close, let's distill everything we've learned. If you were to forget every single story and statistic from this video, what are the core, unshakable truths you must carry with you? I believe it comes down to three fundamental principles. These are the pillars upon which durable wealth is built. The first, and arguably the most important truth, is this: your behavior is your biggest edge. We tend to think of finance as a hard science, a world of spreadsheets, algorithms, and complex formulas. We believe that the people with the highest IQs or the most sophisticated models will win. But Morgan Housel argues, and history proves, that this is profoundly wrong. Financial success is a soft skill. It's not about how smart you are. It's about how you behave. It is psychology, not intellect. Your relationship with fear and greed will have a more significant impact on your financial outcomes than any spreadsheet you could ever build. Think about the great market crashes. During those moments of peak panic, did people pull out calculators? No. They were driven by raw, primal fear. They sold everything at the bottom. Not because their analysis told them to, but because they couldn't emotionally stomach the pain of seeing their portfolio value drop another %. Conversely, during the euphoric peaks of a bubble, people are driven by an intoxicating greed, the fear of missing out. They pile into speculative assets at absurd prices. Not because of sound logic, but because they can't stand to watch their neighbors get rich without them. The gap between the returns that investments theoretically generate and the returns that investors actually receive is almost entirely explained by behavior. The best financial plan in the world is useless if it's so aggressive that it scares you into abandoning it at the first sign of trouble. A decent plan that you can stick with through thick and thin will always outperform a brilliant plan that you can't. Therefore, the highest return on investment you can get is not from picking the right stock, but from mastering your own temperament. It's about cultivating patience, humility, and a long-term perspective. It's about being less emotional and more disciplined. Your financial success is determined less by what's happening in the markets and more by what's happening inside your own head. The second great truth is that time, not timing, builds wealth. The most powerful force in finance is not leverage or genius stock picking. It is compounding. It's the simple magic of earning returns on your returns. But compounding is a quiet, slow, and often boring process. It doesn't produce dramatic results overnight. Its power is invisible in the short term and only becomes truly mind-boggling over very long periods. The secret ingredient for compounding is a long runway. Warren Buffett is a fantastic investor, but his real secret is that he's been a fantastic investor for over 75 years. The vast majority of his net worth was accumulated after his 65th birthday. His skill was essential, but his longevity is what made him legendary. This leads to a crucial insight. Your primary goal as an investor should not be to earn the highest possible returns. Chasing the highest returns often involves taking risks that can wipe you out. Your primary goal should be to simply stay in the game. It is about survival. You need to be able to endure the inevitable downturns and periods of volatility without being forced to sell. You need to structure your finances in a way that you can remain invested for decades, allowing the magic of compounding to do its heavy lifting. People who try to time the market jumping in and out based on predictions are fighting against this principle. They believe they can outsmart everyone else, getting out right before a crash and jumping back in right before a rally. But this is a loser's game. Not only do you have to be right twice, but you also risk missing the market's best days, which account for a disproportionate amount of the long-term gains. The person who gets a decent, but not spectacular, return for an uninterrupted 50 years will almost always end up wealthier than the person who gets brilliant returns for a few years, gets wiped out, and has to start over. Don't aim to be the sprinter who wins the first lap. Aim to be the marathon runner who is still standing at the finish line. Decades from now, that is where real wealth is built. And finally, the third and most profound truth: wealth's true purpose is freedom. Why do we even pursue money? Is it to buy bigger houses, faster cars, or more luxurious goods? While those things can be nice, they are not the end goal, the highest form of wealth. The real dividend that money pays is the ability to control your own time. It is the freedom to wake up every morning and say, I can do whatever I want today. This is the ultimate prize. The ability to choose your work, to decide who you work with, and to determine when you work provides a level of happiness and well-being that no luxury item can ever match. Having a cushion of savings, what Housel calls FU money, means you are not beholden to a terrible boss or a soul-crushing job just to pay the bills. It means you can take time off to be with a sick family member without financial panic. It means you can retire when you want to, not when you are forced to. It means you can pursue a passion project that might not pay well simply because you love it. This control over your time is the essence of independence, and recognizing this changes how you view money. The goal is not an endless accumulation of more. The goal is to reach a point of enough. Enough to give you control. Enough to give you options. Enough to let you live life on your own terms. If you don't define what enough is, you fall into the trap of constantly moving the goalposts, sacrificing your time and your happiness today in a relentless pursuit of a more that will never satisfy you. So, let these three truths be your guide. First, master your behavior, for it is your greatest asset. Second, respect the power of time and commit to the long game of compounding. And third, remember the ultimate goal: using money to buy not just things, but to buy freedom. That is the true psychology of money. We've reached the end of our exploration. But this is not a destination. It is a launchpad. Your launchpad. Now, the most important part of this journey begins: your action. Before you go, I want to ask you something. What was your single biggest aha moment from the principles we've discussed? That one insight that clicked and changed everything, please share it in the comments below. Your story, your realization, could be the precise spark someone else needs to see things differently. If this exploration has shifted your perspective on wealth and happiness, if it has armed you with a new way of thinking, please show your support by liking this video and subscribing for more deep dives into life-changing books. This entire video is a tribute to the original masterpiece. To truly internalize these concepts, the best next step is to buy and read The Psychology of Money by Morgan Housel. We've put a link in the description for you. Consider it the best investment you'll make this year. But here is the ultimate challenge. Don't let this be passive entertainment. Don't let this inspiration fade. Start day one of your new financial plan today. Right now. The best time to start building a better future was yesterday. The second best time is now. Your journey begins with a single step. Take it.